Now let's talk about payment of GST. Now in payment of GST, we will revise the basics of the three ledgers, that is e-liability, e-credit and e-cash ledger. Then we will talk about rule 86A and 86B. Then we'll talk about rule 88C. Then miscellaneous points, then interest, TDS, TCS. So this is what we are going to discuss in revise in payment. First, three ledgers. How does the working look like? See, we have three ledgers: e-liability ledger, e-credit ledger and e-cash ledger. Now you use the e-credit ledger and e-cash ledger to pay the liabilities. E-liability will contain your output tax and RCM payable, because these two things are your liabilities. See, RCM payable is not output tax, but obviously it is your liability. E-credit, you will give details of all your ITC, be it forward charge, reverse charge, IGST paid on import of goods, every kind of input tax credit. E-cash, you deposit money and you use these two to pay the e-liability ledger. There are four major heads: I, C, SUT and cess, and five minor heads: tax, interest, penalty, fee, others. So there are totally 20 types of liability which a taxable person can have. There can be a I tax liability, C tax liability, SUT, cess, interest, penalty, fee, others. Total 20 types of liabilities can be there. Now, e-credit has only one minor head, that is tax, because you don't get ITC of anything else. E-cash ledger has all the four major heads and five minor heads. Now you use this tax to pay only this tax. That means balance you have to pay through e-cash ledger. Plus, any liability under reverse charge mechanism is always required to be paid through e-cash. You cannot use your ITC balance. Composition taxpayer has to pay that 1%. That also he has to pay through e-cash ledger only. TDS under section 51 and TCS under section 52, both have to be discharged through e-cash only. You cannot use e-credit. Now, is there an order of utilization? Yes, I will be first utilized against I, then I can be used against C or S, any order, any proportion. Once you completely utilize I, then you will move to CGST. C can be used against output C, and then C can be used against output IGST. S or UT will be used against S or UT output, and then it can be used to pay output IGST. Never use C with S or S with C. Then how do you deposit money in e-cash ledger? Basically, deposit is allowed through internet banking. You can deposit over the counter, but over the counter there is a limit 10,000 per tax period, but this limit is not applicable to government department, persons notified by commissioner, and during recovery proceedings. At that point of time, any money can be collected over the counter. Plus, when you talk about two new modes which have come in, UPI, IMPS. The law has already been amended to allow UPI and IMPS transfers. Normally it is done by net banking, but UPI and IMPS is also allowed systems. IMPS, immediate payment system, UPI, unified payment interface. Then once you deposit in eCash ledger, you'll get a CPIN and CIN. What is the stage, sir? CPIN, once you create the challan, you get a common portal identification number which is a 14-digit number, and the moment you complete the payment, you get a CIN, challan identification number, which is a 17-digit number. 3 digits are added. There are bank reference numbers which are used by the banks to understand where the credit has happened and to link it with each CIN. Plus, RBI has a system of e-scroll. Sometimes when the payment is debited from your bank account, but CPIN was not generated at that point of time, then RBI maintains records of all this through e-scrolls. That e-scroll data can also be used to give a credit in your eCash ledger. Whenever you deposit money, it gets credited, and whenever you use it, it gets debited. Same is true with e-credit. Whenever you self-assess your ITC, it gets credited. Once you use it, it will get debited from e-credit ledger. Now, eCash ledger, you can claim a refund of money lying in eCash ledger, which we will discuss in refund. E-credit ledger, also some cases of export, you are eligible to claim a refund. Otherwise, the only purpose of e-credit and eCash is to use it to pay your e-liability ledgers. This was about the 3 ledgers. Now let's talk about Rule 86A and 86B. A number of frauds were happening with regard to fake ITC claims, and that's when government came into action and brought Rule 86A, which gives a power to the commissioner or a person or an officer authorized by him to block the e-credit ledger of a person who has fraudulently availed ITC. You have reason to believe that he has fraudulently availed ITC. There are 4 circumstances given in the law in Rule 86A where this blocking of ITC can be done. Blocking of e-credit ledger. First one, supplier is non-existent. The person who had raised the invoice is non-existent. Second, the invoice or document is not there, or the goods or services which were purchased is not there. Third, recipient is non-existent. There was a fake ID created, fake GST number taken in some other person's name, and fraudulent ITC was being claimed. And the last one, tax is not paid to government. So supplier has not paid the tax to government. In all these cases, officer can block the e-credit balance. Now, this blocking is an immediate step which is taken, and it will be valid for 1 year. After 1 year, you will have to unblock it. See, this is an immediate step being taken. Against such person, you will issue show cause notice and you will start recovery. That should ideally be completed within 1 year, because this is a big fraudster, and that's the reason 1 year limit is given here, saying that blocking will be valid only for 1 year. After that, you should have completed the inquiry. This is the onus on the officers. It is not blocking for ever. Plus, in addition to this, a person may request the commissioner saying that there is no tax evasion being done by me. There was one wrong entry which was made. Please unblock it. If the commissioner finds that whatever is being said by the taxpayer is true, then he might do an unblocking immediately once he finds the statements made by the registered person as true. Then coming to Rule 86B. Again, this was also a step taken for fraudsters. See, normally a person who is used to taking fake ITC, he will not pay even a single rupee through e-cash ledger. So government said that any person whose taxable turnover in a month, you have to check this monthly, exceeds 50 lakh, then 1% of e-liability to be paid through e-cash ledger. That means they restricted usage of ITC. The ITC usage will be restricted to 99% of your liability. 99% of your liability you can set off against e-credit. 1% you will have to pay through e-cash ledger. In fact, this is one of the conditions. If this is not followed, then it can lead to suo motu cancellation by officer. This is one of the contraventions. Now, all the terms are important. First, what you will look at, taxable. Second, in a month. Then third, exceeds 50 lakh. But there are 4 exceptions to this. In these 4 cases, Rule 86B will not be applicable. First one. A person who has paid income tax of more than ₹1 lakh in each of the 2 preceding financial years. If he has paid more than 1 lakh as income tax, or for a proprietorship, obviously proprietor, for a partnership, 2 partners, for a company managing director or 2 whole-time directors, for a HUF, Karta can also be covered. If they have paid more than 1 lakh as income tax in each of the 2 preceding financial years, then this condition will not be applicable. So a person who is paying income tax, government believes, yeah, it is not a fake case, so you will be eligible for claiming the benefit of ITC unrestricted by the conditions of Rule 86B. Second, you have claimed a refund of more than 1 lakh in preceding financial year due to zero rated supply or inverted tax structure. What is zero rated supply or inverted tax structure? You are a exporter. Then in that case, you are obviously going to have more of ITC. You are claiming refund. Government has allowed that refund also to you. Then in that case, you are not a fraudster. Inverted tax structure is where your rate of tax on your raw material is higher compared to rate of tax on your finished goods. So it will always lead to excess accumulation of input tax credit. If government is acknowledging that and giving you a refund, then obviously the person is not considered to be a fraudster. Third, government department, local authority, public sector undertaking. Obviously, these will not be covered by the rules of Rule 86B. They don't evade tax as such. And then last one, cumulatively paid more than 1% up to the said month in the financial year. So as I told you, this has to be checked monthly. So in any month, if 50 lakh trigger has been touched, then till that month, check cumulatively. If cumulatively up to the said month you have discharged more than 1% through e-cash ledger, then just because 1 month you had more purchases, rule 86B will not be applicable. To give you an example, because this can be asked as a case study question, April 100 lakh output, ITC 97 lakh. So how much will I pay through e-cash ledger? 3 lakh I paid through e-cash ledger. Then May 100 lakh, 98 lakh. I paid 2 lakh through e-cash ledger. June 100 lakh output, I purchased more, so I had more ITC. So for June, should this restriction of 1% through e-cash ledger apply, or should I be allowed to use full ITC? Let's see. Let's see the cumulative up to June. Cumulative up to June is 300 lakhs. 300 lakhs into 1% is 3 lakh. Have I paid more than 3 lakh up to the said month? The answer is yes. I have already paid 5 lakh rupees through e-cash ledger, and that's why in June I am not required to follow it. Plus, when you see this carefully, rule 86B does not apply to a small taxpayer, because taxable supply should exceed more than 50 lakh. Second, it will not apply to big taxpayer as well, because they will surely discharge more than 1 lakh as income tax. So government is trying to catch those people who are genuine fraudsters, neither discharging GST through e-cash nor paying income tax to government. So in that case, government wants to hold all these people. Then this was about rule 86A, 86B, both important for 5 marks. Rule 88C, newly added. Now what does rule 88C say? If there is a difference in liability between GSTR 1 and 3B up to a certain percentage as may be prescribed by GST Council. Till now, GST Council has not prescribed any limit between GSTR 1 and 3B. But if there is a difference between what you have reported in 1 and 3B, 100 rupees reported here and 90 rupees reported here, that means you are paying less tax because you pay taxes through GSTR 3B, but your recipient will get ITC. Recipient gets ITC based on GSTR 1 of supplier. So recipient is claiming 18 rupees as ITC because GSTR 1 showing 100 rupees as value and GST of 18. But you have discharged tax only on sales of 90 rupees, that is 16.2. Then in that case, government says that a notice will be issued intimating the discrepancy. You have to reply within 7 days or pay the tax along with interest. If you don't do any of these two, then next month you will not be allowed to file GSTR 1, plus recovery proceedings will directly start against such person. This is a new rule which has been added. Okay, now some miscellaneous points. How do you get a credit in e-credit ledger as self-assessed by the taxpayer? How do you get a credit in e-cash ledger? By depositing it. What is the sequence of using the credits and e-cash balance? Government has said first use it against previous tax dues, then use it against current tax dues, then use it against any amount due in any notice or order, including order under section 73 or 74. 73 deals with notice and order in other than fraud cases, and 74 deals with fraud, willful misstatement, suppression of fact cases. Then the law also says that few amounts are always required to be paid through e-cash: interest, penalty, fee, others, and these three always through e-cash. You cannot use e-credit. These were some miscellaneous points. Then let's talk about interest, which is important for your exams. People, interest comes from section 50, correct? Section 50 deals with interest. Now what does the law say? There are two types of interest. One, interest on short payment of tax or non-payment of tax, and second is ITC. See, if a person is short paid tax or not paid tax, then on the tax payable, interest will apply on 18% per annum from the due date of that tax till the date of payment. Now the question is whether interest will apply on gross liability or net liability. That is, it will apply on output or output minus ITC. Now, if there was a liability of July and you report that liability in July return, July liability, July return belatedly, meaning late. You reported July liability in July month return only, but late. Then interest will apply on net liability. But if you report July liability in some other month return and you filed October month return correctly on the due date, July month also you filed on the due date without reporting the liability, then government is like, you're a big fraudster. Interest will apply on gross liability. Plus, if you file your return after receiving a notice from department under 73-74, then also interest will apply on gross liability. Now coming to ITC. ITC, the interest will apply only when it is wrongly availed and utilized. Until and unless it is utilized, interest will not be applicable. Sir, what is the date of utilization? Date of utilization will be the date on which the balance in e-credit ledger falls below the wrongly availed ITC. So the moment balance falls below the wrongly availed ITC, interest will be applicable because that is considered to be date of utilization. Be very careful. Interest will not be from the date of availment. It will be from the date of utilization till the date of payment. Have they defined date of utilization? Yes, whenever balance in e-credit ledger falls below the wrongly availed ITC. Because say suppose I take a 30 lakh wrong availment of ITC in August return, but my balance in e-credit ledger is 40 lakh. So have I used this 30 lakh wrongly availed ITC? The answer is no. Next month, September, my balance of e-credit falls to 25 lakh. Have I used 5 lakh? Yes. So 5 lakh interest will apply from the date when the balance fell down. Now, see, September month, I will normally file the return by 20th October. But say suppose I have filed my return on 18th October itself. What is the date of utilization? If you file it before the due date, then that one. Say suppose I file it on 22nd October. Then the date of utilization will be 20th October. What does the law say? Date of utilization is date of filing GST return for that month or due date for GST return, whichever is earlier. So obviously government wants taxes early, interest also they want early. Okay, then let's talk about any other case. Sometimes how does a transaction work? Normally, see, e-credit, you normally use it with the GST return. When you file the GST return, you use the balance lying in your e-credit ledger. sometimes this particular case may happen. See this case carefully. A person received a notice that 10,000 rupees he has excess availed. He might immediately pay the amount through a separate self-assessment liability, that is DRC03. There is a separate form called as DRC03 where anything which is self-ascertained, or you receive a notice and you get to know that this is paid and you agree to it, then you may reverse the ITC immediately in your e-credit ledger using DRC03. Say suppose I do it on 4th October, not in the GST return but separately. Then on 4th October, the moment I file this DRC03, it will get debited from my e-credit ledger. Now in this case, what is the date of utilization of e-credit balance? Date of utilization will be the day when the amount is debited through e-credit ledger. And if I had sufficient balance, date of utilization is 4/10. Interest will not be applicable because I have paid the liability on 4/10. So don't forget, unless you utilize it, interest will not be applicable. And is date of utilization defined? Yes. Date of utilization is not what you feel that this is when he has utilized it. It is defined in the law. Whenever the law is saying, it is said to be utilized. So be careful about this. This was about interest. Now let's talk about TDS and TCS. See, TDS is under section 51. The rate is 1% CGST, 1% SGST, 2% IGST. This is applicable when government is the recipient. Do you agree that government is the biggest consumer? Government spends a lot of money. So say suppose Mr. A is providing goods or services to government. Now government being the recipient, government wants to track its own contracts. So what government has said, say suppose here 100 plus GST of 18 rupees is applicable. Then government will not pay 118. Government will pay only 116 because on this 100, 2% will be TDS. So they will deduct 2% TDS and this 2% government will pay to government, obviously central government and state government. Now, is this 2 rupees which is short received by A a cost to A? The answer is no. A can file and validate it online, and the moment he validates this transaction online, this 2 rupees will come in his e-cash ledger, and this e-cash ledger he can use to pay his liability. So it's not a cost. It works as a mechanism where the supplier will get it in his e-cash ledger and he can use it to pay his liability. It is as good as TDS done in income tax, that you can set off against your income tax payable. This you can set off against your GST payable. But sir, then what is the purpose if you can set off? Government wants to track whether suppliers who are supplying to them, are they discharging 18 rupees correctly? Because government will get to know how much they have purchased from this person. Whatever they have purchased from this person, A should show that much as sales. If A does not show that much of sales, then he is not paying 18 rupees correctly. Then government will catch A. That is the purpose. TDS, TCS are always to control the taxation flow. get to know the taxation flow. That's the purpose behind TDS and TCS. Okay, great. This TDS is applicable only when the taxable supply under a contract, careful, a taxable supply exceeds 2.5 lakh. And here we are talking about value. Tell me one thing, value is including GST, excluding GST? Excluding GST. Careful. Be very careful in the exam. If they give you inclusive of GST, remove GST and then check 2.5 lakh. Sometimes they'll give you 2.6 lakh, which is including GST. When you remove GST, it will fall below 2.5 lakh. TDS will not be applicable. Only when a contract is for more than 2.5 lakh, only then this will be applicable. Sir, we'll break the transaction into smaller contracts. People, who is the recipient? Government. Government will not do this cheating. Okay. Now, sir, who all are required to deduct tax? Government department, local authority, society set up by government, set up by government, statutory bodies, is RBI, etc. Then you have public sector undertakings or a board set up by government. All these will be liable. So basically government. Public sector undertakings as well, sir? Yes. Sir, what if there is a transaction between them? Whether TDS will apply, one PSU to another PSU, government to government, government to local authority? No. Then whom will government track? So it's only when someone else is providing to them. If it is between them, then in that case TDS will not be applicable. Plus, one more transaction where TDS will not apply. Say suppose supplier is in Delhi, recipient is in Karnataka, but place of supply is Delhi. If the location of supplier and place of supply is in a state different from the state of recipient, careful, these two are in same place but recipient is at a different state, then in that case no TDS. What's the reason, sir? See, in this case, what will supplier bill to recipient? Which type of tax? C plus S. Correct. Location of supplier, place of supply. Location of supplier and place of supply is Delhi, so C plus S will be applicable. Now, can a Karnataka recipient deduct TDS of C plus S of Delhi? Because if Karnataka recipient deducts C plus S, then he will deduct S of Karnataka, not S of Delhi. And that's why government has said no TDS in this case. Sir, IGST transaction, then you will deduct IGST, no problem at all. Sir, if all the three are in Delhi, no problem at all. C plus S easily recipient will be able to deduct. The problem comes only when location of supplier and place of supply is in a state different from the state of the recipient. Those two are at one place, but recipient is in some other state. So careful about these minute points which might be asked. Now coming to TCS. TCS is under section 52. The rate of TCS which is notified is 0.5 CGST, 0.5 SGST and IGST of 1%. Now, TCS is to be collected by the e-commerce operator if the supply is through e-commerce operator and the payment is also through e-commerce operator. Careful, there are twin condition. One, the supply is through e-commerce operator, plus payment is also routed through e-commerce operator. Then e-commerce operator has to collect this before making payment. Then is this 0.5, 1%, will it become a cost to supplier? No. Supplier can validate it online, and the moment he validates this transaction online, this 0.5, 1% will come in his e-cash ledger. Is it, sir? Yeah. TDS and TCS are only to track transactions. It is not for the purpose of collecting revenue. And it comes in e-cash ledger, then supplier can use it to discharge his liability. Now, is the e-commerce operator required to have a place of business wherever his supplier is? Because if the supplier is in Delhi, recipient is also in Delhi, then supplier will charge C plus S. Then eco will also have to collect C plus S. Now the question is, how will he do it? Be careful. Whenever we talk about e-commerce operator is a case where eco can take registration, that is TCS registration, even if there is no place of business in a state. No place of business in a state. So even if he does not have a place of business, he does not have to have a premise in each state, because suppliers are there in every state. Should he have place of business in each state? No. He might be from Karnataka. He can still take a TCS registration of Gujarat. That's permitted in the law. See, he cannot take regular registration, because for regular registration you need to have a place of business there. But TCS registration has given flexibility so that e-commerce operator don't face any issue. Plus, TCS is always on the net taxable value of supplies. Net taxable supplies meaning sales minus sales return on the net amount. If it is negative, then it will be on 0. Plus, anything where 9(5) is applicable, then no TCS. Reason 9(5), eco is only going to discharge the tax to government, na? When eco is only discharging tax, how can TCS apply? It will not make sense. He will collect TCS and do what with it? 9(5), nothing. Then unregistered person also, no TCS is applicable. Composition dealer, obviously composition dealer, government has said that it is not possible. Yeah, from May 24 it's going to change. But composition taxpayer, anyone who is supplying goods or service through e-commerce operator registered under section 52 cannot take composition scheme. So for your exams, November 23, not possible. So it is not possible that the person is a composition taxpayer, because a composition taxpayer cannot make supplies through a e-commerce operator. Plus, sometimes e-commerce operators also hold the stock on behalf of the sellers. Now whatever stock they are holding, they have to maintain it separately, supplier wise, and if the government is asking for those details, then those details should be provided promptly to the government officers. If that is not done, penalty will be applicable. General penalty is 25,000 CGST, 25,000 SGST. But if there is a tax evasion of not paying TCS, not paying TDS, then to the extent TDS and TCS is not paid, that much penalty can be applied. Now, TDS, the return which is filed is GSTR 7 and the due date is 10th. TCS, the return which is filed is GSTR 8. The due date for this is also 10th of the next month. So be very careful about TDS and TCS, where a question may be asked for 2 marks, or interest, a 4-mark question can be asked. Practice some questions on payment of GST. Now let's talk about invoice and other documents. Now the first discussion in invoice is section 31. Section 31, which provides the time limit to issue invoice. Time limit to issue invoice, we have also seen it in time of supply chapter. Like for example, for goods, if supply involves movement, then date of removal. Supply does not involve movement, then date of making available. Sale on approval basis, acceptance, or 6 months from the date of removal, whichever is earlier. And continuous supply of goods, statement or payment. And for services, 30 days from the date of provision or completion of the service. 30 days is replaced by 45 days for banks, financial institutions, insurance companies. Then we had discussed about continuous supply of service. If the payment date is ascertainable, then date mentioned in the contract. Payment date is not ascertainable, date of payment. Payment date is based on completion of each event. Then you need to mention some details on the invoice. Be careful, if it's a e-invoice, then there should be a QR code. And e-invoice signature is not required, otherwise signature is also an information. HSN, harmonized system of nomenclature or service accounting codes. If the last year turnover is up to 5 crores, then 4 digit is sufficient. But if it's a B2C invoice, then you can mention 0 as well. More than 5 crores, then in that case 6 digits. If it's an export-import transaction, then customs law requires 8 digit. That anyways you see it in customs, that the classification there is based on 8 digit codes. Thereafter we learn about revised invoice. Now revised invoice can be issued in case you apply within 30 days, then you get registration later. So what will happen is there will be a difference between effective date of registration, which is your liable date, and grant of registration. In the interim period, whatever invoices you have issued, you can revise them within 1 month from the date of grant of registration. That's what the law provides for. Now if you apply after 30 days, then in that case the effective date and grant date is same. If the effective date and grant date is same, then in that case you cannot revise a invoice, because revision of invoice is permitted only when effective date and grant date are 2 different dates. Like today is the effective date, but grant was given much later. Okay, then we have consolidated invoice. See, consolidated tax invoice, if 3 conditions are satisfied, then you can consolidate all those transactions which satisfy all those 3 conditions. 1, recipient is unregistered person. The value is less than 200. Careful, exactly 200 nahi, less than 200. And recipient does not require invoice. He says I don't require an invoice, then in that case you can issue a consolidated invoice. You will not issue it to anyone, you will keep it with yourself. Obviously this is not for giving it to someone, it is to be kept with yourself, because for a small store it would be practically impossible to issue invoices for every 10-15 rupees, and that's the reason government has brought this. Bill of supply. is issued by composition taxpayer or a registered person for exempt goods or service. Then there is invoice cum bill of supply, where you are supplying both exempt goods as well as taxable goods. Then instead of issuing two documents, if you are supplying both the things together, you will issue a invoice cum bill of supply. Receipt voucher. Whenever you receive an advance, you issue a receipt voucher. If you don't know the GST rate, 18% will be applicable. If you don't know the type of supply, it will be regarded as an interstate supply. Refund voucher. If you refund the advance amount, then you will issue a refund voucher. Payment voucher. Payment voucher is issued by the recipient in cases where recipient is liable to pay tax under reverse charge mechanism. That's where payment voucher comes into existence. Plus, if the supplier is unregistered and it's a case of RCM, then recipient payment voucher will be issued, plus recipient will do a self-invoicing. He will raise an invoice on himself mentioning the name of the supplier. But remember, this is only in cases of reverse charge mechanism. Then there are some other details, like for a banking company, they can issue one invoice per month. For GTA, consignor name, consignee name, origin, destination, such details have to be mentioned. For an input service distributor, basically if by mistake the invoice is issued in Mumbai branch's name, where ISD was also in Mumbai, then Mumbai branch which has received that ISD invoice can bill it to the ISD, so that input service distributor can distribute it to all other units. That is permitted. The document will be same as invoice. ISD does not do any supply, but whatever is the invoice format, that can be used by them to distribute the credit. Then multiplex screen ticket, electronic ticket is deemed to be an invoice. Even for transportation sector, ticket is deemed to be an invoice. This is a benefit given to them. Then you have a document called as delivery challan. See, whenever there is movement of goods and at that point of time you are not able to issue the invoice, then government has said that you will have to issue a delivery challan, because whenever there is movement of goods, it cannot happen without a document, so it has to move with a delivery challan. Then credit note, debit note, very important documents. See, credit note, there are four purposes. One, sales return. Second, to reduce value. Third, to reduce tax. And last one, whenever there is deficient supply of goods or services. These are the four cases where credit note will be issued. Sales return, reduce value, to reduce tax. If you have charged excess earlier, you can reduce it by this, and deficient supply of goods or services. Now, in all these cases, there is a last date to issue credit note, because it leads to reduction in tax. The last date to issue credit note is 30th November after the financial year, or date of filing annual return, whichever is earlier. Then debit note is not for purchase return. Don't forget, both these documents are issued by the supplier. It's not for purchase return. It is to increase value or increase tax. Say suppose you charge less tax, then this is where you will issue debit note. There is no other reason, only two reasons. And remember, there is no time limit to issue debit note. Yeah, reporting has to be done based on GSTR1 time limits, but there is no time limit to issue debit note. But credit note is same, time limit to avail ITC 30th November or date of filing annual return, because it leads to reduction of tax. Careful, whenever credit note is issued, output will reduce, because you will reduce your output. recipient will reduce his ITC. So the person who receives credit note reduces his ITC. Person who issues credit note reduces his output. Debit note, person who issues, his output will go up. Person who receives, his ITC will go up because he will be able to claim ITC. Okay. Then you have another two things, e-invoice. Now, e-invoice, again a very important document. See, e-invoice is required when aggregate turnover in any preceding financial year starting from 17-18 exceeds 10 crore. Then in that case, e-invoice is mandatory. Now, e-invoice is required for what kind of transactions? B2B transactions and export. That means for B2C transactions, you don't require e-invoicing. What happens in e-invoice? You generate a normal invoice. You send that data to a invoice registration portal, IRP. Once you send the data electronically to e-invoice registration portal, that invoice registration portal will give you a IRN, invoice reference number, and it is embedded in a QR code. The moment you print this IRN and QR code on the invoice, it becomes a e-invoice. That means now the document which was plain paper is now a machine readable document. It also says that anything issued where e-invoice was required, if you don't issue e-invoice, then that is plain paper. That means your recipient will not get ITC, because one of the conditions to avail ITC is you should be in possession of a invoice. So if e-invoice is applicable to you and you don't do it, then it becomes very bad for your recipient because he will not get input tax credit. So careful about this particular point. Then there are some people who are not required to generate e-invoice. One is SEZ unit. Careful, not developer, only SEZ unit. Developer is required to issue. Then you have government department and local authority. Then you have banking companies. Then you have insurance companies. Then transportation of passenger providers, GTA, and finally multiplex screen for exhibition of cinematographic film. These are not required to issue e-invoice, but they have to give a declaration saying that I declare that this is rule 48. As per rule 48, though the turnover is exceeding the limits, but we are exempted from issuing e-invoice. That note has to be given. Plus, if banking company is written, any transaction done by banking company will be covered by the exception to e-invoice. For instance, if banking company is selling bullion, gold bullion, gold biscuit, then e-invoice will still not be applicable because the exemptions here are entity wise. So if an entity is covered, then for any transaction they are not required to issue e-invoice. Then there is a concept called as dynamic QR code. Now this dynamic QR code is required for B2C transactions, but here the limit is if in any preceding financial year starting from 17-18, if the turnover has exceeded any even in e-invoice, any preceding financial year, if it has exceeded 500 crores, then only dynamic QR code has to be mentioned. What's the facility by dynamic QR code? It is a machine readable document and you don't have to enter the amount. Direct scan and pay. That's the benefit. Otherwise, if you scan a QR code, you'll have to enter the amount, then you'll enter the UPI pin. Here you don't have to enter the amount, it's embedded in that particular QR code. Now dynamic QR code is required for B2C transactions. This is not applicable for a person who is providing OIDAR service from outside India to Indian person. For them it is not applicable. Then does not apply to banking company, does not apply to insurance company, does not apply to multiplex screen, but even today government or local authority is required to issue dynamic QR code. Others are same, but government and local authority, be very careful, they are still required to issue dynamic QR code. Till now government has not given a relief. Whether it will be required for export transactions, no, because export transaction already e-invoice is there. In fact, CBIC has also clarified, whenever recipient is outside India, even though place of supply is in India, still dynamic QR code will not apply, because obviously you can't expect a person sitting outside India to scan that dynamic QR code and make payment to you. Then prepaid orders, again it is not required for any prepaid order. Then government has also mentioned that when it comes to a transaction where first you make the payment, then the invoice gets generated, then in that case order ID is sufficient. Instead of invoice number, if order ID is given in the dynamic QR code, it is sufficient. Plus dynamic QR code should be such that it can be scanned and payment can be made. UPI will be linked to the bank account. Should bank account details be provided separately in that QR code? CBIC has said no, as it is already linked to the bank account, it may not be required. Plus you will mention the full amount or the remaining amount payable. Like for say suppose invoice is for 100, but a coupon was used, 40 rupees discount you got, so you have to pay 60. So dynamic QR code will be for 100 or 60. CBIC has said that it will be only for the remaining amount, not on the full amount. Then say suppose the supply is made through a e-commerce operator, then on the invoice can Amazon's dynamic QR code be mentioned? Because Amazon is going to collect tax, can their dynamic QR code be mentioned? Though supplier is not Amazon, someone is supplying through Amazon, but can Amazon's dynamic QR code be mentioned? Can that bank detail of Amazon be given? The answer is yes, because Amazon is going to collect, so UPI of Amazon can be given because Amazon is going to collect it. Obviously he has to take the authority from the supplier and only then it will be allowed. So these are the circular clarifications issued with respect to dynamic QR code. Also refund voucher and receipt voucher, CBIC has clarified that instead of receipt voucher and refund voucher, you can also issue a invoice and credit note. That means when you receive a advance, you issue a invoice, and say suppose the other person does not want the service and you refund the advance, then you can issue a credit note. Now which is better, sir? Receipt voucher and refund voucher, or invoice and credit note? Which is better, this combination or this combination? Now credit note, if you issue, you can directly claim a deduction from output in the month in which you issue credit note. But refund voucher, if you issue, you have to apply a separate refund application to government department and then you get the refund of this money. Sir, this is better. That's what CBIC has clarified. Both the options are given. Either you can go with invoice or credit note, or receipt voucher and refund voucher. Okay, practice some sums from invoice and credit note relating to credit note and debit note adjustments, and read the theory properly for e-invoice where a question may be asked. Now let's talk about GST returns. See, a taxpayer, say suppose Mr. A, does various outward supplies and inward supplies. All his outward supplies have to be reported in a document called as GSTR1. The due date for GSTR1 is 11th after the end of the month. All his inward supplies will be shown to him in a document called as GSTR2B. Remember, he is not required to file this document. He will be able to see this. He will view and compare with purchases. So he will compare it with his purchases. Because he would have made various purchases, he will compare it with those purchases, and whatever is not coming in GSTR2B, you cannot avail input tax credit. So this GSTR2B is auto-generated based on suppliers GSTR1. So all the suppliers who supply to Mr. A would have filed their respective GSTR1, and that's how 2B of Mr. A gets generated. Then Mr. A is required to file GSTR3B, where the due date is 20th. This gets generated on 14th of every month, and it is a static document, meaning once it is generated, all those who have filed in due date will have all these entries on 14th. Say suppose one of your supplier has not filed, then it will not come in GSTR2B. It will follow up with him and avail input tax credit. GSTR3B, the due date is 20th after the end of the month. Here you will report your output tax, input tax credit, tax payable under RCM, and make the payment of taxes. Now, be very careful with regard to one important aspect. There is a scheme available to composition dealers where they can file GSTR4, one document, annual, and the due date is 30th April after the financial year. But when it comes to payment of tax has to be made on a quarterly basis, and the due date is 18th after each quarter. Then you have GSTR5, which is filed by a NRTP, and the due date for this is 13th after each month, or 7 days from last day of valid registration, whichever is earlier, because he will go away na. So government is like, say suppose you have taken a 5-day registration, then don't wait till next month 13th, file it within 7 days of your last day of registration, and then you go. 5A is for OIDAR, due date is 20th. Then you have 6, ISD, Input Service Distributor, due date 13th. 7, TDS, due date is 10th. 8, TCS, due date is 10th. 9, annual return, due date is 31st December after the financial year. With this 9C, a reconciliation statement has to be given if the turnover exceeds 5 crores, and 9 is required when it exceeds 2 crores, and 9C when it exceeds 5 crores. 9C is self-certified, no need of CA/CMA certification, it can be self-certified. 10 is a final return, and the due date for final return is 3 months from the date of cancellation or 3 months from date of order of cancellation, whichever is later. So you get good time limit, because this is when you have applied for cancellation, you are going away. So government says file one final return and reverse any input tax credit based on stock. 11 is UIN, unique identification number holders. They file it for inward supply to claim a refund of tax paid on purchases. Now let's talk about from where does this come. GSTR1 comes from section 37. Let's understand some key points in section 37. See, if you have not filed previous GSTR1, you will not be allowed to file current GSTR1. If you have not filed previous GSTR3B, again you will not be allowed to file GSTR1 for this month, so that government is able to get the taxes, because taxes government gets based on 3B. Some people used to file 1, never file 3B. So government said if you have not filed previous 3B, you will not be allowed to file GSTR1. Then you report all the transactions of B2B invoice wise. B2C you record it consolidated wise, but interstate more than 2.5 lakh invoice, that has to be reported separately, and interstate others can be reported together, but obviously you report it state wise so that the revenue gets distributed correctly to each of the state where the transaction has been conducted. In case of interstate supply, because IGST will be charged, it has to be shared to the respective state. Then you cannot file GSTR1 before the end of the month. However, there are two exceptions. First one being a case of casual taxable person, and second one being cancellation of registration. In these two cases it can be filed. 2B comes from section 38. 2B will have two segments: ITC which is available, ITC which is not available. Whatever is restricted under section 38, which is ITC not available, you will not get ITC. In section 38, lot of places even today it says as may be prescribed, percentage as may be prescribed, which is not prescribed till your November 23 exams, so that you can ignore for your examination purpose. Section 39 deals with return. This GSTR 3B, GSTR 4, GSTR 5, 6, 5A, 7, these come from section 39. TCS return comes from section 52, which is clearly given there. 9 and 9C, this comes from section 44. This comes from section 45. This 11 again comes from section 39. Now, there is a scheme available, and that very important scheme is called as QRMP, quarterly return, monthly payment. Let's talk about it. See, say suppose a person's aggregate turnover is more than 5 crores in preceding financial year. Then he does not get QRMP. Then he will file GSTR1 monthly 11th, GSTR 3B monthly 20th, and he will also pay the taxes monthly by 20th. But if aggregate turnover in preceding financial year does not exceed 5 crore, if aggregate turnover in preceding financial year does not exceed 5 crore, then in that case you have an option to file quarterly return. Here you have two options. Option 1, follow this monthly filing. Option 2, go for QRMP. Now what happens in QRMP? QRMP, GSTR1 you will file quarterly and the due date is 13th. GSTR 3B you will file quarterly, due date is 22nd/24th. 22nd/24th. Now be careful about this. Some states have 22nd, some states have 24th. Sir, are we required to remember which state is 22nd and which state is 24th? The answer is no. You are not required to remember that, because underdeveloped states are 24th, developed states compared to those underdeveloped states are 22nd. So both the returns you will find quarterly, but payment of tax has to be done on a monthly basis. Payment, you don't have an option. Payment of tax has to be done on a monthly basis. Now, this monthly basis, first 2 months become important, because third month anyways you will file GST R3B and pay the taxes. First 2 months, how do I pay? Where do I pay? Government says only deposit in e-cash ledger and keep. Oh, is it? Yeah. You are not required to pay it off. You are just required to deposit and keep that amount in e-cash ledger. Now, how much should I deposit for first 2 months? Here you have option A, self-assessed. You self-assess it and deposit. Output minus ITC. So output minus ITC, do this every month, and first 2 months deposit it. Like for example, April, output 10, ITC 5. So you will deposit 5 rupees. May 10, 6, you will deposit 4. June 10, 7, you will deposit 3. B option is fixed sum. Instead of doing these calculations, you can deposit 35% of tax paid in previous quarter. If your frequency of filing returns was quarterly in the previous quarter. So in the previous quarter, if you have paid 10 rupees through e-cash ledger, then for April, how much will you deposit? 10 rupees into 35%, 3 rupees 50 paise. For May, again 3 rupees 50 paise. For June, June you have to do the actual computation. 5 plus 4, 9, 9 plus 3, 12. You have already deposited 7 rupees, 5 rupees we will deposit here. So at the end of the quarter it will match. But this is the benefit which government is giving. The due date for this is 25th of next month. So for April, the due date will be 25th May. For May, it will be 25th June. For June, it will be 22nd or 24th, which is equal to the due date for 3B. Don't forget this. The due date of payment of tax is always linked to due date for filing returns under section 39. But for first 2 months, government has said 25th. So be very careful on this. Sir, what if last month I filed monthly return? Then how will I do 35% of previous quarter? Okay, government has said that last month if you have filed monthly return, then you will deposit 100% of tax paid in previous month. Here it was previous quarter, so government said 35%. Previous month, whatever you paid through e-cash, that much you deposit for April and May. Then after that, next month, next quarter, you will have the quarterly details. Sir, can I take this scheme till any amount? No. This scheme is available up to 5 crore in current financial year. The quarter in which you touch 5 crore, thereafter, you will have to shift to regular scheme. Don't write this. You have to shift to monthly filing, because you are under regular scheme only. You are just quarterly filing, that will be replaced by monthly filing. This is quarterly filing, this is monthly filing. Sir, can I shift between first option and second option? The answer is yes, quarter wise. You can shift quarter wise, and there are dates. First day of second month of previous quarter up to last day of first month of current quarter. First day of second month of previous quarter till last day of first month of current quarter. That means if you want to shift for April to June, then April to June, previous quarter is Jan to March. Jan to March, first day of second month will be 1st Feb, and last day of first month of current quarter will be 30th April. So technically what government is saying, April to June, you have to decide by end of April. April to June, you have to decide by end of April. And then go back 3 months. April, March, Feb. That's why it is 1st Feb. That's how you can easily remember this. But you should also remember the wordings because institute can ask you this. Now, is there an option to file B2B invoice on monthly basis? Because if I file GSTR1 quarterly, my recipients will start getting angry. They will not get ITC. So can you furnish B2B invoices on a monthly basis? Yes, for first 2 months you have a facility called as IFF, Invoice Furnishing Facility. Due date is 13th and there is a upper cap limit 50 lakh per month. Sir, if 1 month my sales is more, don't worry, report it in GSTR1 balance. But remember one thing, something which you have already reported in Invoice Furnishing Facility, don't report it again in GSTR1. In fact, system will not allow the same invoice as such. Sir, if there is some money lying in eCash ledger, do I have to again deposit? No. If you already have good money lying in eCash ledger and it is more than these limits, then no problem. Sir, if I don't deposit this, will interest apply? See, if you are in fixed sum and you have deposited 35%, then no interest. But if you don't deposit 35% for second month, then interest will be applicable. If there is a shortfall, if you go under self-assessed and you deposit instead of 5, you deposit 4, there is an option, you select self-assessed and deposit 4. Interest will be applicable on that 1 rupee. So be careful about interest computations. Okay. So Section 37 GSTR1, Section 38 2B, Section 39 3B 4 5, etc. Section 40 first return is the first return filed after taking GST registration. Then you have Section 41 self-assessed credit and reversal if the other person has not paid taxes. Now say suppose you are in FY 22-23. Now you have taken ITC based on GSTR 2B because the supplier has filed GSTR 1, but the supplier does not file 3B, so he has not paid the taxes. If the supplier has filed GSTR 3B and not filed GSTR 3B by September, which September are we talking about? After the month, people, not here. You are talking about 30th September. If till 30th September following the financial year not filed 3B, your supplier has not filed 3B, then in that case you have to reverse the ITC by 30th November 2023. If you reverse the ITC by 30th November 2023, then no interest. But after this, interest will begin. So be careful. Interest will begin only after this particular 30th November, after the end of the financial year. So is government giving good time? Yes. And after that, if he files the return, say suppose this he had not filed till here, thereafter he files the return. Once he files the return, you can re-avail ITC. And re-availment of ITC, is time limit applicable for re-availment of ITC? No time limit. So you can re-avail ITC once 3B is filed by supplier. This is section 41. 42-43 is not there in syllabus. 44 annual return. 45 final return. 46 notice to defaulter. If a person has not filed returns, then officer can issue a notice giving 15 days time for him to file the return. This can be done for GSTR 3B, GSTR 9. Then we have section 47, late fee. Now late fee for November 23 exams, institute has for GSTR 1, 3B, etc. Even now the late fee is 100 rupees per day or rupees 5,000, whichever is lower. But this 5,000 has some rationalizations. For GSTR 1, 3B and 4, government has given some rationalization, meaning reduction for maximum late fee. Let's see. If your turnover in preceding financial year was more than 5 crore, then maximum late fee will be 5,000 CGST, 5,000 SGST. If it was more than 1.5 crore but up to 5 crore, then 50% discount, 2,500, 2,500. If it was up to 1.5 crore, then 80% discount. If any case for that particular month or quarter you are filing nil return, no sales, then 250, 250. This will be the maximum cap. See, in real life, this 100 rupees is 25 rupees for 1 and 3B and 10 rupees for nil return. But for November 23, Institute has not brought it through amendment, though May 24 book has it. But November 23 books don't have it. So you mention 100 rupees per day for any return other than annual return, and maximum late fee cap it to these amounts based on whatever is the case. Now, what about annual return, sir? Annual return, see what government has done, and Institute has also included it. Annual return, if your turnover was up to 5 crore in the relevant financial year, because you file it for that financial year for which you are filing the annual return, then 0.02% of turnover in a state or rupees 25 per day, whichever is lower. Careful. All these things which you saw, this one and this one, all this is CGST. You'll have to double it for SGST. IGST, there is no late fee. More than 5 crores and up to 20 crores. They've said 0.02%. Oh, same, sir. But here they have said 50 rupees per day. I don't know what fund does government get by giving such limits. Only this 50 rupees is changed. 0.02 remains same. And if it is more than 20 crores, then no relief. It will be 0.25% of turnover or 100 rupees per day, whichever is lower. These are the limits which government has provided. Okay. Then the last discussion here is section 48, which deals with GST practitioner. And there's one information return also, but that is to be filed by various agencies. And if you don't file, obviously 100 rupees per day. There also late fees applicable, maximum 5,000. But let's talk about GST practitioner. Who can become a GST practitioner? He has to satisfy A plus B. A, there are 4 conditions. Person of sound mind, Indian citizen, not insolvent, and not convicted. These 4 preliminary conditions have to be satisfied. Indian citizen, sound mind, not insolvent, not convicted. B, there are 3, and here there is an or mentioned. So one of these can be satisfied. 1, he has a retired commercial tax officer with 2 years or more of experience. Then he is a sales tax practitioner. He was a sales tax practitioner. Sales tax practitioner were there in sales tax, or a tax return preparer with 5 years or more of experience. And last one is he is a graduate or postgraduate in commerce, law, banking, business, or has passed CA, CS, CMA final exam. Any of these met, either first one, second one or third one, then he can apply for becoming a GST practitioner. He will get a separate username and password on the GST portal, and he can provide services to the clients as they allow him to do. So he can reply to notices, he can pay tax on their behalf, he can file GST returns for them. All these functions can be carried out by the GST practitioner. Can he get his GST practitioner number cancelled? Yes, obviously that is allowed. He can make an application and get his enrollment number cancelled. Plus, the primary responsibility is always on the taxpayer, that is the client, not on the GST practitioner. And GST practitioner has to write an exam conducted by Nitin, National Academy for Customs, Indirect Tax and Narcotics. Once he passes, only then he will be given an enrollment number, username, password for the website as a GST practitioner. From returns chapter, some theory questions are asked, which is the last question of your question paper. There one theory question may be asked from GST returns chapter. Now let's talk about accounts, records and e-way bill. See, accounts and records is covered under section 35 and 36. 35 provides that accounts and records have to be maintained at the place of business. Anything which is related to a particular additional place of business should be maintained in that additional place of business. Records of all kind related to output tax, input tax, outward supply, inward supply, name of supplier, name of recipient, address, all these details have to be maintained by the taxpayer. With regard to works contract, they have to maintain separate records for each works contract separately. Agent has to maintain record for each of his principal separately. Unique enrollment number will be taken by a warehouse owner or a transporter, even if they are not registered under GST, because registration limit 10 lakh 20 lakh, but still warehouse owner and transporter are required to take a unique enrollment number for recording the transactions which are taking place through them. So warehouse owner has to maintain record of stock, while transporter has to maintain record of movement of goods. In fact, for generation of e-way bill, transportation or transporter, if he has premises in different states, he can take a common unique enrollment number which can be used across for generating e-way bills. Records can be maintained in electronic form as well. Now 36 deals with the time limit for maintaining records. 72 months from due date for annual return for that particular financial year. But if an investigation is going on, then 72 months from due date for annual return, or 1 year after final disposal of such investigation, appeal, assessment, audit, etc., whichever is later. So this is the time limit. This can be asked as MCQ, case study based MCQ, or a practical question with regard to time limit calculation in a case study based specific theory question. Variety of questions can be asked on this. Be very careful on this. Then we come to e-way bill. See, e-way bill, you have to fill in two parts, part A, part B. Once you fill in this part A, part B, you will get a e-way bill. But first, it is important to understand who is required to generate e-way bill. See, e-way bill is required to be generated whenever there is movement of goods and value is more than 50,000. They have defined value. Taxable supply is included, exempt supply is not included. GST is included for the purpose of this value. Now, it is required for supply, it is required for other than supply, and even if supplier is unregistered person and recipient is registered person, then it is deemed that recipient registered person is causing the movement, and the person who is causing the movement has to generate e-way bill. Two cases it is mandatory. One, interstate movement for job work, and second one is interstate movement of handicraft goods. In these two cases it is mandatory to generate e-way bill even if 50,000 is not touched. Then part A, you basically provide document details. It could be invoice, it could be delivery challan, because it's required for other than supply also. Part B, you fill the conveyance details, vehicle details. The moment you fill part A, which can be filled by supplier or recipient, whoever is causing movement, you can also give an authority to courier agency or transporter to do the entire exercise of e-way bill on your behalf. You can also give the authority to e-commerce operator to do the entire thing on your behalf. The moment part A is filled, you'll get a unique number which is valid for 15 days. That means once you get unique number, you have to fill in part B within 15 days. See, part B, rail, vessel and aircraft, you can fill before or after movement. But road, you have to fill before movement. You can't start the movement of goods until and unless you fill it, and you will provide the conveyance details. Railways will not deliver the goods unless at the time of delivery you produce the e-way bill. So before taking the delivery, you'll have to complete the process. Nothing else is there for aircraft and vessel. Additionally, cancellation within 24 hours is permitted. Who can cancel it? The person who has generated. Rejection, the other person can reject it within 72 hours, or delivery of goods, whichever is earlier. Now, cancellation is not permitted in case it is already verified by the officer during transit under rule 138B. So if it is verified, then you cannot cancel it. Then what is the validity? See, validity of e-way bill for every 100 kilometers you get 1 day's time, and for every additional 100 kilometers or part you get additional 1 day. That means, say suppose the distance is 2340 kilometers. Totally you will get 24 days time to deliver the goods. Is it good time limit? Yes. And you begin the validity the day you start the movement. Just before that you generate e-way bill, and that's when the validity begins. All the validities begin from midnight of the day in which it is generated. Say suppose you generate it on 24th morning. It will not start from 24th morning. It will start from end of 24th. Then your end of 25th will be 1 day. End of 26th will be 2 days, and so on. Then this 100 kilometers is replaced by 20 kilometers for over dimensional cargo. So every 20 kilometers it moves very slowly. Over dimensional cargo and multimodal transport, where one leg is ship. At least one of the modes of transportation is ship. In exceptional circumstances, within 8 hours of expiry, you can seek a extension. Normally 1 day extension will be given, breakdown etc. might happen. Sir, can I change the conveyance? Yes, obviously. If it's the same transporter, then he will only update part B. That's it. Because same transporter, only vehicle is changing. Vehicle is given in part B. You'll update part B. If it's a different transporter, then first add the new transporter. Assign the e-way bill to him, then update part B. But in all these cases, only part B is required to be updated because only conveyance details is changing. Then there are some exemptions. No need to generate e-way bill for certain cases like non-motorized conveyance. Obviously, there will not be a vehicle number. No need to generate e-way bill. Then gold, silver, precious stone, coral reef, currency, kerosene under public distribution system, LPG, empty cylinders. No need to generate e-way bill. Imitation jewelry, artificial imitation jewelry, e-way bill is required to be generated. Then any goods moved by government by rail, government or local authority moving any goods by rail. Then you have notified areas. Don't worry, nothing is notified. Then negative list and alcoholic liquor and 5 products. Again, no need to generate e-way bill for all this. Negative list, alcoholic liquor, 5 products. Then custom movements. Custom movements where the movement is caused by custom department. Like you have imported goods in Chennai, but there is an inland container depot which is there in Bangalore, where you are going to clear the goods in Bangalore. So Chennai to Bangalore movement, it is under custom control. No need to generate e-way bill. Or port to warehouse. Again, it's in the control of customs. No need to generate e-way bill. Then empty cargo containers. Then any exempt goods. Obviously, if the goods are exempt, then government has said there is no need to generate e-way bill. But should you accompany it with an invoice or delivery challan? The obvious answer is yes. Without a document, goods should never be moved from one place to another. Just be careful about this particular circumstance. Thereafter, we talk about Rule 138A, which says the person in charge has to carry something along with him, that is invoice or other documents and e-way bill. E-way bill is not required for rail, vessel, aircraft. 138B. Okay, I missed out one point. One important point here, government has clarified that if it is e-invoice, then there is no need to carry the physical copy. Electronic form is sufficient. 138B, verification of e-way bill can be done by the officer. 138C, the goods which are being transported or the conveyance, that also can be verified. Now when that is verified, be very careful. If it is checked at one custom station or one department of Karnataka, say suppose check post of Karnataka has checked it, then it cannot be checked again until and unless there is some proof that some tax evasion has happened. 138D, if the vehicle is stopped for more than 30 minutes, then a application can be filed under Rule 138D. 138E says that a person who has not filed GST returns will not be able to generate e-way bill for his outward supplies if he is not filed GSTR1 for 2 months or 2 quarters, or if he has not filed 3B for 2 months or 2 quarters. If he is a composition taxpayer and he has not filed CMP 08 for 2 quarters, or his registration is suspended. In all these cases, for your outward supply, you cannot generate e-way bill. For your inward supply, the other person can generate on you, but for your outward supply, you will not be allowed to generate e-way bill. Once system blocks you from generating e-way bill, you will not be able to carry on business. Plus, there was a press release saying that if there is a bill to ship to transaction, billing done to Mr. B, shipping done to Mr. C, how many e-way bill will be required? Law said one e-way bill, because one movement, one e-way bill will be sufficient. It can be either be generated by the supplier or the recipient, because A is the supplier, B is the recipient, goods are getting delivered to C on the direction of B. This is what has been given. From e-way bill, you can expect questions of case study based, about 4 to 5 marks case study based. Could be a validity based question, exemption based question, change in conveyance, all these types can be asked. Now let's discuss about refund under GST. See, there are two transactions where there is a formula, and there are various other cases where you can claim a refund of GST. We will discuss all these circumstances. Let's start with the most important one, that is zero rated supply. Now zero rated supply covers two transactions. One is export of goods or services, and second one is supply of goods or services to a SEZ unit or developer. These two transactions are considered as zero rated supply. Zero rated supply can be with payment of IGST, or it can be without payment of GST. So you can export it without payment of GST or with payment of GST. This without payment is called as export under LUT or bond, letter of undertaking or bond, where you undertake that if you don't export, then you will pay the tax along with applicable interest. Now, when you do with payment of IGST, whatever IGST you have paid on this transaction, this will be allowed as refund to you. But don't forget, this IGST you don't collect from your customer who is outside India, or you don't collect it from the SEZ. You pay it from your pocket and then government gives it back to you. But sir, then what is the purpose? Why do we pay? Now, this is a route to convert your ITC balance into cash. I will give you an example. Say suppose you did an export of 1 lakh rupees, the tax 18%, which comes to 18,000 rupees. Now you had a ITC balance of 15,000. You can use that ITC balance of 15,000 to pay this 18, and 3,000 you will pay in cash. Now government is going to give 18,000 to you in your bank account. Technically, you have converted ITC of 15,000 into cash. That's the purpose of doing export with payment of GST. You convert your ITC balance into cash. Obviously, it is allowed only for zero rated supply and not for every transaction. Sir, say suppose I don't want to take this risk. I don't want to pay 3,000 extra, and then if government does not give me 18,000, then my entire 18,000 is stuck. Then you have another option called as export without payment of GST. Here you don't pay GST on the export transaction or SEZ transaction, you don't pay GST. But see, you will have lot of unutilized ITC. That unutilized ITC can be claimed as refund. And there is a formula given in the law. Unutilized ITC, turnover of ZRS of goods plus turnover of ZRS of services divided by adjusted total turnover into net ITC. Now let's discuss all these terminologies. Turnover of ZRS of goods. This will be export value or 1.5 times of domestic price of like goods, whichever is lower. Either it can be what you supply in the domestic market or someone else is supplying in the domestic market, whichever is lower. Careful, this is being done because some fraudulent exporters used to inflate the export price. So say suppose you mention 180 here, but actually the product price is 100, 1.5 times comes to 150. So what will you take as ZRS turnover? ZRS turnover will be whichever is lower, that is 150. Now whatever ZRS you use at the top, same thing will become part of adjusted total turnover. That will remain same. Then the law also defined export value. Export value will be FOB value on shipping bill or invoice value, whichever is lower. Sir, this should be equal, na? No. People, sometimes the contract is of a CIF contract, meaning cost, insurance, freight. I will deliver the goods till the US port. I am in India, I will deliver it till the US port. So I will incur the cost, insurance, freight and charge a lump sum amount to my customer outside India. Now government does not want to give refund based on CIF value. Government wants to restrict the refund based on FOB value. FOB value is till the Indian port. So that's why they have said FOB value on the shipping bill or invoice value, whichever is lower. If you are billing in FOB value, then these will be almost equal. But if you are billing in CIF value, government does not want to give you the benefit till CIF. You will get the benefit only till FOB. And whatever you consider in the numerator, the same thing will be considered in denominator. Then the next one is ZRS of services. ZRS of services in simple terms is service provided and foreign exchange received, whichever is later. So once both the things are completed, you have provided the service plus you have received the payment as well. In that month, quarter, half year or year, in that period, it will be considered as ZRS turnover. Sir, what is the frequency of applying for refund? You can apply for refund on a monthly basis, quarterly basis, half yearly basis, annual basis. Anything is allowed, but it should be within the time limit. Time limit is 2 years from the relevant date. I will discuss what is relevant date. 2 years is the time limit. Within that, if you are applying, any frequency is allowed. So whatever is the frequency, based on that you have to check whether the service was also provided and the payment is also received. If both the things are completed, the period in which both the things are completed, that's when you regard it as a export transaction for this numerator. Adjusted total turnover will include all types of turnover. ZRS with payment, without payment, domestic transactions, everything will be covered. But it does not include exempt supply. Be very careful, people. Adjusted total turnover does not include exempt supply. But sir, what if exempt supply is exported? If exempt supply is exported, then it becomes part of ZRS. Then it will become part of adjusted total turnover as well. This is only pure exempt supplies which are not export. So domestic exempt supply will not be considered in adjusted total turnover. Don't make this mistake. This is the most common mistake. Then net ITC is only ITC availed on input and input services. Why sir? Capital goods you don't get refund? No. Unutilized ITC you don't get refund of tax paid on capital goods. If you want to claim a refund of tax paid on capital goods in unutilized ITC, then you have to go for export with payment of GST. There you can use entire ITC and then you can claim a refund. That's one route which is available to you. But if you want to go for unutilized ITC, only input and input services. Plus some notifications covered under rule 89.4a and 89.4b, where you have already claimed some other benefit under those notifications, then that particular supply is excluded from ZRS of goods, is excluded from adjusted total turnover, is excluded from net ITC. The example for this will be deemed export and merchant export transactions. So deemed export, you can claim a separate refund there. So if you are claiming deemed export refund there, don't include it here. Merchant export is where you can purchase at a lower rate. Again, that is a very low rate. You can't claim benefit of that lower rate as well as this refund provision. The government wants to restrict it. The moment you find 89.4a, 4b, you exclude it from ZRS of goods, adjusted total turnover and net ITC. Now, when do you regard something as export of goods? Something is regarded as export of goods when the goods are taken outside India. The moment you take the goods outside India, it's regarded as export of goods. When is something regarded as export of service? Careful. Something is regarded as export of service only when some conditions are satisfied. First, supplier is in India. Wonderful. Second, recipient is outside India. Then third, place of supply is outside India. Fourth, foreign exchange or INR permitted by RBI is received. Because in some cases like Nepal and Bhutan transactions, government allows receipt in INR. Last one, not merely establishment of the same person. It should not be branches of the same person. I'll give you an example. There is an Indian branch of a company. There is a US branch of a company. Branch are not separate companies. Branch. Indian branch, US branch. This will never be regarded as export because it should not be merely establishment of the same person. But sir, what if there is an Indian holding company and US subsidiary company? Then will it be regarded as export? The answer is yes. Sir, but first transaction, will you levy tax? No, government has given an exemption for the first transaction in the exemption chapter. So this is exemption and this is export. Which is better? Obviously export is better because you will start getting refund of tax paid on purchase. Exemption, at least you don't have to pay tax on output, but you will not get corresponding input as well. So if it is branch, exempt. If it is different companies, separate legal entities, then in that case it will be regarded as a export transaction. Okay, this was about zero rated supply. The second case where you can claim a refund is inverted tax structure. Now, what is inverted tax structure? Inverted tax structure is a case where your output is subject to a lower rate, your input is subject to a higher rate. Raw material 18% and finished goods 5%. Now what will happen because of this? There will be a lot of accumulation of ITC, that is, there will be a lot of unutilized ITC. Now what can we do with this unutilized ITC? Government says I will give you a refund, but be very careful. Even if there is inverted tax structure, government has an option that they will say I will not give you a refund. That option is also available with government. They can say that for some transactions where I don't want to give refund, I will notify them. That's a special power available to government. Plus here law is giving refund only on inputs, not even input services. Let's see the formula. Turnover under ITS inverted tax structure divided by adjusted total turnover into net ITC on inputs. Careful, not even input services. So minus tax payable under ITS into net ITC on inputs divided by total ITC on input and input services. This is the formula. Looks very big, but technically it is only ITC minus output. Proportionate ITC minus proportionate output. Let me show it to you. See, you are doing proportionate of ITC. That is ITC attributable to inverted tax structure. ITC into turnover of ITS divided by adjusted total turnover. Technically, you are applying proportionate ITC, which is relatable to inverted tax structure. And here you are doing proportionate output. How are you doing proportionate output? Tax which is payable under inverted tax structure, which is output, and that output you would have paid some amount through inputs, some amount through input services. So we are doing a proportionate there. Net ITC of inputs divided by total ITC on input and input services. So you are doing proportionate ITC minus proportionate output. Careful with regard to this. Plus, these two cases are the cases where you can claim refund of unutilized ITC. Now, unutilized ITC refund, whenever you are claiming, these are the formulas of maximum refund. This maximum refund is always subject to e-credit ledger balance. If you don't have balance in e-credit ledger, then you cannot claim these refunds, because obviously you are actually converting ITC into cash. So if you have very good domestic sales, or you have some other products which have high output rate and less input rate, then you will be able to use your input tax credit completely. There will not be any unutilized ITC. Then you cannot claim refund based on these formulas. So e-credit balance is always to be checked. Now e-credit balance is checked on two dates. One, e-credit balance at the end of tax period for which you are filing refund, and e-credit balance as on the date of filing of refund application. On these two dates you check. So technically you compare three things: formula, e-credit balance formula, then e-credit balance at the end of the tax period, e-credit balance at the time of filing refund application, whichever is lower. This is what is eligible as refund to you. Okay, now coming to the third case of refund, which is deemed exports. See, there are 4 transactions which are regarded as deemed exports. First, supply to EOU. Sir, but what is deemed export? The goods are manufactured in India, but they are not physically exported outside India. You are selling to someone who normally exports. One is supplied to EOU, export oriented units, because export oriented units are required to majority export their goods. That's why if you supply to EOU, government has said it's a deemed export. Supply to a person having advance authorization license. A person who is having advance authorization license, trust me, he is so powerful, he can import inputs without payment of custom duty. So if he buys from domestic market, he will get the benefit of deemed export. Then EPCG license under FTP, export promotion capital goods. If he is having a EPCG license, he can import capital goods without payment of custom duty. Here you can import inputs without payment of custom duty. Here you can import capital goods without payment of custom duty. So if you purchase these things from domestic market, deemed exports. Then gold by PSU or banks is also regarded as deemed export if it is against advance authorization. Now sir, tell us the benefit. See, these are the 4 recipients. If you supply to them, it's a deemed export. Now this is always with GST, but anyone can claim refund. Either the supplier can claim refund or the recipient can claim refund. If supplier has borne the tax, that means he did not collect it from the recipient, then supplier can claim refund. If recipient has borne the tax, then in that case recipient can claim refund. So whoever has borne the tax, he can claim refund. Now remember, if the supplier is claiming refund here, then in that case this turnover will not be considered in adjusted total turnover, and any ITC related to this transaction will not be considered as net ITC. Reason? You are claiming refund under deemed export. This is one of the exclusions under 89.4a and 89.4b. So, but if recipient is claiming refund, then don't exclude it, because then this is a normal taxable supply for the supplier, na? And turnover is always from the angle of supplier, not from the angle of the recipient. Okay. Then the 4th transaction is merchant export. What is merchant export, sir? See, merchant exporter is a person who is registered with Export Promotion Council. He can purchase at 0.1%, very low rate, and he is basically going to export it. Sir, exporter can anyways claim refund, na? Now, merchant export benefit is given so that merchant exporter can concentrate on exports and not run behind GST department. So if there is a supplier, that supplier will supply to merchant exporter at 0.1%, but supplier on his purchases would have paid 18%. So supplier can claim a refund under inverted tax structure. Merchant exporter will not have to run behind GST department. As he does not pay much tax on his purchase, this export is allowed only without payment of GST. He cannot do with payment of GST. Only without payment of GST is allowed. Plus, this 0.1% ITC is available, but this 0.1% you will not get refund. So you will have to use this 0.1% only against your output tax. You can't claim a refund. So this 0.1% is also excluded in net ITC when you check the export formula. Plus, this export will not be considered in ZRS. It will not be considered in adjusted total turnover because you are already claiming a benefit in the notification of getting the goods at 0.1%. There are some conditions to be followed, like merchant exporter, obviously only for goods. He has to mention both the names of supplier and his name in the export. Then shipping bill, once he files it, a copy has to be given to the supplier as well, to the jurisdictional officer. These compliance are required to be done by the merchant exporter, plus supplier also has to keep sufficient documentation because he has supplied at very low rate of 1.1%. 0.1% is 0.05% CGST and 0.05% SGST, which is very low. Okay. Then any balance in e-cash ledger is also eligible for refund. In fact, no time limit applicable. You can claim anytime. 2 years time limit is not applicable for balance in eCash ledger. And sometimes the accumulation in eCash ledger will happen because of TDS and TCS. TDS which is made by government department and TCS which is made by e-commerce operator. So that might accumulate. Can you claim a refund of that? Yes, that's a balance in eCash ledger. Anytime you can claim a refund without any time limit. Then refund voucher. If you have issued a refund voucher, that is you have refunded the advance paid by customer and you have refunded the tax also to him, then you can submit this refund voucher and details and claim a refund of the tax which you have already refunded to the customer. Then wrong place of supply. What is this wrong place of supply, sir? Say suppose you paid C plus S instead of I because of wrong place of supply. Now you have to pay I and you can claim a refund of C plus S. So this C plus S will be allowed as refund to you. Now the question is, here also 2 years applies. 2 years will start from the date of payment of wrong tax or date of payment of correct tax. CBIC has clarified that 2 years will start from the date of payment of correct tax. This is very good for us because later if department says I will pay the correct tax and then claim a refund of that tax. Then UN or embassy. UN and embassy, anything which they are purchasing, they can claim a refund of that particular tax. Now UN or embassy get 2 years time limit from the end of the quarter in which the goods or services were received. So if they have purchased between Jan to March, then in that case they can claim refund from end of 31st March and 2 years from there will be counted. So good time limit is allowed for UN or embassy. Then tourist. Tourist, this is not operational, but let me tell you, to a tourist you will always charge IGST. And this tourist, whatever goods he is taking outside India, he can claim a refund because consumption of these goods which he is going to take outside India will be outside India. So he can claim a refund at the international airport, but it is not yet operationalized. Law has it, but not operationalized as on date. Then provisional assessment. What is provisional assessment, sir? Say suppose I was confused with the GST rate which will be applicable. I was confused whether 18% will be applicable or 5% will be applicable. So I went to the GST department. And GST department told me that now you pay 18%, then we will analyze the transaction and thereafter if we feel that lower rate will be applicable, then we'll give you the benefit. So I started paying 18%. Then the department concluded that only 5% is payable. Can I claim a refund? The answer is yes, I can claim a refund provided I have borne the taxes. If I have borne the taxes, then in that case I can claim a refund. Is it, sir? Yes. Because any refund case is always subject to unjust enrichment. I cannot enrich myself at the cost of other person. If I have borne the tax, only then I can claim a refund. Now, any excess payment of tax which is made by any person, can he claim a refund? Yes. 2 years from the date of payment of such tax. Provisional assessment, 2 years from the date of adjustment of final assessment. During final assessment the adjustment will be done from there. UN or embassy, end of the quarter. Wrong place of supply, 2 years from correct tax. Refund voucher, 2 years from the date of payment of tax. E-cash, 2 years does not apply. Deemed export, 2 years from the date of filing return for that particular tax period. Inverted tax structure, 2 years from the due date for filing return for that particular tax period. ZRS, if it is services, that invoice or payment whichever is later, and if it is goods, then when it is dispatched, that is when it goes outside India. And if it is unutilized ITC, then same 2 years from the due date for filing GST return under section 39, and due date for return 20th of the next month for that tax period. So these are the time limits which are applicable. If you don't get your refund on time within 60 days, then you will be eligible for interest. How much interest? Interest of 6% per annum after the expiry of 60 days till the date when I get the refund. And if it is through a judgment, then interest will increase to 9% per annum. Plus there are some documentations which are required to be maintained, like for export you'll have to share the shipping bill, inverted tax structure, purchase and sale invoices, deemed export, transaction of sale invoice, merchant export, inverted tax structure, e-cash ledger, nothing, refund voucher, those refund vouchers and details, wrong place of supply, both the documents, UN or embassy, purchase invoices, tourist, purchase invoices, provisional assessment, final assessment order, excess tax, obviously yes. There could also be a case where the matter was under litigation and you won a case, and when you win a case, the judgment order will say that you are eligible for refund. That also you can claim a refund. 2 years here will start from the date of such judgment. Okay, then you have rule 96, 96A, 96B. Rule 96 deals with export with payment of IGST. And with payment of IGST, let me tell you, the moment you file the shipping bill, then you file your GSTR 1 and 3B, the GST system and custom system will coordinate and you will be getting your refund of the IGST which you have paid directly to your bank account from the custom department. But this is only for goods. You don't have to go to the department. Direct refund. Wonderful, sir. But if it is service with payment of GST, you will have to go to the department to claim a refund of that. Rule 96A deals with without payment of GST. Now this is under LUT, letter of undertaking or bond. What undertaking do you give? For goods, you give an undertaking saying that if I don't export within 3 months from date of invoice, then after this date within 15 days I will pay tax plus interest. This is the declaration which you give. And for services, you give a declaration that if I don't receive foreign exchange within 1 year from date of invoice, then after this date within 15 days I will pay tax and interest. This is the declaration which is given under letter of undertaking. Export of goods, 3 months you should export it, and export of services within 1 year you should receive foreign exchange. Then rule 96B deals with goods if no forex is received. Because let me tell you, for goods there is no precondition that you should receive foreign exchange, then only you can apply for refund. In export of goods you can apply for refund, then you can receive foreign exchange. But for services, you have to receive foreign exchange, then only you can apply for refund. Goods, if you don't receive foreign exchange, then in that case, and what is the time limit, sir? FEMA, Foreign Exchange Management Act. If you don't receive the foreign exchange within FEMA, then you have to return the refund amount along with interest. Obviously, if you have received proportionate, then you will do only proportionate reversal. Plus, later on, with the approval of RBI and within their time limit, if you get the foreign exchange, then you can again claim the refund, but you will not get this interest which you have paid. So be careful with regard to this particular point. Can be asked as a case study based question. Okay. Then the final point, which is a very new point, can an unregistered person claim refund? Yes, law has permitted. There will be a facility on the GST portal where unregistered person can also claim refund of tax which he has excess paid. Let me tell you why this need arose. Say suppose there is a builder who is supplying service of construction to an unregistered person who is the customer. Now, what happens? Customer will keep paying with GST. Say suppose due to some dispute or issue, builder is not able to deliver the house. Customer goes to the court and asks for a refund. Builder will refund only 100 rupees. Why not this 5 rupees, sir? Because builder would have already paid GST to government. Sir, he can take back from government now. He can take back from government only by issuing a credit note. But credit note, there is a last date, 30th November after the financial year or date of filing annual return. So credit note cannot be issued. So builder cannot get back GST from government. So he cannot give it back to customer. Can customer go to government? The answer is yes. Customer can file a refund application and take 5 rupees from government. This was the need, and that's why a provision has been added that unregistered person, when the contract comes to an end and the supply was not done, he can claim a refund. But he has to take a certificate from the builder. Agreement has to be presented. Builder should say that he will not raise a credit note, he will not claim a refund, and the contract has come to an end. Plus, whatever amount is being refunded, based on that only, the refund will be eligible to the unregistered person, that is the customer. Okay. This can happen in insurance policies also, where insurance company has issued a policy to customer and later on customer does not want to take it or there is some dispute. Then customer would have paid with GST, but insurance company has given only value. Can customer go to government and get GST? The answer is yes. Now unregistered persons have an option to claim refund. A very important provision from examination point of view. A 5-mark case study question can be asked. Practice some practical questions on ZRS and inverted tax structure. Be strong with unregistered person theory questions.
In this video, we are going to revise job work. Now, this is one topic where most of us have lot of confusions regarding some critical points. Otherwise, the concept is very simple. Principal, sending the goods to the job worker. Principal will not charge GST. Job worker thereafter will process the goods, and once job worker processes the goods, he will send it back to the principal, or it might be exported from the job worker's premise or supply made from job worker's premise. The law also provides that you should receive back the inputs within 1 year. Capital goods you should receive back within 3 years. If you don't receive back within that time, then it is regarded as a deemed supply. समझ में आया? This we already know. This is already given. Now let's try to understand the entire picture of job work, and let's also try to see various possibilities in this. Now, see this. Go by these steps. First, principal, being a registered person, has to be a registered person. He makes some purchases. Can he claim ITC? The answer is yes, no problem in that. Okay. Now, principal is sending the goods, not supplying the goods, sending the goods to the job worker. In that case, is there GST applicable? The answer is no GST applicable, as there is no supply. Correct? Okay. Is he required to reverse ITC on his purchases? The answer is no. Principal is not required to reverse any ITC. Now, job worker processes it. Once job worker completes the processing, he can send it back to the principal. Say suppose he sends back to the principal. Will GST be applicable? The answer is no GST applicable. It could be transferred to another job worker. Will GST apply? The answer is GST will not apply. It could also be sold from the job worker's premise. Who is selling this? Principal, because the goods belong to the principal. So if principal is selling these goods from the job worker's premise, in such cases GST will be applicable. Principal has to charge GST to customer. Principal will raise the invoice. Okay. And if principal exports the goods from the job worker's premise, then obviously with payment, without payment, that has to be done. Now, whenever he does a transaction of sale or export from job worker's premise, principal has to declare it as additional place of business. Whenever the principal does a sale or export from the job worker's premise, he has to declare it as additional place of business. But this requirement is not there where job worker is registered. If the job worker is registered, then I am not required to declare it as additional place of business. Okay, sir. What about waste clearance? Point number 5. Waste clearance. See, job worker has to pay GST on the waste if he is registered. If he is unregistered, then principal has to pay GST on this waste clearance. If waste is destroyed, then obviously GST will not apply. And finally, what is the time limit for receiving back input and capital goods? For input, it is 1 year. For capital goods, it is 3 years. Can you take an extension? The answer is yes. For additional 1 year in case of inputs and additional 2 years in case of capital goods, this is what is permissible. Now let's discuss some very important aspects relating to job work. See this very carefully. What is included in job worker's turnover? This is where you can get MCQs. What is included in job worker's turnover? Whatever he charges as job work charges, will it be included? The answer is obviously yes. What about sale of goods from his premise? Sale of goods from his premise is not his turnover. Export of goods from his premise is not his turnover. What he sends back to the principal, sorry, it's not his turnover. So only job work charges, it might include any material which is used, that will be included in his turnover for the purpose of aggregate turnover computation. Okay. Now, what happens in case principal makes a supply from job worker's premise? See this, try to cover all the possible cases. See this very carefully. Principal is making a sale from job worker's premise. Say suppose job worker is registered. Tell me, if job worker is registered, is principal required to register it as additional place of business or take registration in job worker's premise? The answer is no. If job worker is registered, the provision is very simple. If job worker is registered, in that case, sale is made by the principal and everything will be based on principal. Principal will issue the invoice. Principal will decide the place of supply. Principal will decide the type of tax. In such cases where job worker is registered, tell me, if the sale is made by principal, what is the location of the supplier? The supplier's location will be Bangalore. That is place of supply of the Bangalore. The location of the principal, registered place of the principal. What is the place of supply? If he is selling to a customer in Delhi, in such cases, the place of supply will be Delhi, and what would be charged by the principal? IGST. Who would raise the invoice, people? Invoice will be raised by the principal. Time of supply will be based on principal. Place of supply will be based on principal sending the goods. Clear with this? This is a simple transaction. Now let's see if job worker is unregistered. See this very carefully. Say suppose job worker is unregistered. In such cases, if both are in same state, principal and job worker are in the same state, then things are simple. Principal will add that job worker's premise as additional place of business, transaction closed. Correct? If principal and job worker are in different state, in that case, see what is the problem. See, job worker is unregistered. I am making a sale from this premise, which is not a registered premise. What is the option available to me? Principal will have to take registration from Delhi. Bangalore premise will invoice Delhi premise. There will be a stock transfer because now principal is registered in Delhi. And then principal's Delhi premise will sell it to Delhi customer. This is the step to be followed. Sir, this is complicated for the principal. Why will he register in Delhi? In such cases, please don't supply from an unregistered job worker's premise, which is outside the state. Again, don't supply it from an unregistered job worker's premise, because if you supply from an unregistered job worker's premise, you will have to take registration in that state. First, you'll have to do a stock transfer from Bangalore to Delhi, and thereafter Delhi to Delhi's customer. Hey, did you understand this? Yes. So this complication arises only when two conditions are met. One, job worker is unregistered and both are in different states. If job worker is registered, then this problem does not arise. Clear with this? Yes. And then there are miscellaneous points which you would have read it multiple times. Be very careful about this entire structure. One is this structure. Yes. And the second one is this structure. We are going to discuss search, seizure, and liability to pay in certain cases. See, when we talk about search provisions, the basic power which is available to the proper officer with the approval of Joint Commissioner, he can search a premise if there is a reason to believe. Very strong word, not suspicion, reason to believe. He should have evidences that the person has evaded tax. Only in that case, the business premise or any other premise can be searched. Search has huge ramifications to any particular person, and that's why there is this restriction that it has to be done only when there is a reason to believe. Say suppose other than search, are there other alternatives? See, section 67 deals with search provisions. It is also possible that a search can be conducted while the goods are in transit. That is section 68, which requires carrying e-way bill, and then the search in transit provision is covered by section 129. See, 129 we will be discussing in offences and penalties, where a penalty can be charged in case search is done during transit. But can you also call persons to give evidences? Yes, that is a power to summon which comes from section 70, gives the power to summon. Thereafter you have section 71 where department can get access to a business premise and thereafter call for documents. That's also a power which is available. Now what happens after search? The goods are seized, documents are seized. Now when these are seized, a seizure order will be issued, and this seizure order is non-appealable. A person cannot file an appeal against the seizure order to the appellate authority. Thereafter the show cause notice is issued. The time limit to issue show cause notice in case of search, seizure, etc. is 6 months plus another extension of 6 months. If it is not issued within the 6 months plus 6 months, in that case, the goods have to be returned unconditionally. Sir, say suppose I want the goods tomorrow only, then either you can pay tax interest penalty or you can also give a bond, and when bond is given, the goods will be provisionally released to you. Otherwise, if they don't issue within 1 year, in that case, you will get the goods back. And once they issue a show cause notice, if any document is not relied upon by them, that has to be returned within 30 days. कुछ documents ऐसे होते हैं जो काम नहीं आए उनको for the show cause notice, that has to be returned within 30 days. Plus, can I take the copies of the documents which have been seized by them? The answer is obvious. Yes, it is completely permitted. After issuance of show cause notice, reply, personal hearing, and then an order will be passed. they can also pass an order confiscating the goods. In case there is a case where tax evasion was with an intent to evade tax and defraud the government. In such cases, confiscation is also possible. But can you also provisionally get the goods released? Yes. You can either pay tax interest or penalty, and then otherwise you can also give a bond. Both the provisions are permitted. So this is the ambit of search and seizure. What's the difference between seizure and confiscation? Seizure they have the possession of the goods, but ownership is still with you. But in confiscation, government takes over the ownership. Government becomes the owner of such goods. This is about search and seizure. Then there is a topic called as liability to pay in certain cases. This is governed by section 85 to section 94. Now this section 85 to 94 deals with liability in certain cases. What does it deal with? See, if I were to tell you in short, liability in certain cases is government is trying to get money from one of the parties involved in that. And everywhere in this, you'll find jointly and severally liable. For example, say suppose there is a sale of business. A has sold business to B. Ab business bech diya. After that, if any fraud happens, B will be responsible. But what about the fraud which has already happened? Before the sale, if there is a fraud which has happened, in that case, who will be responsible? The government says A and B will be jointly and severally liable. That means government A से भी पैसे recover कर सकता है, government B से भी पैसे recover कर सकता है. This is a power which is given to government by section 85, which says both will be jointly and severally liable. Now thereafter, the law also provides that if there is a principal and agent transaction, both will be jointly and severally liable. If there is a partner of a partnership firm, all partners are jointly and severally liable. Directors, if it's a private limited company, then jointly and severally liable if they were involved in that offense. If there is a public limited company, then no, they are not jointly and severally liable. Plus, government also provides a relief that private limited company converted into public limited, still those directors will not be jointly and severally liable. Thereafter, in case of a minor and his guardian, both minor and guardian will be jointly and severally liable. This is also given in the law. Sir, can we recover money from minor? The law is so harsh here. It says minor will be considered as if he is a major, and a lunatic or a person who is a drunkard, he will be considered as if he is not a lunatic or drunkard. So the law is very, very harsh here, where government tries to recover money from some or the other person. And what about a retiring partner? Retiring partner will be liable for any dues whether or not determined as on the date of retirement. Till the date of retirement, any dues which are pending, that retiring partner will be jointly and severally liable. Whether determined or not determined, he will be liable. Okay. Sir, what about dues after he retires? Dues after he retires, he is not liable, provided he or the firm has informed the department saying that this person has retired. Once it is informed to department, thereafter there would not be any kind of issue. Clear with this? Yes. Okay. So retiring partner has to inform within 30 days. If he does not inform, then till the date he informs, he will be jointly and severally liable. Now what happens in case of a dissolution? In case of a dissolution will always be subject to insolvency and bankruptcy call. Government cannot recover money from everyone, even when insolvency and bankruptcy code has some rules. So IBC will be preferred whenever government wants to recover any GST which is pending. Clear? In case there is any insolvency proceeding going against them, first IBC will be given preference and only then recovery will happen. But if it's a discontinued business, like it's not a case of dissolution, it's not a case of closure, it's just A simple case where everyone was solvent and then it is closed. Still, even in such cases, jointly and severally liable clause would be applicable on the partners, on the karta, on the other members of the HUF, on the trustee, on the minor, on the guardian, on the directors who are involved in it. Clear with this? The government has kept it as wide as possible so that government can recover tax dues from at least someone. Yes, so this was about liability in certain cases, jointly and severally liable. See you all in the next video. In this video, we are going to learn about assessment in case of customs. See, when we talk about assessment in case of customs, the term assessment means to determine. Now, this term assessment has been widened. It includes determination of value, determination of any classification, determination of origin, determination of any other factor which affects the custom duty payable. They have widened the scope so that assessment has much wider scope when the proper office is assessing the duty or you self-assess the duty. Now, Section 17 of Customs Act 1962 deals with self-assessment. Self-assessment, I as an importer file a bill of entry for home consumption, it is assessed. At present, government is also moving towards faceless assessment where the assessment of that particular bill of entry can be done by any officer who is in any other place, not just at that particular custom port or airport. Now, it would all be done online. He would send you a query online, you would reply to it online, and he would pass a order online, which is order for clearance for home consumption. Say suppose he finds there is a short payment. If there is a short payment, in case he will intimate that short payment. If you agree, then you will pay that short payment amount and close the matter. If you don't agree, he will pass a speaking order. Plus, a new section has been introduced where custom officers also have the power to carry out any audit. That's a particular provision which can be exercised in any case. So the powers of audit are much wider at present. Thereafter, you have a very important discussion of section 18 that deals with provisional assessment. Now, when we talk about provisional assessment, see what is the basic purpose of provisional assessment. When I am unable to determine the custom duty payable, I will go for provisional assessment. This is the normal rule. So under GST, when I am unable to determine my GST payable, I go for provisional assessment. But under customs, I as an importer can go for provisional assessment, or officer can also provisionally assess the custom duty payable. There are 4 cases where officer can provisionally assess custom duty. And say suppose I want to clear for home consumption, then I will clear the goods for home consumption after paying that provisional assessment duty. And if a bond is required, then that bond will also be given. Say suppose I want to store the goods in the warehouse, then I have to file into bond bill of entry based on the provisionally assessed duty along with twice the duty amount as bond. Here the provision still deals with twice the duty amount under section 18. Then what would happen? Then I would submit all the documents to the proper officer. There is a time limit for that and proper officer has to pass an order. There is a time limit for that as well. Now once final assessment happens, see there can be 2 cases. 1, I have short paid duty. Second, I have excess paid duty. If I have short paid duty, such cases, I will have to pay the duty along with 15% per annum interest from the first day of the month in which provisional assessment was done. Be very careful in this. Lot of times it's asked in the exam. First day of the month in which the provisional assessment was done. But when it comes to refund, I will get 6% per annum after the expiry of 3 months from the date of final assessment. After that, if there is still delay, then I will get interest at 6% per annum. If the goods are still in the warehouse, then what would happen? If the goods are still in the warehouse, then say suppose I have short assessed. In that case, I will have to give more bond If there was an excess bond already given, then nothing is mentioned in the provision, then that bond will continue as it is. Now let's see the timelines and let's see the cases where officer can go for provisional assessment. See this very carefully. Now, firstly, we will see the cases where provisional assessment can be done. The first case, when you see GST, for GST it's only one case, whenever I am unable to determine my GST payable. But in case of customs, first case is where importer is unable to determine custom duty payable, and then you have proper officer. Proper officer can also go for provisional assessment. First, when he thinks a chemical or other test is necessary, or he thinks a further inquiry is to be made even when I have produced the documents, or a case where I have not produced the documents and he feels a further inquiry has to be carried out. So these are the cases where provisional assessment can be done. 4. I myself go for provisional assessment. Second, proper officer can go in case he thinks a chemical or other test is required. Third, further inquiry where documents are produced. Further inquiry where documents are not produced by me. And if I were to clear the goods for home consumption, in that case I will pay the custom duty and give a bond as required by proper officer. If I were to store the goods in the warehouse, then bond twice the duty amount. And how does the process look? Be very careful about the process. This is new process. Custom rules have been notified for this finalization of provisional assessment rules. What is the process? Proper officer will intimate me within 15 days saying that these are the documents which he requires. This is step 1. Second, importer has to submit all the documents within 1 month, plus one extension of 3 months, plus one more extension of 3 months. And what is the time limit for proper officer to pass the order? The time limit for proper officer to pass the order is 2 months plus one extension of 3 months. So from the day the time limit for submitting the documents expires, or I have submitted all the documents, from that time the time for proper officer starts. And for the proper officer, the time limit is 2 months plus an extension of 3 months is also permitted. Clear? This will quicken the process. In GST, what is the time limit? In GST, the time limit is 6 months plus 6 months plus another extension of 4 years. Total comes to 5 years. Clear with this process? Okay. Going to the last segment, final assessment order. See, if I have already cleared the goods for home consumption and I have made a excess payment, in such cases I am eligible for refund at interest 6% per annum after 3 months from the date of final assessment. Be very careful. Everywhere the law uses 3 months from the date of receipt of refund application. But here 3 months is from the date of final assessment. Okay. If there is a short payment made by me, in such cases, I have to pay the difference amount along with interest at 15% per annum from the first day of the month in which provisional assessment was made. If the goods are still in warehouse, if I have given an excess bond, nothing is mentioned. If bond amount falls short, then I have to give bond twice the duty amount. Are you clear with this? Yes. So these were the cases. Then we moved on to what happens in such cases. Thereafter a process, and finally what happens once final assessment order is given. Yes. Clear with this? A very important discussion. See this entire chart once before your examination. In this video, we are going to discuss and revise adjudication. Now, all of us understand that entire GST is based on self-assessment. When we say it is based on self-assessment, obviously there is a requirement that department has a control over self-assessment to check whether there is any non-payment of taxes. For that, government has given them power under section 73 and section 74. Now what do these two sections represent? Section 73 provides for issuing a notice, that is show cause notice, and a demand order under section 73, which is for other than FMS. FMS, fraud, willful misstatement, suppression of facts. If it's a case of other than fraud, willful misstatement or suppression of facts, a notice and demand order will be issued under section 73. For section 74, again deals with show cause notice and demand order in case of a fraud, willful misstatement or suppression of facts. Now, when we talk about these two sections, you should be very careful about one very important point. There are only 5 cases for which notice can be issued. 1. Non-payment of tax. 2nd. Short payment of tax. 3rd. Wrong availment of ITC. 4th. Wrong utilization of ITC. And the last one is erroneous refund. What's the meaning of erroneous refund? Where a person has taken refund where he was not eligible for such refund. Now, there's a time limit. Government cannot come back to me after 10 years saying that you did not pay tax at that point of time. So there's a time limit which is mentioned in the law. What is the time limit for issuing notice? See, whenever we talk about time limit, there is a time limit for issuing show cause notice. There's a time limit for issuance of demand order. In case of other than fraud, this limit is 2 years and 9 months. And for demand order, the time limit is 3 years. By this time, demand order or show cause notice has to be issued. This is the last date for issuing notice, last date for issuing a demand order. For fraud cases, this is 4 years and 6 months. And demand order, the total time is 5 years. You know what's the most important thing in this? From where does all these time limits start? That's the most important thing. All these time limits start from the due date for filing annual return for a financial year. That means, say suppose there is a transaction of fraud in August 2020. If there is a fraud in August 2020, पहले financial year find करो. What is the financial year? 2020-21. Now when I say 2020-21 is the financial year, what is the due date for filing annual return? The due date for filing annual return would be 31st December 2021. From that 31st December 2021, you will start counting this. Be very careful. These timelines don't start when the fraud was done, when the short payment was done. It does not start from the end of financial year. It starts from due date for filing annual return for such financial year. From there you will start counting. Clear? Okay. In case of erroneous refund, these time limits are calculated from the day when we receive such erroneous refund. Such refund, excess refund which we have received, from that day this time limit begins. Clear with this? Yes. Now what is the adjudication process? See, adjudication process starts with issue of notice, goes to notice has to be served. Then the next step is we reply to that notice. Thereafter there would be a personal hearing, and finally an order is passed. See, time limit is given for these two things, order and issuance. That means all the other processes should be completed within that time. So there is a time limit or last date to issue notice, last date to issue order. Remember, these are last date to issue orders or notices. That means, say suppose a fraud is done in August. Can a notice be issued in August? Yes, obviously. Can order be passed in October? The answer is yes. After giving an opportunity, order can be passed. So please understand, these are last date for passing the order or issuance of notice. Now, here government has fixed limits for superintendent, ACDC, that is Assistant Commissioner, Deputy Commissioner, and Additional Commissioner, Joint Commissioner. These are the 3 adjudicators. Adjudicators matlab any decision will be passed by these 3. Superintendent, ACDC, additional commissioner, joint commissioner. How much power is available? If it's a matter of CGST, then up to 10 lakh rupees. If it's a matter of IGST or a combination of CGST plus IGST or C plus S, in that case, this will be 20 lakh. So to this extent, superintendent can go with an order. Tax amount. We are only talking about tax amount. ACDC, it's from 10 lakh, above 10 lakh to 1 crore. For IGST, double, 20 lakh to 2 crore. And more than 1 crore or more than 2 crore in IGST, that is done by additional commissioner, joint commissioner. Remember, commissioner does not adjudicate. Adjudication is done by these three officers. Now, one more very interesting question which arises is, how do you serve a notice? How do you serve a notice? See, notice can be served by hand delivery, which is tendering. Notice can also be served through email. Notice can also be served through registered post or authorized courier agencies with acknowledgement due. It can also be served on the common portal, that is gst.gov.in. If these are not possible, publication of newspaper is also permitted. Now, if these are not practical, then fix it on the premise of the registered person where his last address was there. If there is no premise at all, in such cases, government says, put it in the notice board of the proper officer, that is considered as service. But this cannot be used as the first mode, never. Only when other things are not permissible, you can go by this particular mode. And what is that mode? That mode is fixing on the notice board of proper officer. This is the last resort. Okay. Now, say suppose there was a notice issued for 1819. 1819 के लिए एक notice issue हुआ. ठीक है? Show cause notice issue हुआ. उसके बाद 1920 same matter continues. Officer has two options. One, he can issue a fresh show cause notice, or he can also issue a statement providing information that it's a same matter. So same matter के लिए officer can issue a statement, and that statement would be regarded as a valid notice. So this is an option which is available to officers. Clear with this? Yes. Now, there are a lot of instances where section 74 notice is issued, meaning fraud notice is issued, but thereafter it is held by the court that it was not a notice under fraud. There was no fraud which was done. In such cases, department cannot issue a new notice under 73 now because time limit would be already over. Government has provided a solution to this. What does the law say? The law says if notice under 74 is held to be invalid, that means there is no fraud by a court. If it is held by a court that it is invalid, in such cases, it would be deemed that the notice was issued under other than fraud, that is section 73. So, if a notice of 74 is held to be invalid because of no fraud, in such cases, it would be deemed that the notice was issued under 73. So that at least government gets revenue for last 3 years. Otherwise, for fraud cases, they can recover from last 5 years. Clear with this? Yes. Yes. Because most of these are continuing matters. When I say continuing matters, that same issue would continue for 18, 19, 19, 20, 20, 21. Business continues and issues remain same mostly. Okay. Then, say suppose notice is stayed by a court. If notice is stayed by a court, then in that case, the period of stay would be excluded for computing all these limits. Done? Okay. Government also gives some discount schemes. Yes, there are some discount schemes available depending on whether it's a case of other than fraud or it's a case of FMS. There are some discount schemes. But discount is not in tax. Discount is not in interest. Discount is only in penalty. Okay. Let me first tell you what is the maximum penalty. See, the maximum penalty which can be charged in case of other than FMS is 10% of tax or 10,000, whichever is higher. This is the maximum penalty which can be charged for other than FMS. Now for FMS, this is 100% of the tax. This is the maximum penalty which can be charged. Correct? Clear with this? Okay. Now government is giving some discount in penalty. Don't forget that discount is only given by government on penalty, so that you can close the proceedings before it reaches court and expenditure has to be incurred. Now, say suppose a person pays entire amount of tax, interest and applicable penalty before the show cause notice. Before the issuance of show cause notice, the person has paid tax, interest and applicable penalty if any. In such cases, if it's other than FMS, nil penalty. Oh, wonderful. Nil penalty. And if it is a case of FMS, then 15% of the tax. 15% of the tax. That means discount is 85%. What is the maximum penalty? 100. And government is saying pay only 15%. It's a good scheme. Then if you pay within 30 days from service of notice, 30 days from the service of notice, if you pay, for other than FMS, it's nil. For FMS, it is 25% of the tax amount. And say suppose government gives you one more alternative, and that one more alternative is within 30 days from communication of demand order. 30 days from communication of demand order. In such cases, for other than FMS, there is no relief. But for FMS, 50% of the tax. Government is giving a relief of 50% on the penalty. I again repeat, don't forget the benefit is not on tax and interest. Plus, you should pay tax, interest and applicable penalty, that is reduced penalty, has to be paid. Only then this is available. Now, one important thing. This other than FMS, you can see nil and nil. This nil and nil benefit is not available in case a person has not paid self-assessed tax. Self-assessed tax has not been paid. That means he is saying that this much is what I have to pay. If he has not paid that self-assessed tax for 30 days from the due date, say suppose August month, what's the due date? 20th September. For 30 days he has not paid this, then he has to pay penalty. Relief of nil and nil will not be available. He has to pay it. But tell me one thing, people. Will this be paid voluntarily? No. CBIC has clarified that this penalty is applicable only when show cause notice under section 73 is issued for non-payment of tax for more than 30 days. If you have not paid tax for more than 30 days, department will issue a notice, then you cannot claim a relief of nil and nil. Remember, you cannot claim a relief of nil and nil in such cases. Clear with this? Yes, the self-assessed tax not paid for more than 30 days. In such cases, 73 relief is not available. Okay. Now talking about section 75. See, what does section 75 deal with? It deals with common points which are applicable for both section 73 as well as section 74. Common points. What is the first common point? First common point relates to prosecution. Just because you have paid all these amounts does not mean criminal proceedings cannot be started against you. आपने tax interest penalty भर दिया. अब you cannot go ahead and say that I have already paid tax interest and penalty. Criminal proceedings, that is imprisonment or jail proceedings, cannot be started against you. That is not permissible. Prosecution is separate, civil proceeding is separate. Tax interest penalty is civil proceeding. Criminal proceeding can still be initiated or started. Okay. Second is with regard to connected persons. Now connected persons, say suppose I was a person against whom notice was issued. There was truck driver and truck owner who were carrying those goods. So they also become connected parties to this notice. If I am given a relief, मेरे खिलाफ केस खत्म हो गया है. In such cases, the case is over for all such connected persons as well. So this relief is available to all the connected persons. Clear with this? Yes. Thereafter, the third point is how many adjournments are allowed. Adjournments, tariq pe tariq. Now the adjournment has a limit. There are 3 adjournments which are permitted. 3 times you can call for adjournment or pushing the hearing, personal hearing to the next date. That is allowed 3 times to each party. Now, fourth, when we talk about interest is mandatory even if it is not mentioned in the notice. But the same does not apply for tax and penalty. Tax and penalty will apply only if it is in the show cause notice. If, say, suppose a matter is not mentioned in the show cause notice, then can the proceedings be done for that matter? The answer is no, never. And remember one thing, demand order can never go beyond the show cause notice. Say, suppose notice is issued for 10 lakh. Demand order cannot be 12 lakh. That is not permissible, people. It can maximum be to the extent of show cause notice. It can be favorable to me, it can be favorable to department, or it could be a mix of both. But never can demand order cross the notice amount. But interest is always mandatory. Plus, some cases where the case is sent back to the officer by a higher authority. Say suppose High Court sends it to the to the officer saying that there was a issue, you have not seen into the issue correctly. In such cases, that officer gets 2 years time to dispose that particular case and pass a order. Yes? Okay. One very important section is section 76. Now what is this section 76? Listen to me very carefully. Section 76 deals with amount collected representing as tax. You are not collecting tax. You are collecting an amount which represents as tax. Say suppose मैं एक exempt service दे रहा हूँ. I am providing an exempt service. Now I collect tax. If there is no tax applicable on that, so I have collected an amount representing it as tax. First of all, I need to pay this amount forthwith. What's the meaning of forthwith? Immediately I have to pay the amount. And if I don't pay it immediately, interest will be applicable. And can the department issue a show cause notice? The answer is yes. And the biggest thing is there is no time limit. No time limit mentioned in the law. This is an open-ended provision. No time limit, meaning show cause notice can be issued anytime. But once show cause notice is issued, demand order to be passed within 1 year from the issuance of show cause notice. So show cause notice does not have a time limit, but demand order has a time limit. Clear? Okay. Then we have section 77. Section 77 basically deals with a case where you have paid C plus S instead of I, and you can claim a refund of C plus S after paying IGST. Yes, and similar provision is section 19 of IGST. Then we have section 78 and 79 which deal with recovery. 78 talks about initiation of recovery. 79 talks about modes of recovery. See, officer has passed a demand order. You have 2 options. One, to pay the liability or go for further appeal. If you go for further appeal, no problem. But if you don't go for further appeal, officers will initiate recovery proceedings. And recovery proceedings can be initiated after expiry of 3 months from the demand order. Be very careful. You will find this 3 months even in appeal provision, that appeal has to be filed within 3 months plus condonation can be allowed. But that 3 months and this 3 months is linked. Government has one power where in case there is a person who might run away, in such cases, they can go and recover within the period of 3 months as well by passing a written order. Now, for the purpose of recovery, whenever we talk about recovery can be done from the person or any of the distinct persons. Like Karnataka branch has done a fraud. In that case, recovery can happen from Maharashtra branch as well. The law is very clear on that side. Recovery, there are various modes. You can recover it through adjustment of any amount which is there with you as an officer, or garnish order, that is issue a notice to the bank freezing of accounts, or it could be a case where you recover it as arrears of land revenue, which is called as certificate proceedings. You give a certificate to the district collector and district collector will recover it. Otherwise, the proper officer can go and sell the properties, detain and distrain. That is also possible. In case of liquidation, yes, in such cases, official liquidator will be informed that this is the amount due to government and this is what we have to receive. So, if there is a surety, then recovery can happen even from the surety, the person who has assured that in case the other person does not pay, I will pay. So all such methods can be used by officer, and the worst part is there is no order given. They can use any method at their discretion. This is giving them lot of power. And say suppose you are not able to recover the entire amount, then it will be shared between central government and state government. Say suppose due was 10 lakh and 10 lakh. If you recover only 5, then both will share 2.5. The law is clearly provided for it. Then we have section 80. Payment of tax in installment. Installment scheme is also available. You get EMI na? Today the time is of EMI. Government also give EMI option. Commissioner can give this to a maximum of 24 installments. But if you don't pay one installment, then in that case, you have to immediately pay the entire amount. This is to stop recovery proceedings. I take some time saying that give me 24 months, I will pay entire dues along with 18% per annum interest. Very high interest. Along with 18% per annum interest. But this is not available in some cases. 1. Say suppose there is already a recovery proceeding going against that person, he cannot claim for installment. Second, if previous financial year it was not allowed, in that case it will not be allowed this time. And if the amount is less than 25,000, this scheme will not be available. Okay. Then we have section 81. Now section 81, some transactions will be regarded as void. Like, I have evaded tax. मेरे से recovery करना है. I have a property. मैंने क्या किया? I transferred that property to someone else free of cost. So that recovery cannot happen. In such cases, that transfer will be regarded as void. Something which you have read in Indian Contract Act. But remember, if it is in good faith and for full consideration, then it will be considered as a valid transaction. Then we have section 82. Section 82 deals with liability first charge. Government has first charge over all the assets subject to insolvency and bankruptcy code. So first, whatever is mentioned in insolvency and bankruptcy code, that amount will be paid. Thereafter, government dues will get a priority. And finally, section 83. Provisional attachment. Be very careful. This is not assessment. While reading the question paper, read it with open eyes. Provisional attachment of the property. Now, see, all this will take time. All this meaning issue of show cause notice, personal hearing, service of notice, all this will take time. During the pendency, attachment of assets is permitted so that the other person does not sell off these assets. So during the pendency of section 62, 63, 64. 62 is best judgment in case of non-filers. 63 best judgment in case of unregistered person who was liable to register or cancellation. 64 summary assessment. 67 In case of inspections or seizure, 73, 74. In such cases, during the pendency of the proceedings, the officer can attach the property of the registered person. This attachment will be valid for 1 year. Okay, 1 year के अंदर case close करो ना, complete the entire proceeding and close it. It will be valid only for 1 year. After that, it would not remain valid. So 1 year is the time limit which is allowed for provisional attachment. And can I raise an objection? The answer is yes. An objection can be raised by the person against whom this is done, saying that this is not good, I am not going to run away, neither I am going to sell any assets. Plus, if it is perishable goods, in such cases, it will be released if you pay the amount due or value of perishable goods, whichever is lower. If you pay that amount, then those perishable goods will be released. That is also provided in section 83. Clear with this? So we started with 73 and we end at 83. What have we discussed? 73 show cause notice, 74, 75 common points, 76 amount collected representing as tax, 77 wrong place of supply, 78, 79 recovery, 80 installment, 81 transfer being void, 82 first charge, 83 provisional assessment. Clear? In this video, we are going to revise appeal, review, revision. Now, when we talk about appeals, see, first you should know the terms very carefully. Adjudicating authority. Adjudicating authority is the one who adjudicates, passes an order, issues a show cause notice. There can be three: superintendent, ACDC, or additional commissioner, joint commissioner. These are the adjudicating authorities. Thereafter, below them, you have appellate authorities. Appellate authority has to give decision based on the order which has been passed by adjudicating authority, that will be subject to appeal to the appellate authority. From here, you go to appellate tribunal, national bench, state bench. National bench, only place of supply matter. State bench, all other matters. From here, you go to high court and then high court to Supreme Court. For that place of supply matter, you directly go to Supreme Court because states do not have jurisdiction over place of supply. कोई भी place of supply का matter होगा, so that has to be heard by the Supreme Court, not by High Court. इतना समझ में आया? Yes, sir. Now, let's see the entire process. Now, for this, it's important for us to be in sync with this particular diagram. Let's see. चलिए देखते हैं. First thing is who has passed the order. Say suppose order is passed by superintendent or ACDC. If the order is passed by superintendent or ACDC, then you will go to joint commissioner appeal. And there is a star. That means this is the appellate authority. Joint commissioner appeal. Understood? ACDC or superintendent passing an order, you will go to joint commissioner appeal. And be very careful, people. When we say joint commissioner appeal, there is no relation between joint commissioner and joint commissioner appeal. Joint commissioner is the adjudicating authority. JC appeal is a appellate authority. Fine. Okay. Now, if the order is passed by additional commissioner or joint commissioner, in such cases, you will go to commissioner appeal. Again, you will see a star here. That means they are considered to be appellate authority. Correct? Yes. Now, what is the time limit? For assessee to go, the time limit is 3 months plus one condonation of 1 month is allowed. For department gets 6 months plus 1 month condonation. Now, whenever you go to this joint commissioner appeal or commissioner appeal, you have to pay a pre-deposit. Pre-deposit obviously is applicable only for assessee. That's admitted liability plus 10% of the disputed tax. Be very careful, does not include interest and penalty. 10% of the disputed tax. But admitted liability is tax, interest and penalty. Very careful, people. Admitted liability will include tax, interest, penalty. But 10% of the disputed tax, not interest and penalty. maximum 25 crores. Correct? 10% of CGST, 10% of SGST, 10% of IGST. Maximum 25 crores for CS. For IGST, it would be maximum 50 crores. Careful. Now, once the decision is passed by them, thereafter you go to the appellate tribunal. I will come to revisional authority in a moment. You go to appellate tribunal. Appellate tribunal can be national bench for a matter of place of supply, state bench for a matter of other than place of supply. National bench is supported by various regional benches and state bench is supported by various area benches. Okay. What's the time limit to go to appellate tribunal? The time limit to go to appellate tribunal, SSC has 3 plus 3. 3 months normal time and you have additional 3 months of condonation. But department has 6 months plus 0. There is no condonation given in the law. In future, I think this will be changed, but as on date, there is no condonation for going to appellate tribunal in case of department. Okay. And what is the pre-deposit to be made? 20% additional of the disputed tax. Whatever you have admitted, that too you have to pay additional 20%. 20% of C, 20% of S, 20% of I. But maximum 50 crores C, 50 crores S. For IGST, it would be 100 crores. Thereafter, it is simple. From national bench, you will directly go to Supreme Court. State bench, you will go to High Court. Time limit 180 days. And then Supreme Court, time limit 60 days. Clear with this? High Court and Supreme Court, condonation and pre-deposit is dependent on High Court and Supreme Court. See, pre-deposit for High Court and Supreme Court is full amount. You have to pay full amount, only then you can appeal. But in some cases, High Court and Supreme Court can also give a relief. Plus, when we talk about any condonation to High Court and Supreme Court, it is covered by Code of Civil Procedures, which is not part of our discussion. It is decided by High Court or Supreme Court. Yes? Okay. Till here, everything is fine. The problem comes under this revisional authority. Now, what is this revisional authority? See, this is something which is added in between by the government so that they can play with us. That's it. क्यों लेके आया इसको? Provisional, what happens is if you have failed to file an appeal as a department officer, then this revisional authority can revise the order passed by officer. Wapas, revisional authority can revise the order passed by officer. And obviously they will pass it in favor of department and then we will appeal. This is coming from direct taxes where there is similar revisional power to commissioner, but in direct taxes, now it can happen both ways. It can be favorable to us, it can be favorable to department. Here revisional authority is only for doing one thing. If it is favorable to us, they can convert it into favorable to department. That's the only possible aspect in revisional authority. And if revisional authority passes an order, you have to go to appellate tribunal. Now, who is revisional authority? That is also defined. For superintendent and ACDC passed orders, revisional authority will be joint commissioner or additional commissioner. For JC passed order, commissioner will be the revisional authority. So, revisional authority would depend on who has passed the order. Now, the most important aspect in this is revisional authority, very important for your exams. Let's see how revisional authority works. First, we have understood this. Order passed, thereafter you go to appellate authority, from appellate authority to appellate tribunal, High Court, Supreme Court. In between, revisional authority can change the order which is passed by superintendent ACDC or additional commissioner, joint commissioner. And they will pass it in favor of the department. Let's try to understand how does this work for your exams. Let's see. See this very carefully. Now, there is a matter which is passed. First one is favorable to department. There are 4 matters where the issue was going on. And this is the order. Order passed by department. Order passed by an officer. First one was favorable to department. Can revision be done in this? The answer is no. No revision will be done for something which is favorable to department. Now, something which is favorable to assessee, can revision be done? The answer is yes. They have two options. One, they can file an appeal and appeal time limit is 6 months. Or they can tell the revisional authority that revisional authority will revise it after 6 months but before the expiry of 3 years. So the maximum time which is allowed for revision is 3 years from the date of order. Why after 6 months? Because first 6 months में तो appeal का provision है ना. If they fail to file an appeal, still they can harass us by revising the order. That is a power which is available. And this is a bit biased against assessee, because if the power was to be given, it should have been given both sides. Like, this can be used only if something is favorable to assessee. If it is favorable to department, revisional authority cannot do anything. Revisional authority can revise only if it is favorable to assessee. So, who is a revisional authority? We saw this, that revisional authority is JC or additional commissioner for superintendent or ACDC, and if JC has passed an order, then commissioner. What can they do? They can change the order which is passed by the adjudicating authority if it is erroneous plus against the revenue. Wonderful. Erroneous plus it is against the revenue. But there are 4 exceptions. 4 exceptions where revision is not permitted. Very important for exams. 4 exceptions where revision is not permitted. 1. If already an appeal is filed in the appellate authority, appellate tribunal, high court, supreme court, in such cases, revision is not permitted. A revisional authority is not superior to appellate authority. वो officer ही तो है, not an appeal authority. तो इसीलिए the law clearly says if there is an appeal already there, then it is not permitted. First 6 months not allowed. After 3 years, not allowed. First 6 months not allowed, because first 6 months you can file an appeal. Correct? Okay. If it is already a revision order, you cannot revise it again. Okay. If it was already taken up for revision earlier, but you dropped it thereafter, you did not go ahead with it, still you cannot revise it. Clear with this? Yes. Now, this is very important. The last segment is very important. Say suppose matter A is favorable to department. Can this be revised? The answer is no. Matter B is favorable to assessee. Now when I say matter B is favorable to assessee, department filed an appeal, obviously no revision permitted. No revision permitted. But for matter C and D, which is favorable to assessee and they have not filed an appeal, in that case, can for C and D revision be permitted? The answer is yes. Within 1 year from the order of appellate tribunal, high court, supreme court, or 3 years from this initial order, whichever is later. So if a particular order is in appeal, then for some matters in the same order, you get higher time limit. Doctrine of merger. In such cases, A and B will be regarded as separate, C and D will be regarded as separate. A and B you cannot revise, but C and D can still be revised if it is not considered and decided by the appellate tribunal or high court or supreme court. If it is not considered and decided, in that case, you can still, as a revisional authority, revise that order which is favoring assessee. Remember, something which is favorable to assessee, can the department officers revise it? The answer is yes. So, it continues for a period of 3 years. The sword or the knife, तलवार 3 साल तक लटकी हुई रहती है on us, because first 6 months they can file an appeal and they can revise it up to the period of 3 years. Clear with this? Yes. So revision is very important and this appeal mechanism is very important. Clear? Now, pre-deposit, don't miss out on that. Solve some questions on pre-deposit. Very important. First level 10%, subsequent level additional 20%. 10% of the tax, 20% of the tax. With this, we conclude in this, and you can go through the balance.
Now let's talk about miscellaneous provisions, and we will also discuss about advance ruling. These are the two topics which we will take. Miscellaneous provision, basically the law believes that if any document is found with the person during any search or seizure operation, then the content of the document is true, and second, any part where anything is written is from the handwriting of the registered person or such person with whom it was found. This is a presumption. Obviously, presumption means that if this is not true, then it has to be proved by the person saying that this was not mine. It has to be proved. The onus of proof will not be on the department, it will be on the person with whom that particular document was found. Facsimile copy, that is fax, computer printouts, electronically stored information are also regarded as evidence for the purpose of GST. Information can be sought by the commissioner under section 151, but obviously there is a bar on non-disclosure of such information, but with consent it can be used and disclosed, plus it can be used in proceedings after giving an opportunity to be heard. Then we deal with publication. Can information be published about tax evaders? Yes, publication of information of tax evaders can be done upon approval from the commissioner. Once that is done, it can be the director's name, partner's name, or related person's name who were involved in tax evasion, that also can be published. However, if the time limit for publishing the information, there is a bar, and that bar is if the appeal time limit is not over or the appeal is not yet disposed of, then in that case publication should not be done. That's the only criteria before publishing such information. Common portal, you have gst.gov.in for all the compliances, and you have ewaybill.gst.gov.in, that is for e-way bill generation. These two are regarded as common portal for the purpose of GST. Then we deal with apportionment of taxes. See, when we talk about IGST, we know that IGST will be apportioned. Now, how will you apportion IGST? See, there can be two things. If the sale is made in a B2B transaction, that means the other person was a registered person, then the other person will avail ITC. It is not a case of apportionment. It will be transfer of ITC depending on how IGST is used. I'll give you an example. Say suppose there's a B2B transaction done and the IGST charge was 18 rupees. Then the recipient will avail ITC of 18. Now this recipient will generate output tax. Say suppose he generates an output tax of C and S. C 9 rupees, S 9 rupees. Can he use ITC of 18 to pay this 9 and 9? The answer is yes. The moment ITC of 18 being IGST is used against C and S, that amount lying in IGST will be transferred in the way in which C and S has been used. So if you have used 9 against CGST, 9 against SGST, then in that case 9 rupees will go to central government's account and 9 rupees will go to state government's account. So earlier this money was lying in IGST account. Now it will be transferred to central government and state government. So whenever it is a B2B transaction, IGST is not apportioned between states. What happens? IGST is kept in IGST account, and then based on whatever is the usage, that money will go to wherever you have used. If I is used against I, then it will remain in IGST account. If I is used against C, that much will move to central government's account. If I is used against S, that will move to state government's account. Then comes B2C transaction, or supply to a composition dealer, or supply in a case which is covered by block credit, because you will not get ITC even if it is a B2B transaction. For block credit, that is section 17 bracket 5, cars etc., you will never get ITC. Or the last date for taking ITC is over. What's the last date for taking ITC? Due date for filing September month return was there earlier. Now it is 30th November after the financial year, or date of filing annual return, whichever is earlier. If that period also has lapsed, now you cannot take ITC. In all these cases, IGST will be apportioned. Now, IGST, first half of IGST will be transferred to central government. Then balance half should be transferred to state government. And if it belongs to a union territory, then that will also go to central government. Now, if the place of supply is known from the GST returns, then in that case, it will be transferred to that state government where the place of supply has arisen. So if the place of supply has arisen in Karnataka, half will go to central government, half will come to the state of Karnataka. Sir, what if the place of supply was not known? Then in that case, the supplier in that particular financial year, say suppose he has supplied to Karnataka, Maharashtra and Delhi, and the ratio is 3:2:1. Then in that case, if you are not able to find the place of supply for a particular IGST amount, it will be distributed to Karnataka, Maharashtra, Delhi in this ratio 3:2:1. Normally whatever tax he pays us on Delhi, Maharashtra, Karnataka transaction, in the same way that IGST amount where we don't know what is the place of supply, it will be transferred in this ratio. Sir, what if we don't know who has paid that IGST? And we are dealing with thousands of crores, lakhs of crores. We might sometimes not know who has paid that particular IGST amount. Then it will be distributed to all the states and union territories based on preceding financial year tax collection in the ratio of tax collected in the preceding financial year. So, determination of ratio, and then the balance amount will be transferred to all the states. What are we talking about? We are talking about this half, because first half will anyways go to central government. The second half will be divided in this manner. First, if the place of supply is known, do that. Second, if the supplier is known and place of supply is not known, divide it based on wherever he supplies. Third is, if nothing is available, divide it between all states and union territories. Then we have anti-profiteering measures. What is anti-profiteering measures? See, there might be a scenario where government has reduced the GST rate from 18% to 12%, but instead of charging lesser value, what you have done is you have started making profit out of government. Earlier 100 plus 18 was charged. Government reduced this 18 to 12. What should be done by the businessman? He should also charge like this. But you know what he did? He increased this to 105, say suppose 105.75, and then this became, say suppose 12.25, and this remained 118. So though government has reduced the GST from 18% to 12%, instead of passing the benefit to government, the person or the businessman had started making profit out of government. This is not allowed. If this is done by a business, then anti-profiteering proceedings will be initiated against him. Who will do this anti-profiteering initiation, sir? Competition Commission of India is empowered to do this. Which Competition Commission? That under Competition Act 2002, that Competition Commission of India is empowered to take actions against this person. The other case might be where government has given you input tax credit, so your cost reduces. If your cost reduces, you should also reduce your sale price. But this person is not reducing the sale price, even though earlier he did not get ITC. Now he is getting input tax credit, so he should have reduced his cost, and subsequently he should have reduced his sales. He is not reducing the sale price. In such cases also he is profiteering from government. Anti-profiteering proceedings can be initiated. Now, under anti-profiteering proceedings, you should know that what orders can CCI pass. The first power which is there with CCI is they will tell the other person to reduce the prices. Second power is they will tell to refund the amount. They might also cancel the registration, initiate cancellation proceedings, because this is one of the areas where suo motu officer can take action of cancellation if you don't follow anti-profiteering provisions. And last one, penalty can be imposed, and penalty is 10% of the profiteered amount. Sir, what if the other consumer is not available? If consumer is not available, then the money will be transferred to government under Consumer Welfare Fund, and both of these will be along with interest at 18% per annum from the date it was collected till the day it is repaid. If the amount is paid within 30 days, then in that case penalty will not be applicable if the profiteered amount is paid. Now in this you have state level screening committee. Now state level screening committee will screen all the applications which are received at the state level. Then it will go to the standing committee. Then standing committee has DG investigation. They will transfer the case to DG investigation. This DG investigation will conduct the investigation of profiteering and finally submit the report to Standing Committee as well as Competition Commission of India to take necessary actions against this particular person. This is how the provision works for miscellaneous topics. Then let's now talk about advance ruling. Now, see, as the name suggests, the reason of keeping advance ruling was to give a benefit to persons with regard to confusion. If they are confused with regard to some aspect of the law, then they can go to advance ruling authority and get a certainty, because one of the principles of GST is there should be certainty in taxation law. So if there is a confusion, can the taxpayer go to the advance ruling authority? The answer is yes, the taxpayer can go to the advance ruling authority. It's called as authority for advance ruling. So an application can be made by a person to the authority for advance ruling for a transaction which is undertaken or proposed to be undertaken. Then there is department on other side as well. So it will be forwarded to department, and then department will also reply with its arguments. Once the department replies with its argument, authority for advance ruling has to pass an order, and that too within 90 days from the date of application. So it is very quick. So once application is made, entire process has to be completed within 90 days. Plus remember one thing, that say suppose a matter is already pending in a court or already under investigation. So either it is getting investigated or it is pending in the court, then in that case authority for advance ruling cannot take that particular matter, because obviously courts will decide it, not authority for advance ruling. Authority for advance ruling is state wise, and that's the reason they cannot hear a matter of place of supply. They can hear matters of classification, exemption, output tax, whether it is a supply, whether input tax credit will be available, valuation, whether a person is liable to register under GST law, or notifications. They have all these powers, but place of supply is not one of the powers covered by authority for advance ruling, and hence place of supply cannot be determined by AAR. Sir, what if I am not satisfied with the decision of AIR? Then you can go for an appeal to appellate authority for advance ruling. The time limit is 30 days plus additional extension of 30 days. Appellate authority for advance ruling also has to pass an order within 90 days. This is one route of going to appellate authority for advance ruling. There's another route. Say suppose authority for advance ruling, there is a difference of opinion between the members. There are two members, one is saying taxable, one is saying exempt. I went to ask whether it is taxable or exempt. So if there is a difference of opinion between the members of authority for advance ruling, they may refer the matter to appellate authority. Sir, if there is a difference of opinion here, if there is a difference of opinion between them, then it is deemed that no advance ruling can be given. No advance ruling can be given. So see the provisions. If AAR is confused, authority for advance ruling confused, you will go to appellate authority. But if appellate authority there is a difference in opinion between the members, then in that case it is deemed that the ruling cannot be given. Now, if any advance ruling has been taken by fraud, willful misstatement, suppression of facts, then in that case it would be void. Void from the time when we get to know the fraud. Obviously anything done prior to that would still stand, but it will be regarded as void. The ruling will be regarded as void. Plus don't forget one point, the time period from the date of giving the order under advance ruling till the time when we get to know the transaction of fraud, when it is void, this period is excluded from computing the time limit of issuing show cause notice under 73-74. That means department will get more time to initiate show cause notice proceedings and issue a demand order against this person, because he has taken fraudulent advance ruling. Now, yeah, obviously he'll have to pay taxes, because see, even though the moment it was taken by fraud, the ruling itself is not there. So as the ruling itself is not there, it would be as good as the ruling was not applied for, and that period will be excluded for the computation of limitation. This is about advance ruling. Now let's talk about offences and penalties. Offences and penalties, we'll start with penalty and then move on to imprisonment and other provisions. First, when we talk about penalty, the governing section which deals with most of the penalties is section 122. We'll start with 122.1. 122.1 deals with 21 offences where the penalty would be 10,000 or tax evaded, whichever is higher. This is the penalty applicable under section 122.1. There are various offences covered. In fact, all the possible offences which a person can think of is covered under 122.1. Like a person supplying goods without invoice, services without invoice, or invoice being issued without supply. You are just issuing invoices, or the person is claiming ITC on these fake invoices. Section 20, that is input service distributor provisions contravened. That means C plus S was charged in a state where you should not have transferred it, or that was not received by the company, and still C plus S was converted into IGST and transferred to the other state so that loss of input tax credit does not happen. Contravention of ISD provisions. Collects tax but fails to pay tax to government is a big crime. Then TDS TCS not done, tax not deducted, tax not collected. Fraudulent refund or fails to obtain registration, obstructs an officer or fails to maintain books of accounts, fails to give information. Like this 21 offences, the penalty would be 10,000, or tax evaded, or ITC wrongly availed or utilized, or fraudulent refund, or tax not deducted, or tax not collected, whichever is higher. 122(1)(a) is a new provision which says the person who has undertaken these transactions is anyways liable under 122(1). What about those persons who took the benefit out of these transactions, or at whose instance this person was doing such transaction? Even a chartered accountant can get covered under this if he has helped in this first four: supply of goods without invoice, invoices without goods, or contravention of ITC provisions or ISD provisions. If first four cases, any person who has retained the benefit of such transaction and at whose instance these transactions was done, penalty will be equal to tax evaded or ITC availed or passed on. Now, earlier chartered accountants or helpers were covered under 122(3). Aids or abets, the helpers were covered here, but here the maximum penalty was only 25,000, which was very low compared to the crimes which were being done, and that's why government brought in 122(1)(a) that such persons will be liable to the extent of tax evaded, not just 25,000. All this which you see is under CGST Act. So for SGST Act, the same provision will be applicable. And for IGST, any amount which is there or percentage of value will be doubled for IGST. If it is a percentage of tax, then don't double it for IGST, because tax of IGST automatically gets doubled. 122(2), it's similar to 73-74. Other than FMS case, 10,000 or 10% of the tax, whichever is higher. But FMS, what is FMS? Fraud, willful misstatement, suppression of facts. If it's a fraud, willful misstatement or suppression of facts case, then 10,000 or tax evaded, whichever is higher. Plus remember that section 75 clearly provides that if penalty is levied under 73-74, then any other penalty under any other provision will not be applicable. So normally if 73-74 is already used, then 122 penalty will not be applicable. But as a precaution, government has been considerate enough to give these penalties even under section 122. So the officer can levy either 73-74 penalty or 122 penalty. Then we have failure to furnish information return. Information return, basically RBI or municipal authorities or electricity department, where government says you have to give some returns. Then if they don't give those returns, penalty 100 rupees per day or 5,000, whichever is lower. It's like a fee, and that's why government has said whichever is lower. 124 deals with failures to furnish information under section 151 which the commissioner has sought. Then in that case, fine will be 10,000. This is not a penalty, it's a fine. And if it's a continuing offense again and again, 100 rupees per day, maximum to the extent of 25,000. Then if anything is not covered by any other provision, then a general penalty can apply, maximum 25,000. Plus, if there is a minor breach, that is less than 5,000 or only a documentation error, then such penalty may be waived off by the officer. He has a discretion. But wherever there is a specific percentage based penalty which is fixed, then 126 does not apply. Then in that case, penalty would be applicable as such. Less than 5,000, be very careful. Exactly 5,000, penalty will be applicable. It is not considered as a minor breach. So minor breach is only when it is less than 5,000. Obviously this is under section 126 CGST Act. Okay. Then 128 gives a special power to government that they can waive off any penalty that they normally do. In fact, they can waive off fee as well. That also is being done by government. Lot of late fee in GST return was waived off under section 128 in the initial 3-4 years of GST. Let's talk about a very important provision now from examination point of view, and that is section 129, which deals with detention, seizure and release of goods which are detained during transit. Now say suppose a vehicle was not carrying requisite documents. Invoice was not being carried, or e-way bill was not being carried, or e-way bill was not generated, or e-way bill is expired. Then section 129 will get triggered. Officer will first detain the vehicle. Now as officer has detained a vehicle, he has to issue a notice within 7 days from such detention, and then an opportunity to be heard will be given. Plus officer has to pass an order within 7 days from the notice. If the person wants to release the goods, then for releasing the person has to pay these amounts, or he has to give a bond for this extent, furnish a security. Say it could be a bank guarantee. That bank guarantee will have to be submitted for this amount. Say suppose the tax evader or the person who did not carry these documents comes forward, then the penalty will be 200% of the tax. Don't double this for IGST, it's 200% of tax. Tax will automatically get doubled in IGST. If it is exempted goods, then it is 2% of value or 25,000, whichever is lower. But if the person does not come forward, the tax evader does not come forward, then penalty will be 50% of the value or 200% of tax, whichever is higher. Sir, 50% of value, will we double it for IGST? The answer is yes, because 50% of value does not automatically get doubled in IGST. That you will have to double it. So that will become 100% of the value. What government wants to actually do is, when he does not come forward, government wants to eat away that entire goods value. Obviously he is a tax evader and he has not paid the taxes correctly, and he is not coming forward as well saying that it is his goods. Then government has also kept the penalty very high. Normally a CGST Act question is asked. If CGST Act question is asked, just apply this. Don't give an answer for SGST Act. Just mention this much, that will be sufficient for your examination. Exempted goods, instead of 2% here, it is 5% or 25,000, whichever is lower. Plus, if these amounts are not paid within 15 days from the order, then it will lead to sale of goods. Department has an option to go for auction and these goods will be auctioned. Now, before auctioning, they will issue a notice, public notice, saying that these goods will be auctioned. If before that notice, but after this 15 days time, if the person pays, then the auction will be cancelled and the goods will be released. If he does not, then e-auction will be conducted, and obviously the time limit there is 15 days again. Once the process is completed, the person who has the highest bidder, he will get the goods. If the bids received are not in consonance with what the department wanted, that means a very low number of people participated or there were no bids at all, then in that case auction process will be cancelled and a new process will be initiated. Then corresponding to section 129, you also have section 130, which deals with confiscation of goods. Any case where a person supplies or receives goods in contravention of the provisions of the law with the intent to evade tax or contravenes any provision with an intent to evade tax or does not account for the goods or fails to obtain registration even though he was liable to register, then in these cases within intent to evade tax, that's the key point, 130 is very harsh, then goods can be confiscated by the department. Now once the goods are confiscated by the department, you can get it released by paying redemption fine. And don't forget, this redemption fine is over and above tax, interest and penalty. Those three are anyways to be paid. 130 is a wider provision. 130 can be executed in any kind of search and seizure. Plus, normally when 129 applies, 130 will not apply because release provisions are covered here only. Then anyways goods are detained and kept in the custody. Here confiscation would not be done. Here direct sale proceedings are given in the law. 130 can cover other cases of search and seizure and raids. Redemption fee. What's the redemption fine? Redemption fine which is given in the law, government has given a maximum redemption fine and minimum redemption fine. Maximum redemption fine is market value of the goods. Minimum redemption fine, market value of the goods minus tax payable, because anyways he has paid the tax, so that will be deducted, net amount. But here minimum redemption fine, government has said the minimum redemption fine plus penalty shall not be less than 100% of tax. This is the minimum redemption fine. So here maximum redemption fine is market value minus the tax payable, and minimum redemption fine, fine plus penalty, and this penalty is penalty under section 122. See, normally these will be cases of fraud and penalty under section 122 will be tax evaded. Tax evaded is 100% of tax. So this 100% of tax and 100% of tax will get cancelled. Minimum redemption fine can come to 0 as well. So this is the range given to the officer for levying redemption fine, because government has stored these goods, and obviously if government has stored these goods, they want the goods to be released only on payment of redemption fine. Option to pay redemption fine will always be given under section 130 before the goods are confiscated. Differentiate between 129 and 130. 129, there is no option to pay redemption fine, etc. If you don't pay, they will start selling it. But 130 gives an option, makes it mandatory for the officer to give an option to the taxpayer to take away his goods by paying redemption fine. That's the major difference. Then we have 132, where imprisonment can apply. Various cases which talks about how much should be the jail term, what can be the offences. Let's see what are the crimes first. I have some friends, people. First friend is Mr. A. He is actually running a factory. He is supplying goods or service without invoice. Without invoice, he is supplying goods or services. B only issues invoices, does not actually supply goods or services. So his factory only issues invoices. C takes ITC of the invoice of B. See, for all these crimes, penalty will be applicable, plus jail also will apply. We are reading jail now. You will find it similar to section 122(1), but both are different. 122 talks about penalty, 132 talks about jail, imprisonment. 1D collects GST but does not pay to government for 3 months. These 4 are big crimes where the imprisonment and arrest provisions are very strong. And don't forget that imprisonment and arrest are two different things. See, imprisonment is given by the criminal code saying that this much jail term will apply. Arrest is a preventive arrest so that the other person does not run away. Arrest provisions are there. Mr. E fraudulently exports and claims refund. F falsifies the records. G obstructs an officer. H is a helper for goods. I is a helper for services, commission agent who helps you to do all these transactions, and this is transporter who helps you transport the goods. J tampers with the documents. K information not given to officer, and L abets or encourages all of them. Now all of these crimes can lead to imprisonment, and specifically these three crimes F, G and J, 6 months jail term can apply. But remember, this 6 months jail term will apply when there is no tax evasion in rupee terms. It's just falsification of records which did not lead to any tax evasion. Then also 6 months jail will apply. Obstructing an officer. If you stop an officer from performing his duties, even if you have not evaded tax, 6 months. Tampers with documents. Even if there is no tax evasion, 6 months jail. Sir, what if there is a tax evasion? Then it depends on how much of tax is evaded or ITC fraud to extent of what. Minimum 1 crore is required for imprisonment to apply. Till 1 crore, no imprisonment. More than 1 crore up to 2 crore, 1 year jail, minimum 6 months. 2 crore to 5 crore, 3 year jail, minimum 6 months. And more than 5 crore, 5 years jail, minimum 6 months. Arrest in first case, not possible. For arrest, more than 2 crore has to be evaded. Here arrest is possible, but only for A, B, C, D. That's it. A, B, C, D. Only these 4 crimes. Other cases, arrest is not possible. If there is a subsequent offense, then arrest is possible without any limit. Subsequent offense is once you have been convicted, jail term has been served, again do this crime. That's it. And more than 5 crores, obviously A, B, C, D. Type of offense. The first type of offense is non-cognizable and bailable. Non-cognizable and bailable. That means bailable meaning the person who has arrested, he can only give the bail. He will only release that particular person. More than 2 crore up to 5 crore, A, B, C, D or any other crime will be non-cognizable and bailable. Oh, same sir, same. Non-cognizable and bailable. Okay, what about more than 5 crore? More than 5 crore, if it is A, B, C, D, then it will be cognizable and non-bailable. Non-bailable does not mean you will not get bail. Non-bailable meaning bail will be given only by the magistrate. It will be taken to the magistrate, that person can give a bail. So don't mix up imprisonment and arrest. Arrest is a preventive arrest to stop. Imprisonment is a jail term which is given by the criminal court. Subsequent offense in all cases 5 years, minimum 6 months, and arrest is obviously possible in case of subsequent offense, be it any category, if it was convicted. This is about section 132. Then the law also says that if there is an offense by companies, then the particular director, manager, or in case of trustee, in case of partnership firm, in case of LLP, partners, in these cases, if they are found to be doing any crime, then all these imprisonment will apply on those persons. But if someone proves that he was not involved in such fraudulent transaction, then in that case it will not be applicable. This is what the law has clearly provided. Then you have section 138. 138 deals with compounding of offenses. There is a relief given. I mean, a person can pay X amount and not go to jail. Compounding of offenses. But obviously for crimes from A to F, A to F is this, A to F, it is allowed only once. That means if you have compounded first time, second time compounding cannot be done. Then if the value is more than 1 crore, then again compounding is allowed only once. Only once. Second time it will not be allowed. Third, obstructing an officer or tampering evidence or information not given, G, J, K, G, J and K, not allowed. No compounding. Then if something is an offense in any other law, like Arms Act, it's an offense, then also not allowed. These are the places where it will not be allowed. I mean, you will not get compounding. A to F you get only once, second time you will not get. Value more than 1 crore you will get once. G, J, K you will never get. Any other law, if it's a crime in any other law, you will not get. If already convicted, if the criminal code has given a judgment, then obviously it is not allowed. But before initiation of prosecution or during prosecution, compounding can be done. How much do I have to pay, sir? Minimum 50% of tax or 10,000, whichever is higher. And maximum is 150% of tax or rupees 10,000. Again the law says whichever is higher. The law also provides that if the officer has disclosed some information which he has got in his official duties, then in that case fine or 6 months jail or both may be applicable on such person. This is what the law has clearly provided. Practice this for case study based questions, and normally offences and penalties you get a question, so be very strong with offences and penalties. Now let's talk about customs. Now customs comes from the union list. It can be collected only by central government. Article 246 has 3 lists: union, state, concurrent list. Custom duty forms part of union list, and the power to levy custom duty is with the central government. That is, Parliament will make the law with regard to customs. Now, union list has given the power, and based on that, Customs Act 1962 has been made. This is the main act which provides the provision for charge, and all the rate of custom duty are given in Custom Tariff Act 1975. This contains all the rates of customs. Earlier it was given in Customs Act, the rates were provided, but then they made a separate law for the acts in 1975. Now, when we talk about Customs Act, Section 12 is the governing section, which says that any goods imported or exported would be liable to custom duty. So the charging section of customs is very wide. The moment goods are imported, doesn't matter whether it is in the course of business, doesn't matter whether consideration is there, the moment it is imported or exported, custom duty triggers. Normally imports are liable to custom duty because the consumption is in India. Exports are generally not liable, but government can obviously levy custom duty. Now let's understand the procedure, because most of the thing we'll get to know in the procedure, which will be useful in all the other provisions. See, there is a small diagram to make you understand how does the process work. First step is arrival of the vessel or aircraft should always be at the custom port or airport. And the law also requires that before the goods arrive, electronically import general manifest and passenger and crew manifest has to be given. Now what is this import general manifest? It contains the details of goods which are being brought. Passenger and crew manifest, those who are coming to India. Now this has to be filed before arrival electronically. But when it comes to vehicle, you get 12 hours time after the arrival. You can fill import report in that case. Then the proper officer will give a permission. This is the proper officer. proper officer will give a permission to the person in charge. Person in charge is the captain of the vessel or the pilot in charge. Entry inwards will be given, but this is given only in vessel, not for aircrafts. Aircrafts can land. Then once the vessel has come here, thereafter unloading will be done. Unloading of the goods is done at the port. Any goods which are not mentioned in the import manifest cannot be unloaded. And then the law says custody of the goods will be given to the custodian. These goods now will be under the custody of the custodian. Thereafter the importer's work starts. Here is the importer. Now importer has to file something called as bill of entry for home consumption if he wants to directly clear the goods. It is also possible that he wants to store it in the warehouse because he does not have funds now, and you can't keep it on the port because port is very expensive. Now the bill of entry for home consumption or into bond bill of entry. Into bond bill of entry is to send the goods to the warehouse. It has to be filed prior to the date of arrival, previous day to the date of arrival, including holidays. Say suppose it is coming on 16th, you have to file it by 15th. If it is coming on 14th, you'll have to file by 13th. Doesn't matter whether it is a holiday or not. Previous day you should file it. If it's a holiday, file 5 days before. Sir, we can file 3 months before. No, the law has given a limit. If you expect the vessel to come within next 30 days, then you can file bill of entry for home consumption and keep it ready. Once you file the bill of entry for home consumption, you'll also have to pay custom duty. Now, the time limit for paying custom duty is also defined. Self-assessed tax, you have to pay on the date of presentation of bill of entry for home consumption. The day you present the bill of entry, that day you have to pay. Otherwise, interest at 15% per annum will be applicable. Reassessed, sometimes once you file the bill of entry, officer will say no, 10% tax you have said, actually 12% custom duty will apply, 2% you have to pay extra. Then he will reassess and send it back. If you agree to it, then you have to pay that 2% extra next day after the reassessment, after the receipt of reassessment. If you don't pay by next day, interest will start triggering 15% per annum. Sir, if I don't think 2% extra is payable, then you get into litigation. That's a separate discussion altogether. Once you pay the custom duty, officer will verify everything and give a order for clearance for home consumption. Now let's see what happens if you file into bond bill of entry. To move it to the warehouse, you'll have to give a bond which is thrice the duty amount. Bond basically to safeguard the interest of government. Proper officer will verify your into bond and then give a order for warehousing. Then the goods will be stored in the warehouse. After that, whenever you want to clear, you can file a ex bond bill of entry and pay custom duty and get a order for clearance for home consumption. This is how the process would work. Now, from the warehouse, you can also export the goods. Then you will not be required to pay custom duty, but that you will learn in warehousing chapter. So, you have two options. One, to clear the goods directly from the port. This is 6, 7, 8. Or you can also do 9, 10, 11. What is 9, 10, 11? 9, 10, 11 is basically storing in the warehouse. So you file bill of entry into bond 1 and then you give a bond, transfer it to warehouse, then file a ex bond bill of entry to clear the goods. All these processes will help us in understanding how do we compute custom duty payable. So either 6, 7, 8 or 9, 10, 11 can be followed. Now, payment of custom duty, there is an option to pay deferred as well. Deferred payment is also allowed for authorized economic operators. Now, authorized economic operators, those who have significant import and export transaction and are given that under the authorized economic operator program run by CBIC. They get a deferred payment, plus authorized public sector undertakings also get an option to pay custom duty on a deferred payment basis. What's this deferred payment basis? whatever you are clearing between 1st to 15th, any goods which you are clearing between 1st to 15th, you can pay by 16th of the month. Those goods which are cleared from 16th till the end of month, you can pay the taxes by 1st of next month. So deferred payment is not a very big benefit, but at least you get some benefit. And if this is for March, if it is for March, then you have to pay the taxes by 31st March. Now, government has also introduced e-cash ledger under section 51A of Customs Act 1962, saying that you have to deposit money in the e-cash ledger, then through e-cash ledger you will make the payment of custom duty. E-cash ledger is exempted at ports where there is no electronic data facility or baggage, obviously baggage when you come from outside India at that point of time, or any duty other than the basic custom duty, social welfare surcharge, SWS, IGST. Other than these, if there is any other duty payable, that also can be paid from other than e-cash ledger. For everything else, e-cash ledger is mandatory. Then there is one e-credit ledger also. This e-credit ledger is for duty scripts. Say suppose you are an exporter. Now exporter would have incurred some taxes on his purchases. Other than IGST and C+S, he would have incurred some other taxes. Government wants to give that also as a refund. Now they don't give that refund directly to your bank account. They give it in the form of e-scripts, electronic scripts. These e-scripts will get credited to your e-credit ledger and they are freely transferable. One of the examples for this is RODTEP, remission of duties and taxes on export product. So this will not be directly coming to bank account, it will come as a e-script. E-script, either you can use it to pay your basic custom duty or you can sell that and transfer it to someone else. The other person will be able to use it against his imports and adjust it against his basic custom duty. This is the basic idea before with regard to e-cash ledger and e-credit ledger. Then there is transit and transshipment. See, what is the meaning of transit and transshipment? Transit is where the goods remain in the same vessel but they are going to some other port, whether in India or outside India. Transshipment is where the goods are transferred to another conveyance and that another conveyance is going to another port in India or outside India. Transit and transshipment both are allowed without payment of custom duty. So it can go to the next place. And if it is going to a place outside India, then no custom duty will be there. If it is going to another port in India, then custom duty should be paid in that another port. But movement during transit and transshipment is allowed without payment of custom duty. So if the vessel has come to Mumbai and it is also carrying some goods for Chennai, during this, once it touches Mumbai, no need to pay custom duty, and Mumbai for Chennai goods, tax will be in Chennai. That's what the law tries to say. Plus this transit and transshipment movements, there is no need to generate e-way bill as well, which we learnt in e-way bill exceptions, saying that no need to generate e-way bill in these cases. Then once you talk about transit and transshipment, the next area of discussion is with regard to export procedure. Obviously export procedure is not generally asked, but you should at least know the process so that if a question is asked on a practical side of solving, you know the terminologies at least. Export procedure, see, first you will file a shipping bill to the proper officer, and proper officer, the vessel in which these goods are going to go, proper officer would have given a entry outward to the vessel, and only that vessel which has entry outward, only that vessel's name can be written in the shipping bill. Then officer will pass a order for clearance and loading of goods. Once the order for clearance and loading of goods is completed, thereafter the loading of goods will be done. Once the goods are loaded on the conveyance, the person in charge, that is captain of the vessel, person in charge will issue a export manifest and give this to the officer. Let me tell you, import manifest, export manifest, if you fail to furnish that, penalty 50,000 on the person in charge. Plus if there is any short landing of goods, penalty twice the duty amount. Once export manifest is filed, officer will give a leaving permission. Provided all the taxes on stores or any penalty which is payable has been paid, then the leaving permission will be given, and once leaving permission is given, the vessel will sail to its destination. That's the export procedure. Now some important judgments in regard to custom basics. You should know that, say suppose you are supplying to SEZ. Supplying to SEZ, whether export duty will be applicable? The answer is no, because though SEZ is regarded outside India, but export duty will be applicable only if technically it is outside India. It's not technically outside India, I mean physically it is not outside India, and that's why export duty, as there is no charge either in SEZ Act, neither SEZ Act says that export duty will apply, nor Customs Act says, because Customs Act clearly says that a transaction can be regarded as export only when the goods are going outside India. And actually, is the SEZ outside India? No. For the provisions it is regarded, but actually it is not outside India, and hence export duty will not be applicable. Plus, a classification given at a particular point of time through a circular will hold good even for a prior period if there is no change in the entries in the Custom Tariff Act 1975. Plus, there is no time limit for filing bill of entry. Even if bill of entry is filed late, still even after 30 days, then also if the goods are there, then bill of entry is considered to be valid. It's obviously with prescribed late fee. What is the late fee? See, bill of entry you have to file on the previous day. If you don't file it prior to the date when the vessel is arriving or aircraft is arriving, then the late charges are 5,000 per day for first 3 days and 10,000 per day thereafter. Plus the maximum late payment charge, late filing charges is subject to custom duty payable. Obviously, maximum is restricted to custom duty payable. Otherwise, this prescribed charges will exceed the total custom duty payable, which is not the intent of the law. These are the judgments and provisions related to custom basics. You should also remember that importer may be a person who is importing or who holds himself as an importer, plus a beneficial owner as well. Like say suppose you have done a high sea sale or warehouse goods sale, then the person who has bought the goods, he will also be regarded as exporter. Same thing in export case, beneficial owner is also regarded as an exporter, like a merchant exporter or a manufacturer exporter will also be regarded as a exporter of goods. So this was about custom basics.
In this video, we are going to talk about classification of goods, and we are also going to talk about certain cases where custom duty is not payable. When we say certain cases where custom duty is not payable, we are talking about goods pilfered, goods damaged, goods destroyed, or goods relinquished. Let's first talk about classification, then we'll talk about no duty payable in certain cases. Classification. What's the purpose? To find out the applicable rate of custom duty. Where do you get the customs rate? It's available in Custom Tariff Act 1975. This Custom Tariff Act is based on harmonized system of nomenclature. Harmonized system of nomenclature is an internationally accepted product coding system which helps in grouping of various products where similar products are grouped together. like plastic articles in one section, rubber articles in one section. That's how it is grouped. Now, when we talk about classification, there are some rules of interpretation given in classification. Let's try to understand those rules. First of all, any heading which is given is of no use. Let me tell you how it looks. Say suppose there is a chapter 39, which deals with plastic articles. And in this plastic articles, we will have various custom duty rates given. Now, there will be two columns. One, rate column, and second one, preferential rate column. Now, what is this preferential rate? And then various items would be mentioned. What is rate and preferential rate? Rate of custom duty, say suppose, is 10%. Preferential rate might have something lower, say suppose 5%. What does it mean? If you import from certain countries, government will give us a benefit, and that benefit is lower custom duty rate, but a certificate of origin has to be obtained that goods were manufactured in the country where preferential rate benefit is given. Lot of people also plan this transaction in such a way that they try to import the goods from preferential country, just doing some value addition, so that we get a preferential rate of custom duty. This planning is also done, so they keep making these rules stricter. Plus, government also clearly provides that in case you have not claimed it while importing it, that is while filing your bill of entry, if you don't claim preferential rate, later on you cannot come back to government and say that preferential rate would have been available to me. So the claim has to be done at that particular point only. Clear with this? Okay. So this is about classification, preferential rate. Now let's talk about various rules of interpretation. The first rule is any heading. Say suppose plastic article, the first heading is articles made of polyethylene. Polyethylene heading would not be of relevance. What is relevant is the product code, that is tariff item, because entire custom tariff act is based on 8-digit product coding system. So once it is 8-digit, only then the rate or preferential rate will be mentioned. So first rule clearly provides for non-usage of heading, chapter heading, etc. Rule 2A, very important rule. It says, if there is an incomplete product having the essential characteristic of a complete product, then it will be classified as if it is a complete product. Again, if there is a incomplete product having essential characteristic of a complete product, it will be classified as if it is a complete product. जैसे कि car without tires. A car without tires is still a car. Incomplete product having essential characteristic of a complete product will be regarded as if it is complete product. Now, you cannot save custom duty by saying that car without tires is not car, so I will not pay custom duty. That's not permissible. It will be treated as if it is a car. Okay. Then, an unassembled product having essential characteristic of an assembled product will still be classified as an assembled product. This used to happen in cars again. Unassembled form. Cars were imported in unassembled form and they used to take the benefit of lower customs rate for parts of car and say these are parts of car, this is not car, because car was subject to a higher custom duty rate. Government said an unassembled product having essential characteristic of an assembled product will be treated as if it is a assembled product. Plus, anything which is mentioned in the Custom Tariff Act, it will include its mixtures as well. Say suppose gold is mentioned here, then it will include any product containing gold. That will also be covered under this particular segment. So a mixture will also be considered for that particular material. Okay. Now, say suppose you are not able to distinguish, like you have a product which has two major varieties and two major components and both the components are separately mentioned. Then rule 3 provides you for alternatives. 3A talks about specific description. It says specific description will override general description. Like if I talk about a suitcase, whether it will be considered as a bag or article of plastic. Sir, obviously bag. That's how specific description will override general description. Then we have rule 3B. 3B talks about essential characteristic. Let me give you an example. You have to see the essential characteristic and based on that you have to classify. For example, I import a software in a hardware. How will it be classified? Obviously, it will be classified as a software. The essential characteristic will override any particular mixture. Thereafter, rule 3C says laterer the better. Laterer the better. In case you cannot get the specific description, essential characteristic, like say suppose I am importing trouser and shirt. If I am importing trouser and shirt, I cannot go by specific description. I cannot go by essential characteristic. The law says laterer the better. What is laterer the better? The one which comes later in the HSN series. Say suppose there is one product which has 3978 and one which has 3990. It would be considered as 3990. Clear with this? Yes. And then we have rule 4 which talks about akin rule. Say suppose you cannot classify based on rule 2 and rule 3. In that case, the law says classify it as a nearest to the product description which is given. Akin, a product description which is nearest to it. This will be useful in case it's a new product which is being made for the first time. So try to find out the closest product to that and classify it based on that. Then we have rule 5 for packing materials. See, if there is a specific packing, like gun case for a gun. If gun case is imported with a gun case will not be classified separately. It will be classified as if it is a gun and the same rate of custom duty will be applicable as applicable for the gun. And be very careful about one thing. Say suppose gun case is imported separately. Sir, if gun case is imported separately, then obviously custom duty rate of that gun case will be applicable. So the law has given us lot of clarity on this area. While reading all this, you should also understand one thing. Can the rate of custom duty be increased by government? See, this comes from Custom Tariff Act. To change an act, you require approval of the parliament. I am asking you, can custom duty rate be increased by government? Do they have the power? The answer is yes. They have the power to increase the rate of custom duty. A special emergency power is available. Once they increase it and thereafter the parliament is in session, they have to place it in the parliament. If it is not approved there, then it will have a prospective effect. Like for the period for which you have increased it, that will be applicable, but thereafter it would not be considered as a increased custom duty rate. Sir, does the government have the power to decrease custom duty rate anytime? That is done by exemption. Obviously, that is permitted at all times. Okay. So this was about classification. In classification, what did we come across? We came across custom duty comes from Custom Tariff Act. We have rate, preferential rate, and we got through all the rules of interpretation. Thereafter, let's talk about certain cases where custom duty is not applicable. Now, there are 4 basic cases. Pilfered. Pilfered means theft in small quantity. Damaged or deteriorated. Then you have destroyed. And last one is relinquishment. Relinquishment is giving up the right over those goods. Now, let's try to understand. The benefit in case of pilfered goods, that is theft in small quantity, is available till the order for clearance for home consumption or order for deposit to warehouse is given. If any goods are pilfered before this date, in that case, custom duty is not payable. Before order for clearance for home consumption or before order for deposit to warehouse, custom duty will not be applicable. Say suppose goods are pilfered before entering into India, then import has not happened, no need of paying custom duty. Say suppose it is pilfered at the time of unloading or before clearance for home consumption or before order for deposit to warehouse, again custom duty will not be applicable. Damaged or deteriorated, you get the benefit till order for home consumption. But remember, deteriorated, the benefit is available only to the extent of unloading of goods. Only to the extent of unloading of goods. That's it. Thereafter, if you knew that it is going to deteriorate, you should not have left it at the port. Neither you should have stored it in the warehouse. You should have cleared it immediately. So, government is strict in case of deteriorated. Plus, tell me one thing. If pilfered goods are received back, if pilfered goods are received back, then obviously custom duty will be payable. Okay? Tell me one more thing. What would happen in a case where goods were damaged by the importer due to his negligence or his employee due to a negligence? In such cases, sir, custom duty is payable. Okay. What about goods destroyed? Goods destroyed, you get the benefits up to order for clearance for home consumption. And what about relinquishment? Relinquishment, you get the relief till order for home consumption or order for deposit to warehouse. So that means once it is deposited to warehouse, thereafter you don't get the power relief for relinquishment. You have to pay custom duty. Plus, we will also come across a particular case where, say suppose you imported this pen, but thereafter you found that this pen is not in conformity with the purpose. Ekdam bekar pen. No use. Now see, this has become useless. You have already paid custom duty. Now you can go to the custom authorities and claim a refund. Yes, you heard it right. In case you have not worked upon these goods and these are not in conformity or they are defective, in such cases you can go to the department and give it to them or relinquish it or destroy it, and in such cases you will get back your custom duty. A very good point which signifies consumption, that if goods cannot be used in India, government will give us a refund. That is a very, very, very big benefit which is available. Clear? Yes, sir. Now let's have a look at all these pilfered, damaged, deteriorated and relinquished cases in a small diagram which can be used before the exam. See this. When we talk about goods pilfered, it's theft in small quantity. Will we get the benefit in case of pilfered? Yeah. If it is before the port, no custom duty. At the port, no custom duty payable. So till this date, order for clearance for home consumption or till the time of deposit to warehouse, you will get the benefit. Destroyed, yes, no custom duty payable. Deteriorated or damaged, benefit available. When I say benefit available, I mean proportionate duty to the value which is left will be payable. Obviously, in case of damage, it's not completely damaged, so you will have to pay some amount of custom duty based on the value of such goods after considering the damaged portion. Relinquished, no custom duty payable. At the port, again, here I am just mentioning no custom duty payable. But say suppose you relinquish goods where an offense was claimed, like एक smuggler है, smuggler ने अगर relinquishment किया, so will custom duty be payable? The answer is obviously yes. And then it says for the star is there at two places. For the star, for deteriorated goods, only up to unloading of such goods. Sir, what about after clearance? After clearance, custom duty already paid, no benefit available. What about during transit to warehouse or in the warehouse? Now during transit to warehouse or in the warehouse, for pilfered, custom duty payable. For relinquished, custom duty is payable. In other cases, there is no need to pay custom duty. Clear with this? Yes, sir, very clear. And once you transfer it to the warehouse, you can thereafter claim the benefit for destroyed and damaged, not deteriorated, not pilfered, not relinquished. Yes? So, go through this chart. This chart will help you one day before the examination. In this video, we are going to discuss about computation in case of imports. We are also going to talk about valuation in case of imports and computation in case of export transactions. See, when we talk about value, the first thing which comes to our mind is transaction value. What's transaction value? Transaction value is the price actually paid or payable for the goods at the time of importation. So when I say at the time of importation, what's the significance of this? Please understand. Say suppose I import a particular product for 4,000 US dollars, but the prices have fallen down. Before the goods come into India, I renegotiate with my supplier and he says that I will allow you to take it at $3,500 and I get a renegotiated invoice. Now my question to you is, should I pay custom duty based on $4,000 or $3,500? The answer is price actually paid or payable at the time of importation. And importation takes place when I file bill of entry for home consumption. So while I am filing bill of entry for home consumption, the renegotiated price is 3,500, which will be considered. And be very careful about one more thing. The moment you talk about a renegotiation which is after clearing goods, that will not be of no significance, because in such cases, obviously you will not get any refund from custom authorities or government. So price actually paid or payable. And remember one more thing, with the price transaction value, certain adjustments are done. These adjustments are given in Rule 10 of Custom Valuation Rules 2007. So these adjustments are required to be done. These adjustments are similar, I would not say same, are similar to transaction value inclusions in GST. Like any charges, incidental or ancillary was added. It is similar to that. Then we have the second type of valuation, which is tariff value. See, tariff value, CBIC has got a power to notify value for certain goods or services. Obviously, services will not come. Be very careful on this. It's only goods. So, tariff value for goods which are mentioned in Custom Tariff Act, for specific goods, CBIC can decide and put a value. Now, the moment CBIC decides this value, you will have to adopt this value which is notified by CBIC. You cannot go by transaction value if CBIC has notified value for a particular product. Remember one thing very carefully. Say suppose you have imported a product for 100 rupees. CBIC says the tariff value will be 120. You will have to pay custom duty on 120. If CBIC had said 80, still you will have to pay custom duty based on 80. Transaction value will not be relevant in case tariff value is notified by CBIC. Clear with this? And there would not be any adjustments to be done in that simple reason, because the value which CBIC is giving is after considering any kind of adjustments as well. Yes? Okay. Then when we talk about a particular case of no tariff value being notified, if tariff value is not notified, no problems. You will just do transaction value and close the valuation. Now, the next question which arises is, which day's rate of exchange do you use and which day's rate of custom duty do you use? Because out of these two, what you get is assessable value. Now to this assessable value, you have to apply custom duty. You start with basic custom duty, add social welfare surcharge. Remember, social welfare surcharge is only on basic custom duty. And thereafter, on the entire amount, you add CVD under section 3(7) of Custom Tariff Act 1975. So CVD under section 3(7) is nothing but to counter IGST. So this is equivalent to the IGST rate applicable for same goods which are sold in India. Social welfare surcharge is applicable on BCD. BCD is applicable on assessable value. On all these three taken together, plus any other taxes, CVD under section 3(7) will be applicable. So IGST will be applicable on the entire amount. All three taken together, this valuation is given in section 3(8) of Custom Tariff Act. Now, what about compensation cess? If compensation cess is applicable, then compensation cess has to be charged based on CVD under section 3(9). But remember, on whatever value you are charging 3(7), the same would be the value for charging compensation cess. There is no separate valuation for compensation cess. IGST is not applicable on compensation cess. Compensation cess is not applicable on IGST. Now the question is, based on which day's rate will you convert dollars into INR and which day's rate of duty will be considered? Both are different. Rate of exchange is to convert dollar into INR or any other foreign currency into INR. Rate of duty is which day's rate of duty will be used, because custom duty rates might change. Which rate will be considered? Let's try to understand. Rate of exchange will be as on the date of filing first bill of entry. So whenever you file your first bill of entry, that day's rate of exchange will be considered. This first bill of entry can be either bill of entry for home consumption or it can be into bond bill of entry. So whatever you are filing, based on that, you have to determine the rate of exchange. Bill of entry for home consumption or into bond bill of entry. The first bill of entry which you file. Rate of duty is different. See, in case you are clearing from the warehouse, then rate of duty will be based on date of filing X bond bill of entry. Be very careful. This is where institute can confuse you. Exchange is into bond bill of entry. Rate of duty will be X bond. Be very careful. Then, in case you are clearing from the port or airport, in such cases, it would be the rate as on filing bill of entry for home consumption or entry inwards / arrival of aircraft, whichever is later. Very important word. Whichever is later. That means, in such cases, bill of entry for home consumption or entry inwards, the later of the date will be considered for rate of duty. Because, say suppose you file a prior bill of entry. Prior bill of entry meaning before the vessel has come, you file bill of entry for home consumption. So that you can clear the goods quickly. Till now, goods ही नहीं आया है. Can you use that date? The answer is no. In such cases, the law says whichever is later. So the moment entry inwards or arrival happens, that rate will be considered. Very clear with this? So remember, see this very carefully. This is where institute will confuse. Bill of entry for home consumption, here it is whichever is later. And say suppose smugglers, in case of smuggling, what would it be? Sir, in case of smugglers, that is in any other case, it would be date of payment of custom duty. The day payment of custom duty is done, that day's rate of duty will be considered. Clear with this? Yes. Say suppose there is a substitution. So I substitute bill of entry for home consumption with into bond. Any problem? No sir, no problem, because then you will consider X bond. That happens at a later point of time. But say suppose I convert into bond. First I gave into bond. Then I immediately say no, I want to clear the goods now and I file bill of entry for home consumption. Which day's rate of duty will be considered? Sir, date of substitution. When I say date of substitution, what do I mean? The day when I file that bill of entry for home consumption, that is date of substitution. If there is some error in bill of entry for home consumption, you can file an amendment. Which one will be considered? Original date or amendment? Original date will be considered. Clear with this? Yes. So this was the basic structure of how things work in case of import of any particular goods. Transaction value, tariff value, then you have assessable value, BCD and social welfare surcharge. 3739 is charge. Which day's rate of duty? Which date? Rate of exchange. Yes? Oh. Now let's move forward. Now we have to determine how do we come to this assessable value. This will be our target. Let's see how can we come to this assessable value. Now, the first thing. In case of exports, you consider the FOB price because goods are going from India. In case of imports, you consider the CIF price. So it's a long journey. When I say it's a long journey, it starts from the exporter's premise and ends at the Indian port. So all the costs from the exporter's premise till the Indian port will form part of value. There are various rules given to this. There are various transactions which can take place. Let's have a look at what transactions can take place. Now, see this with numbers. Let's start with 1. But before that, this is outside India. That is exporter's premise. And this is India, Indian port. That is import port. Correct? Okay. You incur various expenditures. See, the first thing is ex-factory price. Ex-factory price in our example is $20,000. Will ex-factory price be part of value? The obvious answer is yes. What about cost of transportation from exporter's premise till the export port? Obviously yes. What about handling charges at the export port? Obviously the answer is yes. All these three, that is 1, 2, 3 taken together is called as FOB. Now, once I arrive at FOB, I need to make some adjustments which are given in Rule 10. Now, what are these adjustments actually? Now, say suppose there is commission. That commission which is paid to a local agent, that has to be added. Remember, buying commission will not form part of value, but commission will form part of value. Any cost of additional packing, secondary packing, necessary packing, all such cases will be added. Say suppose design charges incurred outside India, yes, that will also be added. Design charges incurred in India, that won't be added in this particular case. Any material which is supplied free of cost, in that case, that material which is supplied free of cost, that will also be added. Any other cost which you are paying as a condition of sale, that will also be added. Say suppose you are paying a royalty as a condition of sale on that particular product. In such cases, again, that royalty or after sale fee will also get added to the value. Where do you adjust all these which I have just mentioned? You adjust it to the FOB. Once you adjust it to the FOB, you arrive at actual FOB. Now, once you get actual FOB, you add freight, you add insurance, and you get your CIF. Our target will always be to reach CIF because CIF is considered to be assessable value. Now, there are various other aspects which needs to be considered. First, let me tell you, any demurrage charges. Demurrage charges are incurred at the import port, will not form part of value. Any transportation from import port to the factory? No. Any landing charges at the import port? No, it will not be added. Ship demurrage. Hey, what do I mean by ship demurrage? Ship demurrage is when the bigger vessel cannot come to this place. There are some charges like ship demurrage, lighterage or barge. Barge meaning small vessels which will bring the goods from this large vessel to the port. This ship demurrage will be added because any cost up to this place will be added to value up to this place, that is CIF. Now there are certain rules given. Say suppose freight, we talk about two kinds of freight, one vessel and the second one is aircraft. Say suppose vessel actual is given. When I mean actual na, be very careful. Actual means a mixture of lot of things. I will come to it at the end. So if actual is given, then please take actuals. If actual is not given, then 20% of actual FOB. What do I mean by 20% of actual FOB? This one, this which I am making green now. 20% of actual FOB. In case of aircraft, if actual is given, see the relief given by government. Government says actual or 20% of actual FOB, whichever is lower. So government is giving me a benefit in case of aircraft, because in case of aircraft, the transportation expenditure is very high, which causes people to get discouraged of getting goods through aircraft. So that's why government has given this benefit, whichever is lower will be considered. If actual is not given, in that case, 20% of actual FOB. Okay. When you talk about insurance, if actual is given, please take actuals. If actuals is not given, in that case, 1.125% of actual FOB. Did you understand this? Yes. Now coming to the most important thing. See. Freight, loading, unloading at the export port, transport from the export premise to the export port, ship demurrage. All these together are considered as actual. This has a very important meaning. Listen to me very carefully. Now, in this example which you can see on your screen, see, freight actual is available. $2,000. This is 200, this is 600 and this is 10,000 rupees. Everything is available. And you can see that it's a vessel transportation. So if actual is given, no problem, you will just consider actual. Game over. But say suppose vessel, this $2,000 is not given. This $2,000 is not given. Now when $2,000 is not given, you cannot take actual. If you cannot take actual, what will you do? You will consider 20% of FOB. Now the moment you consider 20% of FOB, 20% of FOB includes ship demurrage, includes this export port handling charges and includes cost of transportation. That means now you will have to remove that cost of transportation, handling charges and ship demurrage. You should not consider it because it is already included in 20% of FOB. But remember one important thing. To calculate this 20% of FOB, first so you should add that 600 and 200. Until and unless you add this 600 and 200, you will not get your actual FOB. So first so you have to add it. And thereafter, when you are applying 20%, it is already considered as part of 20%. In such cases, you will have to remove that cost of transportation from the exporter's premise till the export port and any handling charges which is incurred at the export port. These two are to be removed and ship demurrage has to be ignored because it is already included in 20% of FOB. So whenever you do a comparison, be very careful. Two types of problems. One where all the information is given. Then you have to consider actuals. You will do the entire computation as required. But if one of the information is not given or it's a question of aircraft, tell me, if it's a question of aircraft, you consider actual or 20% of FOB. Now when you say actual, that actual will include everything and you will compare it with 20%. If 20% is accepted, in that case, you will have to remove these two fellows. Which two fellows? This one and this one. Because it is already part of that 20%. As it is already part of 20%, you will exclude it. This is a benefit which is available to us, and obviously we should utilize it. Clear with this? Sure. Be very careful. Keep this picture in mind and you will get the answer for your CIF. Plus, remember one very important point. What's that important point? Say suppose FOB plus freight is given to you together. If FOB plus freight is given together and breakup is not available, how will you get insurance? FOB plus freight given, how will you arrive at insurance? And breakup is not available. Then the law says apply 1.125% on this entire FOB plus freight. Apply on that entire FOB plus freight. Similarly, if FOB plus insurance is given to you and breakup is not available, the most important point is breakup is not available. If breakup is available, directly you will apply on FOB. If breakup is not available, freight will be considered as 20% of these two. Clear with this? Yes. In a normal circumstance, you would have done some mathematics and removed freight and then applied it on FOB. The law says no. If breakup is not available, then apply it on the total amount. And remember, any exportation cost after import port will not be considered as part of CIF. Cost, insurance, freight will be considered as assessable value. Clear with this? Yes. Now let's talk about valuation rules. See, when we talk about valuation rules in case of import starts with Rule 3. Valuation Rules 2007. Rule 2 is the definition clause. Rule 3 says that consider Rule 4 to 9 sequentially. That means you have to follow 4, then only you can follow 5. This is the first thing. The law also clearly says that in case of related person transaction, if you can prove that the price is not influenced, in that case, transaction value will be accepted. Plus, if there is any resale proceeds flowing to the exporter, that resale proceeds has to be added. And lastly, there should not be any geographical conditions or restrictions on sale. If there is a small geographical condition regarding selling only in South India, then that is permitted. Otherwise, there should not be any condition for further sale. In such cases, transaction value will be accepted. Otherwise, the value will be based on Rule 4 to 9 sequentially. Now, what does Rule 4 to 9 provide? Rule 4 speaks about identical goods. Now, what is identical goods? Identical goods are goods which are same in all respect, and in such cases you don't find a characteristic which is different but which does not influence the price. Then say suppose the color might differ but the price remains same. So some small variation which does not affect the price, it will be considered as identical goods. So the law says that if you are valuing a particular product, say suppose you are valuing a particular television. If you are valuing this television and you have got it free of cost. If you have got it free of cost, tell me, will custom duty be applicable? The answer is yes, because in case of custom duty, there is no need of consideration or in the course or furtherance of business. Just mere import is liable to custom duty. So even if you are importing this television free of cost, custom duty will be applicable. But here, you are getting it free, goods are not sold, price is not the sole consideration. How will you value it? The law says, value it based on identical goods. Identical goods, same TV at or about the same time when it is imported. Say suppose it is imported for $5,000, you will use the value of $5,000 for valuing this identical goods. Say suppose sir, there are multiple transactions. In that case, consider the same commercial level and substantially the same quantity. Same commercial level, substantially the same quantity. But sir, in same commercial level, if there are different prices like $5,000, $4,200, then the law says consider whichever is lower. Oh, wonderful. consider whichever is lower. So be very careful. Identical goods. First of all, identical goods are those goods which are manufactured from the same country, same manufacturer. If same manufacturer is not available, in that case, different manufacturer can also be used, but not a different country. See, you will use different manufacturer only when same manufacturer data is not available. Then you will consider the same quantity, same commercial level, and if there are different prices at that same commercial level, then the loss is whichever is lower. Plus, whenever you are talking about identical goods will never cover a case where designing is done in India free of cost. For a product for which designing is done in India free of cost, tell me that designing cost of India will not be considered as part of price. When it is not considered as part of price, that cannot be considered as identical goods. And in such cases, you are not required to do that comparison. It will not be considered as identical goods. Clear? Okay. Say suppose there are no identical goods. Then what to do? Then law says rule 5. Use similar goods, and similar goods are interchangeable. Similar goods, they are not of the same characteristic, but they have similar reputation, similar materials which are used. Then similar goods value can be used. Again, whatever you saw in identical goods, same conditions are applicable even for similar goods. So first try to find out identical goods, value it based on identical goods. If that is not available, then value it based on similar goods. If that is also not available, rule 6 does not provide any valuation. It is called as directive rule. It just gives you a direction. It says apply 7 and then apply 8. Then it says you can also request proper officer to follow 8 and then 7. Oh, wonderful. So 6 is directive rule. It says follow 7 and then 8. If you are not able to follow 7 before 8, you can request proper officer that I will follow 8 because that is more suitable to me. In which case will you do it? I'll tell you. Rule 7 is deductive value. Hey, when we say deductive value, what do you mean? See, till now we were trying to compute the value that is CIF in India. Deductive value means sale price of importer. Importer has imported that, sale price of that importer, and then you go back to CIF. Sale price will include profit margin, will include other post importation costs. All that has to be subtracted and arrived at CIF. So this is called as deductive value. It is similar to your direct tax. You learn resale price method. Yeah, it is similar to that resale price method. And then if this is also not possible, then go by rule 8, computed value. This is cost plus computed value. What is computed value? Computed value is from the exporter's premise, that is here, from the exporter's premise till you reach CIF, exporter's cost, exporter's profit, freight, insurance, you will arrive at everything and come to CIF. Sir, how will we get all this information? That's why rule 8 is normally used between related parties. See, if your holding is sending you, a subsidiary is receiving from holding, it's a related person transaction, transaction value will not be accepted. In such cases, you might go with rule 8 because you will have the information readily available. You will have the information from the holding company. You will present that and go with 8 before using 7. That's why here you can use 8 then use 7. 8. We are with this. Yes. And deductive value has a time that sale price within 90 days has to be considered. Now, if this is also not possible, then you have rule 9, that is reasonable means. Adopt reasonable means and arrive at the value. But when you are arriving at reasonable means, please don't use the export price to some other country. Don't use the domestic price of that particular country. Don't use the domestic price in India for reasonable means. Okay. Rule 10 is all the adjustments. We learned all the adjustments along with that freight, insurance, 20%, 1.125%, all that is provided in Rule 10. Coming to Rule 11. Rule 11 provides for declaration by importer. And what's the declaration which importer would give? Importer would give a declaration saying that whatever I have stated is true and correct. Finally, Rule 12 gives a power where officer can reject the value. This is a power which is available where officer can reject the value which has been declared by you. But he has to give the reasons in writing and you have to ask for it. If he does not give the reasons in writing and just reject it, then there is a case law, Gira Enterprises, which said that in such cases the rejection is invalid. Clear with this? Yes. So this is how the rules of valuation are framed. You go from Rule 4 till you touch Rule 12. Yes. Now, what happens in case of export? In case of export, you consider FOB and the calculation is very simple, people. FOB into export duty rate, that's it. And you get your export duty. FOB into export duty rate. Why FOB? Because in case of export, the price in India is considered. FOB into export duty rate will give you export duty. Normally, export duty is not there. But in some cases, it might be given. Which day's rate of exchange do you use and which day's rate of duty do you use? Rate of exchange will be on the date of filing shipping bill. Rate of duty will be based on the order given by proper officer for clearance of export goods. That day's rate of duty will be considered. Don't apply any social welfare surcharge. Don't apply CVD under section 3739. Nothing. It's a simple calculation of FOB into export duty and then you get your export duty payable. In this case, obviously you have valuation again. Rule 3 says follow Rule 4 to 6 sequentially. And Rule 4 in this says comparison. Comparison. When we say comparison, you compare the export price for one country vis-a-vis other country, and in case you are sending something free of cost, you will value the other also at the comparative value. Then Rule 5 says computed value. Obviously here computed value is easy. Cost plus profit plus any transportation expenses till you reach FOB. And finally 6 talks about reasonable means. 7 is a declaration by exporter that everything which he has stated is true, and 8 is rejection of value. See, here the officer rejects the value because you would have inflated the value. Why will you inflate the value in case of exports? To claim various export benefits. And that's why in such cases there is a possibility that officer rejects the export value where he thinks it is higher. Now, the last discussion in this is valuation in case of warehoused goods. Now, what happens in case of warehoused goods? See, when you talk about warehoused goods, you have stored the goods in a warehouse and now you are selling these goods. You are selling these goods while they are in the warehouse. See, while they are in warehouse, if you sell the goods, then GST is not applicable because it is covered by negative list. So, sale of goods when they are in the warehouse, no GST is applicable because it is covered by negative list schedule 3. But what will be the value for clearing these goods? Say suppose this belongs to A and A has sold it to B. When A is selling to B, there is no GST applicable. But when B is clearing these goods, he has to pay CVD under section 37 on assessable value plus basic custom duty plus social welfare surcharge and any other duties. This is your normal calculation for 37, or transaction value, whichever is higher. Now what is this transaction value? This transaction value is the price at which A has sold the goods to B. A has made a sale. That value, or assessable value plus BCD plus social welfare surcharge, whichever is higher. But say suppose this is half sold. Half goods are sold and half goods A is going to clear. Will this same computation apply to A? The answer is no. For A, he has to pay CVD under section 37 on assessable value plus BCD plus social welfare surcharge. And remember, for both the cases, starting point will be same. Assessable value will remain same. Don't start applying BCD on assessable value or transaction value, whichever is higher. Assessable value for both will remain same. Plus BCD plus social welfare surcharge. This is the amount on which you charge 37. You will compare this with transaction value, and whichever is higher, on that you will have to discharge CVD under section 37. Same value will apply for CVD under section 39 for the purpose of compensation cess. And these two are given in 38A and 310A of Custom Tariff Act 1975. Clear with this? Yes. A very important segment. See some questions on this. Yes. In this video, we are going to discuss some other types of custom duties. We have already discussed basic custom duty, social welfare surcharge, CVD under section 37, CVD under section 39. CVD under section 37 to counter IGST, CVD under section 39 compensation cess. Now, to protect the Indian manufacturers or the Indian industry, government can levy some more types of duties. Like government can levy anti-dumping duty, government can levy CVD on subsidized goods, and they can also levy safeguard duty. Now this is the power available with government. When we talk about these duties, they can also place some quantitative restrictions that only a particular person will be able to import that particular product. Only a particular person to this extent of quantity will be able to import that product. That is going by import licenses. That can also be done. So all these are measures so that the Indian industry can be protected. Now when you talk about anti-dumping duty, see, anti-dumping duty, when there is a case of high dumping of a particular product happening towards and affecting Indian manufacturers, in such cases anti-dumping duty is levied. How much of anti-dumping duty can be levied? Anti-dumping duty can be margin of dumping or injury margin, whichever is lower. Now what is margin of dumping? Margin of dumping, let's see it through an example. See it very carefully. Now, first we'll focus on anti-dumping duty. When we talk about anti-dumping duty, say suppose a product from US is being dumped into India because the product is no more allowed to be sold in US. So they are dumping it into India. The price at which it was being sold in US is 40,000 rupees, equivalent of INR. In India, the price of that product is 25,000. So no prudent person will sell that from US to India at 40,000. So what they do? They completely reduce the prices and start selling it here at 10,000 rupees. This becomes the export price. Now in such case, what happens is that the Indian industry gets affected. The Indian manufacturer has a selling price of 25,000, while in case of import, the cost will be only 10,000 plus basic custom duty, social welfare surcharge. Totally, the landed cost coming to 11,100. Now, in such cases, the Indian manufacturer is affected. What would government do? Government can come up with anti-dumping duty. And how much of anti-dumping duty can be levied? Margin of dumping or injury margin, whichever is lower. Both the terms have the meaning. Margin of dumping. When I say margin of dumping, normal value minus export price. See, what's the normal value of this? 40,000. Export price 10,000. So margin of dumping is to the extent of 30,000. This compared with injury margin. Injury margin is the effect which is caused on the Indian manufacturer. कितना effect हो रहा है Indian manufacturer को? Fair selling price minus landed cost. What's the fair selling price? 25,000 minus 11,100, which is the landed cost to the importer. So fair selling price minus landed cost, which is the injury margin. Now, what is anti-dumping duty? Margin of dumping or injury margin, whichever is lower. How much does that come to? It comes to 13,300 because 13,300 is lower than margin of dumping of 30,000. This is the power which is available to government. Now, when we talk about anti-dumping duty, can it be retrospective? The answer is yes. To the extent of 90 days from the date of notification, it can be retrospectively. Last 90 days, whoever has imported, now he will be liable to pay anti-dumping duty. Now, see, all this data which is mentioned on the screen will require time. It's not that the government will get to know the normal value, export price, landed cost and fair selling price in just about 1 month's time. It all takes time. In such cases, for the period, government can levy provisional anti-dumping duty. Reason being, they are also not sure of the exact number. They'll go with a provisional anti-dumping duty. So obviously, provisional anti-dumping duty is permitted. Now, once a calculation of anti-dumping duty is made, it would be valid for 5 years. Plus, government can again extend it to 5 years. So the total comes to 10 years. What happens after 10 years? Can government still levy anti-dumping duty? See, say suppose the dumping continues, they can again do a fresh analysis and levy a fresh anti-dumping duty. That's within their power. Clear with this? So this is to protect the Indian manufacturer. Now, there is one more type of duty which is CVD on subsidized goods. Say suppose some country is giving subsidy. It could be in the form of cashback for exports. It could be in the form of interest-free loan in case of export. If government is giving a subsidy so that the other country products come into India at cheaper rate. Say suppose Chinese government is giving a subsidy of 20 rupees and the Chinese person is exporting it to India at 30 rupees. The cost in India is 50. Now the question is, the Indian manufacturer is affected. Can government protect him? The answer is yes, by levying CVD on subsidized goods. And how much of CVD on subsidized goods can be levied? To the extent of subsidy. To the extent of subsidy being given, it can go up to that. Can it be retrospective? The answer is yes. Can it be on provisional basis? The answer is yes. It would be valid for 5 years and one more extension of 5 years would be allowed. Yes? Okay. Now, say suppose you are not finding any fault. Like, there is no case of dumping. There is no case of subsidy being given. In such cases, what can government do to protect the industry? This happened in steel industry where the product was being imported at 900 rupees while Indian manufacturers were selling at 1200 rupees. So obviously import was being preferred. In such cases, what would the Indian industry do? Because they are being affected just because of lesser technological upgrade and higher cost of input in India. In such cases, government can protect these manufacturers by levying something known as safeguard duty. Now, provisional basis allowed, but safeguard duty can never be retrospective. So, safeguard duty is to protect the Indian manufacturers when there is no proof of anti-dumping or there is no proof of subsidy. In such cases, government can still protect the Indian manufacturers by levying safeguard duty. Once safeguard duty is levied, it would be valid for 4 years and extendable up to 10 years. Now, let's try to understand some key points on all these. Anti-dumping duty and safeguard duty will not go together. Anti-dumping duty and CVD on subsidized goods will not go together. There will be one of these duties which will be levied, not both of them. So even if there is a case of anti-dumping plus there is a subsidy which is being given, still both cannot be applied because the dumping duty which you are applying will cover whatever subsidy has been provided by the other government. So remember one thing, anti-dumping duty and CVD on subsidized goods cannot be clubbed together. Thereafter, can we file a case against any anti-dumping duty as an importer? Because effect कौन होता है? Importer effect होता है. Importer को ज्यादा भरना पड़ेगा. Can importer go against these anti-dumping duty and CVD on subsidized goods? The answer is yes. He can file an appeal against these. Then, when we talk about any import from member countries of WTO, see, India is a member country of World Trade Organization and all these are stopping trade. Any anti-dumping duty levied will act as a trade barrier. In such cases, Indian government will have to prove that there is a actual effect which is happening on the Indian industry and that's why these were levied. Now, there is one very important exemption for safeguard duty. Say suppose safeguard duty, we talk about a SEZ or a EOU which is importing these goods on which safeguard duty is applicable and thereafter they are exporting. Should safeguard duty or these duties be levied? The answer is no. The answer is no. Because let SEZ import it and let SEZ export it. But if the SEZ or EOU gets it into India, in such cases, these duties will be applicable. So this was one exemption which is common. Now there are two other exemptions which are available for safeguard duty. And what is it? For safeguard duty, say suppose the product is being imported from one developing country. If it is being imported from one developing country and the share of that is less than or equal to 3% of the total imports, in that case, safeguard duty will not be applicable. Sir, what if it is coming from more than one developing country? If it is coming from more than one developing country, then try to club all those countries whose share is less than 3% and the combination of all should not exceed 9%, then the exemption will be available. Listen to me very carefully. If it is being imported from more than one developing country, what will you check? First, take the combination of all those developing countries whose share individually is less than 3%. So say suppose two countries have less than 3%, 2.5, 2.5. Then club them and it should not exceed 9%. So 2.5, 2.5 obviously does not exceed 9%. Yes, the exemption would be available. Clear? So three exemptions. One is a common one, EOU, SEZ. Second, one developing country does not exceed 3% of the total imports. More than one developing countries, pick up those developing countries where the share is less than 3%. The total of that should not exceed 9% of the total imports of that particular product. Clear with this? Yes. Now, from where will you start these calculations? And whether CVD on under section 937 and 39 would be applicable in such cases? The answer is yes. You remember valuation in case of GST. Any tax other than GST will form part of value. Taking the same logic, say suppose safeguard duty is charged or anti-dumping duty is charged. In that case, will CVD under section 37 and 39 be applicable on such safeguard duty and anti-dumping duty? The answer is a obvious yes. Clear with this? Yes. So CVD under section 37 and 39 can be applicable on anti-dumping duty, on safeguard duty or on CVD on subsidized goods. Now, anti-dumping duty, you will do the calculation and add it, correct? You will do this computation and add it as custom duty. Safeguard duty is applicable on assessable value. Say suppose assessable value is 10 lakh, then safeguard duty is applicable on that. But please, for God's sake, Don't apply safeguard duty on basic custom duty and don't apply basic custom duty on safeguard duty. And forever don't do social welfare surcharge on safeguard duty. Don't do that. Safeguard duty is applicable on the assessable value, but CVD under section 37 and 39, once you add everything, thereafter you will apply CVD under section 37 and 39. Hey, clear with this? Yes. So while you are comparing, remember CVD under section 37 and 39 are applicable for all the taxes other than GST and compensation cess. Okay. Now, say suppose a set of articles are imported and for a single price. In that case, what rate of custom duty will you take? The law has clarified that if a set of articles are imported for a single price, then you will take the highest rate. Clear? Okay. Now, one very important discussion is with regard to accessories. What happens in case of accessories? Accessories will suffer the rate of custom duty of accessories or the machine or the main product. That's the question. So, accessory coming with the main product and there is no separate charge. Remember, it is coming with the main product and no separate charge. In that case, it will be liable to custom duty as on main product. Be very careful. Custom duty as on main product. This has one more conclusion. Say suppose there is a separate charge for the accessory. Even if it is coming together, if there is a separate charge for that particular accessory, then accessory will suffer the custom duty rate applicable on such accessory. That also means that accessory assessable value has to be computed separately और main product का accessible value अलग से compute करना पड़ेगा. Remember this, both will have to be computed separately in case there is a separate charge for accessory. Remember it, accessory plus main product being supplied with no separate charge. In such case, accessory will also suffer the rate of custom duty which is applicable on the main product. Clear with this? Yes, this screen will help you to understand these duties well. In this video, we are going to analyze baggage post courier. See, when we talk about baggage, the main thing which you should understand is I am getting these goods while coming from outside India to India. I could be a person who has gone there for a tour. I could be a person who is staying outside India. Or it could be a tourist who lives in US but I have come for a small holiday. In such cases, there is a free allowance which is allowed. See, whatever goods are imported into India, custom duty is applicable. Charging section is very plain in customs which says any goods imported would be liable to custom duty. If this baggage rules was not there, imagine what would have happened. I have taken my clothes outside India and then I bring it in India. It becomes a case of import. I'll have to pay custom duty on that. Yes, but baggage rules provide various reliefs, including getting those clothes from outside India, plus getting some goods from outside India. To a certain extent, government has allowed certain benefits. Now, our task would be to remember all these benefits perfectly, an important area in examination. Let me just show you a small diagram which will help you to remember all the provisions regarding to baggage with respect to free allowance which is allowed. But before I show you that diagram, let me also tell you that a particular person getting one laptop who is a person aged more than 18 years, in that case, custom duty is not applicable. And what is the rate in case of baggage? 38.5%. How do I get 38.5%? 35% basic custom duty plus 10% social welfare surcharge, that is 38.5%. Plus, you should also remember that, say suppose I get a gun from outside India and I declare it, but I was unaware that custom duty is applicable. Then I say, no, I don't want to take it in India. You keep it at the custom port or custom airport. While going, I will take it back. Is it permissible? The answer is yes, that is permissible. But you have to declare it. It is not possible that if you don't declare it and then it is caught, then you say, okay, keep it, while going I will take it away. That's not permissible. So, the provision also allow us to keep the goods with the custom port airport, and thereafter, while the person is going away, he might take those goods, or in some cases, authorities might send it through post or courier. Clear? Okay. Let's see the exemptions or the free allowance which is allowed for baggage. Now, see this. First, we are talking about free allowance. Free allowance depends on who is the person coming in. Is he an Indian resident? Is he a foreigner who is residing in India? Expats? Or is he a tourist of Indian origin? If he is one of these and not coming from 3 specified countries, he will get a free allowance of 50,000. Sir, which are those 3 specified countries? These are basically connected through land route, and there might be lot of cases of custom duty evasion, and that's why government has very clear that for Nepal, Bhutan and Myanmar, it would be 15,000, and only if it is through air. It is through air, not by land route. Okay. If it's a tourist of foreign origin, whether he is coming from these 3 through air or through other countries, 15,000 free allowance is permissible. Now when I say free allowance, इसका मतलब क्या हुआ? इतने value तक का product you can get into India. Now, there are free allowance limits. Free allowance में you cannot bring certain things. That is mentioned in Annexure 1. Now, what you can't get is mentioned in Annexure 1. First one is firearm. Second one is cartridge of firearm in excess of 50 units. So, up to 50 units, you can get it as part of free allowance. More than 50 units, no, that would not be part of free allowance. Cigarette, 100 units allowed. More than 100 units will not form part of free allowance. Cigar, 25 units. Tobacco, 125 grams. So, these are to be read in combination. Alcoholic liquor, 2 liters. Gold or silver other than ornaments. Be very careful. Ornaments are allowed in free allowance, but gold bullion, silver bullion, that is not allowed in free allowance. You will have to pay custom duty on that. Flat TV, be it LED, plasma, LCD, doesn't matter. It is not allowed as free allowance. Okay, these are mentioned in Annexure 1. The first 3 which you say, full rate of custom duty will be applicable if it is more than these limits. And let me tell you, the full rate of custom duty can range from 60% basic custom duty to 150% basic custom duty in certain cases. So that's why firearm, cartridge, cigarette, cigar and tobacco, full rate of custom duty will be applicable if they are more than these limits. And for an infant, used personal effect is allowed. And who is an infant? Less than 2 years. Plus, with this free allowance, you also get some more benefits. One is you can get used personal effect. You can get one laptop if the person is 18 years or more. Travel souvenir, and the rate of custom duty is 38.5%. This is the baggage rate. Now, let's see a small example. Say suppose firearm, I get it, the value is 70,000. Can I claim free allowance? The answer is no. Nahi milega free allowance. Plus, full rate of custom duty will be applicable, not 38.5%. Hey, 38.5% is very low for firearm. Then so people will start getting firearm as part of baggage. And that's why highest rate or the actual custom duty rate will be applicable. Let's take an example of cartridge. Cartridge of a firearm. Cartridge of a firearm up to 100 units which I have got for 2 lakh. See, what is permissible? 50 units. So 50 units to that extent 1 lakh. Balance 50 units to that extent 1 lakh. The first 1 lakh that is relatable to 50 units will form part of baggage. That means if the baggage is valued at 1 lakh, that is 50 units, I'll get a free allowance of 50,000 and on balance 50,000, I have to pay 38.5%. And what about balance 50, 1 lakh? No benefit available. Full rate of custom duty will be applicable. Are you very clear with this? Yes? Yes. Be very careful. Remember this. Firearm, cartridge, cigarette, cigar, tobacco, alcoholic liquor for human consumption, gold, silver other than ornaments, and flat TV. Yes? Okay. This is the free allowance which is allowed to everyone, irrespective of the stay outside India. Doesn't matter. Irrespective of the stay outside India. You might stay outside India for 2 days, 1 day, 3 days, doesn't matter. You will be eligible for this free allowance. Now let's talk about additional allowance which are allowed for certain cases. Say suppose a professional is returning into India. A professional, a person who was working outside India, he is returning to India. See, when he is returning to India, obviously he would have lot of things at his home outside India. He might bring all that. In such cases, the additional allowance is much higher. And obviously, this is only for used household and personal effect. That's it. And remember one thing, gold, jewelry wearing and coming into India, that is not personal effect. The law clearly says that it is not personal effect and you can never club the free allowance of 2 persons like Mr. A, Mrs. A, both. You take it as 1 lakh. That's not permitted. That's not permitted. It has to be done separately. So say suppose I get a music system of 70,000. I can't break it between Mr. A and Mrs. A. One of them have to take it in their account and free allowance will be 50,000, on balance 20,000. Custom duty will be payable. So coming back to this additional allowance. Additional allowance for household effects, used household effects, bringing into India, depends on the stay outside India. If you have stayed outside India for more than 3 months but up to 6 months, in that case 60,000. More than 6 months up to 1 year, 1 lakh. 1 year to 2 year, you get 2 lakh, and more than 2 years to the extent of 5 lakh. Say suppose I have stayed there for 23 months. 23 months meaning less than 2 years. In that case, can I still claim 5 lakh benefit? The answer is yes. Government has given such power to the officers to condone delay for certain cases. Similarly, if you are just near about that and you have grounds, sufficient cause, you can claim a higher exemption or additional allowance. That is at the discretion of the officer to allow you. Clear with this? Yes? Okay. When we talk about jewelry, there is one exemption for jewelry. Remember, this is for jewelry. This is not for gold or silver. In bullion, it is only in case of jewelry. Now, how much is available? For men, 20 grams or 50,000, whichever is lower. Women, 40 grams or 1 lakh, whichever is lower. Be very careful about this, whichever is lower. Obviously, these limits have become redundant now because if you see the 10 gram price today, obviously it does not make any sense today. But that's what the exemption deals with, 20 grams or 50,000, whichever is lower. You know which is going to be lower, 20 grams or 50. Obviously, what is going to be lower is 50,000. Clear? Okay. Now, this was about baggage. When we talk about unaccompanied baggage, remember one thing. In case of unaccompanied baggage, free allowance is not given. But any benefit like used personal effect, travel souvenir, all that will be allowed if unaccompanied baggage comes on time or the person who has first brought the baggage and then he is going to come, if he comes within time. Now, say suppose the baggage has come. If the baggage has come, then the person can arrive within 2 months from the arrival of the baggage. So baggage has come first, person has to come within 2 months. If the person does not come within 2 months, in such cases, what would happen? In such cases, an extension can be taken if there are exceptional circumstances, natural calamity, COVID. In such cases, obviously an extension would be allowed. What happens if the person has come first and then baggage? Baggage has to be dispatched from the other country within 1 month. See, these unaccompanied baggage are cases where I come from flight, but I don't bring entire baggage through flight because the expenditure would be very high. So I route it through vessel. In such cases, it is unaccompanied baggage. So unaccompanied baggage has to come within this time limit. What's the time limit? If baggage has come first, in that case, the person should arrive within 2 months. If person has come first, in that case, the baggage has to be dispatched from the other country within 1 month. These limits can be enhanced by ACDC. That's a power which is available to them. Clear? Yes. Plus, a crew member of a flight or of a vessel does not get these allowances. They get this only at the time of leaving their service. At that point of time, they will get it once. Otherwise, they keep coming and going from outside India to India. Every time when they come, will they get this free allowance of 50,000? The obvious answer is no. The allowance which is allowed to crew members is to the extent of 1,500. They can bring some chocolate, cheese, some small products, some small gifts. That is permissible, not more than that. Clear? Yes? Okay. This was regarding baggage. This diagram will help you one day before the examination. Now, when we talk about stores, see, what do we mean by stores? Stores are supplied to a vessel or aircraft for their transit. This could include food, this could include oil, this could include other safety equipment which are there on the vessel or aircraft for usage. So stores can be of two types. One, it could be a domestic store or it could be an imported store. Say suppose it's a domestic store. See, we are the manufacturers or we are the importers, and we are supplying these stores to the vessel or aircraft. Understand the purpose. And this vessel is a foreign going vessel. When I say foreign going vessel, what do I mean? When I say it's a foreign going vessel or aircraft, in such case, it is to depart from a place in India to a place outside India. That's what is the meaning of foreign going vessel. It can touch any intermediate port in India. It will not be affecting its status of foreign going vessel. Like a ship is going from Chennai to Mumbai and then going to US. Just because it is coming to Mumbai does not mean it loses its status of foreign going vessel. Whether or not it is touching an intermediate port, it will still remain a foreign going vessel. But it should not carry coastal goods. Now what is the meaning of coastal goods? Obviously, coastal goods means domestic goods. It should not carry domestic goods from Chennai to Mumbai. In that case, it becomes a coastal runs. Now, when we talk about supply made to a foreign going vessel, obviously it is regarded as export. When the manufacturer is selling it, it is domestic stores being supplied. GST will not be applicable. Correct? If it is supplied to a foreign going vessel. Say suppose there is an importer who has imported oil from Saudi Arabia and he is supplying this as imported store. Obviously, again, no custom duty will be applicable on such imported store. But it has to be supplied to a foreign going vessel. If it is supplied to a vessel which is carrying out a coastal run, that is, it is carrying some coastal goods, in such cases, GST will be applicable, plus that importer storing that oil in a warehouse is also required to pay custom duty. Okay. Sir, what if importer has imported oil and already paid custom duty and then he is supplying this to this particular vessel? If he has already paid custom duty and then he is supplying it to this vessel, then he can claim something called as duty drawback, and that too to the extent of 100% of the custom duty paid. This is the benefit which is available. So normally what happens is the importer keeps it in the warehouse. Oil which is to be supplied to the foreign going vessel is kept at the warehouse without payment of custom duty. That into bond bill of entry. You file into bond bill of entry, store it in the warehouse, and from the warehouse you supply it to the foreign going vessel. If you have already paid custom duty and then you are supplying, then you can claim a duty drawback. And will GST be applicable on such imported store? Obviously the answer is no. But the moment it is any thing other than foreign going vessel, in such cases GST would have to be charged. Clear with this? This was a small discussion in case of stores. Now, what happens in case of post or courier? See, can you get goods from post or courier? The answer is yes. Now, when you import goods through a post or courier, do you file bill of entry for home consumption? Into bond bill of entry, ex bond bill of entry? The answer obviously is no. So, in that case, who clears it? In case of post or courier, clearance is done by the postal authorities on our behalf. Postal authorities clear these goods on our behalf. When I say postal authorities clear these goods on our behalf, the question is, do the postal authorities have a power to check the goods in case they find any suspicion? The answer is yes, they have a power. See, officers obviously have that power to check the goods. But do the postal authorities also have the power? The answer is yes, postal authorities can check that particular parcel. But before checking, they will have to inform the importer saying that at this point of time, at this place, we are going to open the parcel. If you come, we'll open it in front of you. If you don't come, we will still open the parcel. Postal authorities have this particular power. Now, the question is, which day's rate of duty will be applicable? See, rate of duty in case of imports will be on the day when list is submitted to proper officer. And who submits this list? The postal authorities. Postal authorities submitting the list to proper officer. But is it possible that the postal authorities have submitted this list before the vessel has come into India? Nothing. List submitted before the vessel has come into India. In such cases, the day when the vessel comes, that would be regarded as the applicable date for determining rate of duty. So be very careful. In case you submit the list before the vessel has come, then the date of arrival of vessel or aircraft will be considered for the purpose of finding the rate of duty. This is same as that bill of entry for home consumption or entry inward / arrival of aircraft, whichever is later. Okay. Now in case of exports, which day's rate of duty will be used? In case of exports, rate of duty will be based on the day when the person hands over or gives the article to postal authorities. The day that article is given to the postal authorities, that day's rate of duty will be considered in case of exports. A very simple reason for that, because postal authorities will have to determine the export duty, if any, and collect it at that point of time. So the day the article is delivered or given to the postal authorities, that day's rate of duty will be considered. So be very careful with regard to this rate of duty. Can be asked for MCQs. Yes, so we have discussed baggage, we discussed stores, post and courier. In this video, we are going to learn about assessment in case of customs. See, when we talk about assessment in case of customs, the term assessment means to determine. Now, this term assessment has been widened. It includes determination of value, determination of any classification, determination of origin, determination of any other factor which affects the custom duty payable. They have widened the scope so that assessment has much wider scope when the proper officer is assessing the duty or you self-assess the duty. Now, Section 17 of Customs Act 1962 deals with self-assessment. Self-assessment, I as an importer file a bill of entry for home consumption, it is assessed. At present, government is also moving towards faceless assessment where the assessment of that particular bill of entry can be done by any officer who is in any other place, not just at that particular custom port or airport. Now, it would all be done online. He would send you a query online, you would reply to it online, and he would pass a order online, which is order for clearance for home consumption. Say suppose he finds there is a short payment. If there is a short payment, in case he will intimate that short payment. If you agree, then you will pay that short payment amount and close the matter. If you don't agree, he will pass a speaking order. Plus, a new section has been introduced where custom officers also have the power to carry out any audit. That's a particular provision which can be exercised in any case. So the powers of audit are much wider at present. Thereafter, you have a very important discussion of Section 18 that deals with provisional assessment. Now, when we talk about provisional assessment, see what is the basic purpose of provisional assessment. When I am unable to determine the custom duty payable, I will go for provisional assessment. This is the normal rule. So, under GST, when I am unable to determine my GST payable, I go for provisional assessment. But under customs, I as an importer can go for provisional assessment or officer can also provisionally assess the custom duty payable. There are 4 cases where officer can provisionally assess custom duty. And say suppose I want to clear for home consumption, then I will clear the goods for home consumption after paying that provisional assessment duty. And if a bond is required, then that bond will also be given. Say suppose I want to store the goods in the warehouse, then I have to file into bond bill of entry based on the provisionally assessed duty along with twice the duty amount as bond. Here the provision still deals with twice the duty amount under Section 18. Then what would happen? Then I would submit all the documents to the proper officer. There is a time limit for that and proper officer has to pass an order. There is a time limit for that as well. Now, once final assessment happens, see there can be 2 cases. 1, I have short paid duty. Second, I have excess paid duty. If I have short paid duty, such cases, I will have to pay the duty along with 15% per annum interest from the first day of the month in which provisional assessment was done. Be very careful in this. Lot of times it's asked in the exam. First day of the month in which the provisional assessment was done. But when it comes to refund, I will get 6% per annum after the expiry of 3 months from the date of final assessment. After that, if there is still delay, then I will get interest at 6% per annum. If the goods are still in the warehouse, then what would happen? If the goods are still in the warehouse, then say suppose I have short assessed. In that case, I will have to give more bond. If there was an excess bond already given, then nothing is mentioned in the provision. Then that bond will continue as it is. Now let's see the timelines and let's see the cases where officer can go for provisional assessment. See this very carefully. Now, firstly, we will see the cases where provisional assessment can be done. The first case, when you see GST, for GST it's only one case, whenever I am unable to determine my GST payable. But in case of customs, first case is where importer is unable to determine custom duty payable And then you have proper officer. Proper officer can also go for provisional assessment. First, when he thinks a chemical or other test is necessary, or he thinks a further inquiry is to be made even when I have produced the documents, or a case where I have not produced the documents and he feels a further inquiry has to be carried out. So these are the cases where provisional assessment can be done. 4. I myself go for provisional assessment. Second, proper officer can go in case he thinks a chemical or other test is required. Third, further inquiry where documents are produced. Further inquiry where documents are not produced by me. And if I were to clear the goods for home consumption, in that case I will pay the custom duty and give a bond as required by proper officer. If I were to store the goods in the warehouse, then bond twice the duty amount. And how does the process look? Be very careful about the process. This is new process. Custom rules have been notified for this finalization of provisional assessment rules. What is the process? Proper officer will intimate me within 15 days saying that these are the documents which he requires. This is step 1. Second, importer has to submit all the documents within 1 month, plus one extension of 3 months, plus one more extension of 3 months. And what is the time limit for proper officer to pass the order? The time limit for proper officer to pass the order is 2 months plus one extension of 3 months. So from the day the time limit for submitting the documents expires, or I have submitted all the documents, from that time the time for proper officer starts. And for the proper officer, the time limit is 2 months plus an extension of 3 months is also permitted. Clear? This will quicken the process. In GST, what is the time limit? In GST, the time limit is 6 months plus 6 months plus another extension of 4 years. Total comes to 5 years. Clear with this process? Okay. Going to the last segment, final assessment order. See, if I have already cleared the goods for home consumption and I have made a excess payment, in such cases I am eligible for refund at interest 6% per annum after 3 months from the date of final assessment. Be very careful. Everywhere the law uses 3 months from the date of receipt of refund application. But here 3 months is from the date of final assessment. Okay. If there is a short payment made by me, in such cases, I have to pay the difference amount along with interest at 15% per annum from the first day of the month in which provisional assessment was made. If the goods are still in warehouse, if I have given an excess bond, nothing is mentioned. If bond amount falls short, then I have to give bond twice the duty amount. Are you clear with this? Yes. So these were the cases. Then we moved on to what happens in such cases. Thereafter a process, and finally what happens once final assessment order is given. Yes. Clear with this? A very important discussion. See this entire chart once before your examination. In this video, we are going to discuss some critical areas of exemption under customs, refund under customs, and also some miscellaneous provisions which are important from examination point of view. The first discussion is with regard to exemption. See, again, exemption section 25 of Customs Act 1962 provides for a power where central government can provide an exemption with regard to any goods which is mentioned in Custom Tariff Act 1975. Now, when we talk about exemption, the law provides a power to government to change the method while giving an exemption. I'll give you an example. Say suppose a particular product at rupees 100 and has a basic custom duty of 10%. So what is the basic custom duty? Sir, basic custom duty is 10 rupees. Government can give exemption in two forms. One, they can reduce this 10% to 4%. This is one kind of exemption. Second kind of exemption is government can say that you have to pay basic custom duty of 3 rupees. Now when they say basic custom duty will be 3 rupees, in such cases You are changing the method and giving an exemption. Is this permitted? The answer is yes. Exemption can be given by way of reduction in the same method or by any other method. But while giving exemption, can government say that this will be 12 rupees? The answer is no. Never can an exemption cross the statutory duty. Statutory duty is 10%, that is 10 rupees. It can never cross that. See, when is this form of exemption given? This is given in case of petrol, diesel and certain other products where the exemption might be given based on quantity. So the government might say that the exemption in case of petrol, you have to pay only 3 rupees per liter as basic custom duty. This is a valid exemption. So changing of percentage or form is allowed as an exemption. Now, what is the meaning of notify? See, notify would mean when that particular exemption has been notified in the official gazette. The moment it is notified, it would be regarded as effective until and unless the notification says that it will be effective from a future date. Okay. Then talking about refund. See, the time limit from the relevant date to claim refund in case of customs is 1 year. And remember one very important principle in case of refund, unjust enrichment. Obviously, you are required to prove that the person has not unjustly enriched himself. One of the cases which is there and very important is, say suppose you have debited a particular expenditure in profit and loss account. In such cases, you have included it in your cost. Now you have already charged more from your buyer as it is included in your sale price. That means you have passed on the duty incidence to the other person. If you have passed on the duty incidence to the other person, you will not be eligible for refund, because any kind of refund under customs or under GST is subject to the principle of unjust enrichment. A person cannot enrich himself at the cost of the other person. Okay. When you talk about provisional assessment, yes, you can claim a refund within 1 year from the date of final assessment. If you are getting a refund from a judgment, 1 year from the date of such judgment. In case of purchaser other than importer, obviously 1 year from the date of purchase. In any other case, it would be 1 year from the date of payment of custom duty. Now, say suppose you have paid export duty. See, normally export duty is not applicable, but say suppose a particular product when exported had export duty. Nothing to do with GST paid on export. This is export duty under customs. If you have paid export duty and then the other person returns it to you. Now say suppose the other person has returned it to you. In that case, can you claim a refund of this export duty? The answer is yes. But the time limit for claiming refund for export duty is 6 months from the date of filing order for clearance of goods for home consumption. That means that goods which come back now, you will clear those goods. You get 6 months time for filing the refund application. Be very careful about this point. Plus, it should not be a case of resale. It should be a case of return. Only in such case, export duty can be claimed as refund. Yes? Okay. Any goods imported from personal use? Obviously, no need to prove unjust enrichment. If there is a case of duty drawback, what do you mean by duty drawback? There is a discussion on duty drawback. But what happens in case of duty drawback? In case of duty drawback, I get a particular benefit from the government. What kind of benefit? Say suppose I import a particular product and thereafter I have exported that particular product. In such cases, whatever I paid as custom duty on purchase will be allowed as duty drawback. This is a benefit which is available throughout. Now, duty drawback, the time limit is 3 months plus 3 months plus 6 months. And the principle of unjust enrichment does not apply because I am only the purchaser and I have exported it. Clear? Yes. These were the cases of refund. Do you get interest in case of delayed payment of refund by department? The answer is 6% per annum after the expiry of 3 months from the date of filing refund application. Plus, there are cases of project imports. Now, in case of project import, there is no kind of refund on the deposit which you pay. See, sometimes project imports is where I am trying to import a number of products for setting up entire power plant in India. I cannot assess custom duty for each product separately. So I will ask CBIC saying that give me a particular rate based on which I can import everything under project import. The government would give me this particular project import rate. The moment project import rate is given, I will have to make a deposit money. That deposit which I make, will I get interest on that? The answer is no, because that is not custom duty. Clear? Okay. And don't forget one important judgment in this, which clearly provides that in case I have paid an amount of custom duty when a product was exempt. Say suppose the product was exempt. In such cases, if I have paid custom duty, that is not at all custom duty. Now when I say that is not at all custom duty, the time limit of 1 year will not be applicable. Yes? Sure. So this particular point was held in the judgment of Parimal Ray, where it was clearly provided that in case a product was exempted but still I have paid custom duty, then that's just an amount which I have paid to government and I should be eligible for refund without applying any limitation of 1 year. Yes? Okay. Then coming to an important discussion with miscellaneous provision. See, is it possible that I export this particular product and it comes back for repair? I export this, it comes back for repair. Now when it comes back to repair, should I pay custom duty on this because it has been imported? The answer is no. But you will have to re-export this after repair within 6 months, extendable up to 1 year. In that case, custom duty will not apply. I exported this, I got it back for repair, I did the repair and I am re-exporting it. Within 6 months, I have to send it back, extendable up to 1 year. Clear? Okay. Say suppose I have imported this. This is a machine. I have imported this. Now this machine was defective. I exported it back for repair and thereafter I get this back. Will custom duty again apply on this particular import? The law says that custom duty will be on the fair cost of repair plus any material used plus to and fro, freight and insurance. Jaane ka freight, aane ka freight. Jaane ka insurance, aane ka insurance. On this entire amount, the custom duty would be charged. But remember, same thing should come. Say suppose a new machine comes. In that case, on that new machine, custom duty will be applicable again. Sir, but that is wrong. Now it would be double taxation. No. See, this machine I imported. Thereafter, I am sending it back because it was defective. I should claim a duty drawback. Thereafter, when I get the new machine, I will again have to pay custom duty. Clear with this? Yes. But this machine should come back within 3 years, extendable up to 5 years after repair. Let's have a look at this particular discussion which we just had. Export and import transaction. Say suppose there is an export, re-import and then re-export. I have re-imported and then I have re-exported. Government says no need to pay export duty benefit back, but you have to export it within 6 months. Say suppose there is a return. If there is a return, that is export and then re-import. Export duty paid, I can claim a refund, and if I have claimed any export benefits, that has to be returned to the government. Okay. I imported and then exported, I can claim a duty drawback. I imported, exported it for repair and then I re-imported. Custom duty on the fair cost of repair plus any material used plus to or fro freight and insurance. And the condition given in the law is re-import within 3 years, extendable up to 5 years. Very important point. Now, what in case of derelict, jetsam, flotsam, wreck? What is derelict? Derelict is goods which are abandoned in the sea or thrown in the sea without any hope of recovery. Say suppose there is a high tide and the vessel is not able to move forward. Ship आगे ही नहीं बढ़ रहा है. In such cases, goods will be thrown out. Some goods will be thrown out. That is called as derelict. Now, goods which are thrown out, if it floats, it's called as flotsam. If it sinks, called as jetsam. And if the vessel is broken, called as wreck. Now, any of these also coming into India or brought to India will be subject to custom duty, and the person who declares himself to be the owner will be regarded as the importer, and he will have to complete the formalities of paying custom duty. Otherwise, the authorities will auction it and the person who purchases it in auction will become the owner. Clear with this? Yes. So this is about export and import transaction. Very important point. Revise it correctly. In this video, we are going to discuss duty drawback, a very important topic from examination point of view. See, when we talk about duty drawback, there can be two cases. One, I import this material and I export this. I get a duty drawback on custom duty paid on import. Second, I import raw materials or I use domestically used products. I manufacture a product and then I export it. I'll get duty drawback of the custom duties paid and taxes incurred on various raw materials and various purchases made for that export product. Section 74 deals with duty drawback when same goods are exported. See, in both the cases, goods can be exported by post, goods can be exported through courier, goods can also be exported through vessel or aircraft by filing a shipping bill. Section 74, same product. Section 75, different product. That's the difference. Section 74 can be before use. If you export it before use, you get 98% as drawback. In case of supply of oil to foreign going aircraft or in case of supply of oil to Indian Navy, you get 100% of duty drawback. If you export the goods after use, obviously if it is exported after use, then you get something lower. Say suppose the usage is for 0 to 3 months and this 3 months is counted from the date of clearance of goods for home consumption. The time from when you have cleared the goods for home consumption and the export shipping bill date. 0 to 3 months, you will get 95%. 3 to 6, 6 to 9, 9 to 12, 12 to 15, 15 to 18 and then more than 18. More than 18 is nil. 15 to 18 is 60, which is even the exemption percentage for chartered accountancy. Any paper, 60. So thereafter, 85, 75 and then twice you reduce it by 5. This is how I remember it. See, I remember 95, nil and 60. At the inception, the depreciation will be higher. So 95 reduces twice by 10%. So 95, 85, 75. And then 5 to reach 60. And after 18 months, if you export after use product, in that case, you will not get even a single rupee of duty drawback. So this percentage is the percentage of custom duty which you have paid at the time of import. The time limit for export is 2 years. The time limit for filing application of duty drawback is 3 months plus 3 months and extendable to another 6 months. Totally, you get 1 year. Now, time limit in case of export 2 years, but sir, after 18 months I get nil. Obviously, this 2 years will help you in before use. Without use, exporting, you can get the duty drawback to the extent of 98%. These are identifiable. Section 74 deals with goods which are identifiable proper officer can identify that this was the product which was imported and this is the same product which is being exported. Yes? Okay. When we talk about section 75, product manufactured and thereafter exported. See, every time you will have all industry rates given for the products. All industry rates is the rate given by government that this much of custom duty I will refund it to you as duty drawback. All industry rates are fixed for most of the standardized products. But say suppose I am manufacturing a product for which all industry rate is not there. What in that case? I can apply for a brand rate. And say suppose I am not satisfied with the all industry rate, then I can go for a special brand rate. But what is the level of satisfaction? The level of satisfaction is less than 80% if you have got. In that case, you can apply for special brand rate. If you are getting 80% or more, please don't go to government and say, no, I want more. What is this 80% or more? The custom duty which you have paid or the taxes which you have paid on purchase. If you are getting to the extent of 80% or more, then you cannot apply for special brand rate. Otherwise, you can apply for special brand rate. These can be in the form of percentage of FOB, or it can also be in the form of value. Hey, when I say value, what do I mean? It could be in quantity. Say suppose the amount is 200 per kg. That is also a form of duty drawback. So percentage of FOB or 200 rupees per kg depending on the quantity which is exported. Both the methods are to be decided by government. Government will mention AIR depending on the nature of the product. So section 74, same product. Section 75, manufactured and then you have exported it. In such cases, you will get all industry rate, or you can apply for a brand rate, or you can also go for special brand rate. Now, are there some conditions? The obvious answer is yes, there are some conditions. Section 76 first provides for two conditions. Less than 50 rupees, no drawback. Plus, no drawback in case market price of the product is less than the duty drawback. Imagine the market price is less than the duty drawback which you are claiming. That means you have inflated the FOB so much, you are actually sending goods at a very high value transaction, but the market price of that product is very low. In these two cases, you will not get even a single rupee of drawback. This section 76 is applicable for both 74 as well as 75. Now, say suppose government does not pay you drawback within 1 month. In that case, you will be eligible for a refund along with 6% per annum interest after the expiry of 1 month. See the difference. GST, 60 days. Customs, all cases, 3 months. Duty drawback, 1 month. So, duty drawback, government is trying to give as much as benefit possible. But, say suppose a person has taken duty drawback fraudulently, then he has to pay interest at 15% per annum from the date he got that drawback till the date of payment of that drawback back to government. Okay. Thereafter, there are some additional conditions for section 75. Like, some cases, there will be a requirement of minimum value addition. If minimum value addition is not met, in that case, you will not get even a single rupee of drawback. Second, if there is negative value addition, then no drawback. What do you mean by negative value addition? Negative value addition means you have spent $2,000 for getting raw materials and you are exporting for $1,800. That means you have made a negative value addition. Your CIF of import while bringing the raw material and bringing other required products was $2,000. So you have spent $2,000, but your export is $1,800. In such cases, no drawback will be allowed. So in some cases, government can mention minimum value addition. Say suppose government will say at least 40% minimum value addition. So for $2,000, 40% would be 800. So at least export should be $2,800. Only then you will be eligible for drawback. And then the maximum drawback is equal to 1/3 of market price. 1/3 of market price. You cannot go beyond 1/3 of market price. But be very careful. If market price is less than drawback, then so you will not get even a single rupee of drawback. If it is more, then it is still subject to 1/3 of market price. These three conditions are only applicable in case of section 75. And you can also go ahead and file a supplementary claim. Say suppose you have wrongly claimed a lower drawback. In that case, you can file a supplementary claim and claim that balance amount. There are timelines given. 3 months plus 9 months plus 6 months is the time limit for supplementary claim. So government gives various timelines for us to claim duty drawback. Even if we have short claimed in certain cases where we apply for special brand rate, or we have short claimed, or government has retrospectively revised the drawback rates. In all such cases, we can file a supplementary claim. And remember, while claiming section 75, shipping bill is deemed to be claimed for drawback if you have mentioned that this export is under drawback. Yes? Okay. Let's have a look at all the provisions which we have discussed. Now, except for supplementary claim, this has all the provisions. You can use this one day before the examination to recall everything. Let me quickly take you through this. First case, imported goods, section 74, being exported. If it is exported before use, 98%, however 100% in foreign going aircraft or vessel. 0 to 3 months, 95%, and then it goes on more than 18 months. Not even a single rupee of drawback is permitted. There are some exclusions for after use in case of clothes, in case of X-ray, tea chest, the boxes in which tea is stored, cinematographic films, papers and plates, after use being exported, not even a single rupee. Time limit for export, 2 years, and there can be an extension by CDIC. What is the time limit for filing duty drawback claim? 3 months plus ACDC can extend it by another 3 months plus 6 months extension by commissioner. When we talk about section 76, 2 cases where drawback is not allowed. Less than 50 rupees or market price is less than duty drawback. Section 75 implies import goods, processing, and then manufactured product being exported. All industry rate, government notified rate, brand rate when AIR is not available, and special brand rate when you are not satisfied with the all industry rate which is given by government. All industry rate is less than 80% of actual, only then you can apply. If it is 80% or more, then you cannot apply. 3 conditions: no duty drawback in case of negative value addition. In certain cases, you will have to meet minimum value addition, and maximum drawback is 1/3 of market price. And then you have interest. Interest, if fraudulently taken, 15% per annum. If you have not received drawback after claim, 6% per annum after the expiry of 1 month from the date of filing application. So this entire diagram will help you one day before the examination. Okay, clear with this? Yes. So this was about duty drawback.
Now let's talk about warehousing. This is a warehouse. Basically, this is a custom warehouse where you file an into bond bill of entry and you give a bond which is 3 times the duty amount. And then the officer will give a order for deposit to warehouse. Once he gives a order for deposit to warehouse, you can store it in the warehouse. Generally, it is done either to export from the warehouse, or when a person is not having the requisite funds to pay custom duty, then in that case First he will transfer it to warehouse, then clear it from there, because port has very high demurrage, that is very high rent. Now, once you file into bond bill of entry and transfer it to warehouse, then you can get this removed either by filing X bond bill of entry and payment of tax. Second option is filing a shipping bill and exporting it. In that case, you will not have to pay taxes on the import because the consumption has not happened in India. It was imported in the warehouse and now it is exported. And the third case is re-warehousing. Re-warehousing, it is possible that the warehouse in which you are storing the goods, the license of this warehouse has been cancelled. Then in that case, you can transfer it to another warehouse with the approval of the officer. In fact, once the registration of a warehouse is cancelled, then within 7 days you will have to move the goods or an extension can be taken. Now, there are totally 3 types of warehouses. Public warehouse, that is owned by government, private warehouse owned by other than government, and special warehouse. Special warehouse is where you can store only certain products because it is under customs lock, gold, silver. These products, if you want to keep it in the warehouse, it has to be kept in the special warehouse. Section 57 of Customs Act deals with public warehouse, 58 private warehouse, and 58A deals with special warehouse. Plus, whenever you store the goods, the time limit for which approval is given for storage is 1 year. Plus, you can seek extension from commissioner and each extension will not exceed 1 year at a time. Now, you are storing the goods in the warehouse. Then when you clear, will interest be applicable? The answer is yes. Interest at the rate of 15% per annum after 90 days from the date of order to deposit or for deposit to warehouse. That means first 90 days from the date you get this order, not the day you deposit, from the date you get the order, from there you get 90 days interest free period. After 90 days, interest will start applying. So what you can do is, when you get a order date, there will be a payment date as well. When you have paid the custom duty, calculate the number of days, then subtract 90 days. You will never go wrong in days calculation. Not even a single day difference will be there. Plus, remember that this interest will be applicable only on the custom duty which is payable at the time of clearance. Say suppose there is no custom duty payable because you exported the goods by filing shipping bill. Then in that case, custom duty payable on these goods is 0. As the custom duty payable is 0, there will be no interest applicable on this transaction. Plus, CBIC has a special power to waive off any interest for certain class of registered persons or certain class of goods, that is left to the discretion of CBIC. Then the next point is, can you give a general bond? Yes, general bond can be given, where instead of giving a bond every time, you give a 1 crore rupees bond. And then whenever you bring it in the warehouse, it gets debited. 3 times of the duty will get debited. When you clear it from the warehouse, again that 3 times of the duty which was earlier debited will get credited, and a running balance can be made. You'll also don't have to give the bond again and again. Then who is responsible? See, the primary responsibility is always on the importer. So if there is any mishap or mismatch in the goods which were stored vis-a-vis at the time of clearance, then the primary responsibility to pay tax, interest and penalty is always on the importer. But a secondary liability is also created on the warehouse owner, and the liability is created saying that if goods are removed by other than these three methods. See, if the goods are there in the warehouse, no liability even secondary on the warehouse owner, because there is no mistake on his side. But if the goods are removed by other than these three cases, then in that case warehouse owner may be also responsible. Obviously first government will try to catch the importer, the secondary liability is on the warehouse owner only when goods are missing, it's not there, it's not removed from any of these three methods, then in that case recovery can happen from the warehouse owner. Otherwise normally if the importer is not paying, the goods are anyways there, the custom authorities will get it auctioned and recover custom duty from them. Any additional amount which is recovered will flow to the importer. The next discussion is with regard to warehousing without warehousing. Now what is warehousing without warehousing? See, sometimes you have an intention to clear the goods for home consumption, but at that point of time some documentation are missing. Now during that period you can't store the goods at port for too long because you will incur lot of high rent. So you can request the officer saying that I want to file bill of entry for home consumption, but at present one document is missing. For that please allow me to store the goods in the warehouse without filing into bond bill of entry. Warehousing without warehousing means storing the goods in the warehouse without filing bill of entry, which is into bond bill of entry. This is called as warehousing without warehousing. Plus if some details are missing, then in that case also the proper officer can be requested saying that I want to warehouse the goods, but for filing into bond bill of entry I don't have some details, please allow me to warehouse without filing into bond bill of entry. Now this is valid for 30 days and extension can be taken, and each extension will be for 30 days and it can go on. So that's the basic premise of warehousing without warehousing. What are the powers of the importer when the goods are there in the warehouse? He can inspect these goods, he can show these goods, he can deal with these goods, and basically he can sell these goods to any other person. That is also possible. These are the four powers which are available to the importer who has stored the goods in the warehouse. Then can manufacturing operations be carried out in the warehouse? Let me tell you, manufacturing operations in the warehouse can be undertaken with the approval of the commissioner. Obviously these manufacturing processes will not be very complex because the goods are in the warehouse and you are carrying out manufacturing process in the warehouse itself. So obviously these will be some minimal processes. The advantage of doing manufacturing operation in the warehouse is you don't have to pay custom duty if your intention is to export those goods. Understand one thing, if you get the goods directly to your premise, then you will have to pay custom duty. Once you have paid custom duty, after that if you export the finished goods, then you will get a duty drawback of the custom duty. Instead of paying and then claiming a duty drawback, what a person can do is he can bring it in the warehouse, carry out manufacturing process and export those goods. Now whenever manufacturing operations is carried out, let's see the taxability. Say suppose entire finished goods is exported. Out of the manufacturing process, if entire finished goods is exported, then on finished goods no custom duty. What about waste, sir? Waste if it is destroyed, then again no custom duty. If it is cleared for home consumption, then custom duty as if waste was imported. That means, say suppose you import steel to make knives, then GST will not apply on that steel. Neither IGST will apply nor balance custom duties will apply, because the treatment will be as if waste was imported, because you have met the objective, you have exported the entire finished goods. What if part finished goods exported and part finished goods cleared to DTA, domestic tariff area? I mean, you clear it to the local area in India. Now, for this, let's talk about exports first. Part finished goods which is exported, this will be the treatment. For finished goods, no custom duty, and for waste, it depends on whether you have destroyed it or cleared for home consumption. DTA, the finished goods which are cleared for DTA will be liable to custom duty as finished goods imported. So that means the rate of custom duty will be the rate of custom duty applicable on finished goods. But however, if the custom duty payable on finished goods is more than the custom duty which would have been payable by the imported articles, then Government of India can give a waiver. What about waste? Now see, finished goods you have cleared to DTA, so waste will not get any benefit. Custom duty as if imported material is being cleared. So for waste clearance you get the benefit only when finished goods is exported. If finished goods are being cleared to DTA, then in that case government is not intending to give you the benefit for finished goods which are cleared to DTA. So waste will suffer as if imported article has been imported. So to the extent imported material is there, based on that custom duty will be applicable. That's the reason government does not want you to do DTA manufacturing in a warehouse. The purpose of giving this benefit is so that manufacturing is done and then the goods are exported. That's the basic premise based on which this entire provision has been created. Okay. The final discussion is improper removal of goods. Say suppose the 1 year time limit within which you have to remove the goods from the warehouse is over and you did not take any extension, then there is a deemed date of removal. It is deemed that the goods have been removed, and the moment this deemed date of removal arises, that day's rate of duty will be applicable for custom duty calculation on that particular product. And the deemed date of removal will be the date on which the goods were to be cleared. The moment time limit expires, that day's rate of duty will be applicable. Basically, government is saying that there is a deemed removal, and as there is a deemed removal, custom duty will be applicable based on that deemed removal date. Reason for giving this came from a Supreme Court judgment, but the reason for giving this is you are not going to file X bond bill of entry. Now when you are not going to file X bond bill of entry, how will we use the rate of duty applicable on X bond? And that's the reason it is specifically defined here. So this is about warehousing. Be careful about how the goods are entered and what are the manufacturing operations, time limits. Interest is a very important provision for 5 marks theory as well as case study. Primary responsibility and warehouse owner's responsibility. deemed date of removal where a practical question may be asked in the examination. Now we will be revising foreign trade policy. See, by the time you have done GST and customs, now it becomes really tiring to just keep up with the number of chapters, and at the end you always feel that no, let me not do foreign trade policy. Please don't do that. At least this revision part, see some important areas so that you are able to recall and write. If the question paper has a very easy question on FTP, you should not miss out on that easy question. And that's the reason this we will do it quickly from the PDF. The PDF is also available in the note section description. This will help you to quickly recollect and recall important provisions of foreign trade policy. So let's start. Now, central government has the power to make foreign trade policy, and they have made foreign trade policy 2023. This foreign trade policy basically provides instruction and guidelines for import and export transaction. Obviously, it comes from Foreign Trade Development and Regulation Act 1992. The purpose behind foreign trade policy was to develop exports and regulate import and export transactions in India. It provides for various promotional schemes which are inbuilt in this foreign trade policy. Now, as an exporter, you wish to claim a number of benefits. Those benefits are available in foreign trade policy. The first benefit which we will be dealing with is advance authorization. Now, advance authorization, what is the benefit? It's a very important segment. Inputs can be imported without payment of custom duty, and those inputs which are physically incorporated in the export product, those can be imported. Fuel also can be imported in this. Mandatory spares is restricted to 10% of the CIF value of the authorization license. That means if your authorization license is of 1 crore, then 1 crore into 10%, up to 10 lakh worth mandatory spares can be imported, because mandatory spares is nothing but finished goods, and thereafter you have this balance which can be used for inputs which will be physically incorporated on those export goods. Validity, obviously the validity is 12 months from the date of issue for you to import. One revalidation is allowed for another 12 months time period. If it is deemed export, then you get higher time limit, project execution, or 12 months, whichever is later. Who is eligible for advance authorization? A manufacturer exporter or a merchant exporter tied up with a manufacturer exporter is eligible. For pharmaceutical products, basically the license will be given only to the manufacturer, not to the merchant exporter. An authorized economic operator holder with a 2-star and above status is eligible for advance authorization. See, one can be, if you have an authorized economic operator license, obviously you are eligible. Plus, if you have applied for it, then also you will be eligible, because the law clearly says that one is authorized economic operator who holds this license. Second, a status holder who has applied for authorized economic operator license and he has a 2-star status rating. Status holder, government gives status 1 star, 2 star, 3 star, 4 star and 5 star. We'll talk about it in some time. Then DGFT has the power to deny any authorization, which is the sole discretion of DGFT. An authorization can never be claimed as a right of any person. Who is an authorized economic operator? Basically, CBIC started a program that those who are in import and export on a regular basis, let them get this accreditation program so that they are able to import and export quickly and without much restriction. That was the basic intention of giving authorized economic operator. Don't forget that it is issued for physical export and deemed export or even intermediate supply, plus stores which is being supplied to a foreign going vessel or aircraft. There are two cases. two specified deemed export cases. One, supply of capital goods against EPCG, and supply of goods to UN or international organization. Here these are not exempted from anti-dumping duty, countervailing duty, safeguard duty and specific safeguard duty. IGST, basic custom duty, social welfare surcharge, everyone will get the benefit. Plus others will get the benefit of these additional duties also. However, two cases, one is supply of capital goods and supply of goods to UN or international organizations, which is not eligible for the benefit of anti-dumping duty, CVD. These they will have to pay and only then they can import. Then all this is subject to SION, standard input output norm, which is defined. Export obligation period, you get 90 days time from the date of clearance of the import consignment. The moment you clear the import consignment, from there 90 days is given to export the finished goods, because ultimately whenever government is giving you a benefit, what does it want in return? It wants you to meet the export obligation. That is how any license under foreign trade policy works. What can you import? Inputs which are physically incorporated, fuel, oil, energy, mandatory spares which is restricted to 10% of CIF value. Now talking about the basis. How is it issued? Obviously it is issued based on SION, standard input output norm, but it is also available on self-declaration basis, plus you can get a prior fixation done from the norms committee, which is the head for determining any norm if your product is not mentioned in that. Plus there can be a self-ratification scheme where you get it done from a certified engineer. Plus say suppose there is an additional input. Additional input does not mean quantity wise. Additional input meaning a new type of input which is required for making this product and which is not there in SION. Then you will have to get that additionally ratified. Obviously chartered engineer certificate will be sufficient for this. Features. Pre-import condition is mandatory. That means all the inputs which you import has to be physically incorporated. Plus you import it, then you use that raw material to make the finished goods. It should not be a case that you have made a finished goods and then you import those inputs. That's not allowed. Pre-import condition is applicable. Same inputs which you have imported, that input only should be used to make the finished goods, not some other input. Actual user condition, obviously these licenses are not transferable, plus raw material imported in this is also not transferable. However, once you meet the export obligation, finished goods can be sold in domestic area also once export obligation is met. Then minimum value addition 15%, but in some cases government can specify even less than 15%, plus in some cases they can also specify more than 15%. If any goods is supplied free of cost by a foreign buyer, then the value of that free of cost material will be added in import computation as well as export computation. That's given in the law. If you want to purchase these goods from domestic area, then you will have to get an invalidation letter or advance release order as the case may be. Annual advance authorization is also given, but there is a limit. It is restricted to 300% of FOB value of exports or FOR value for deemed export. Free on board for export, deemed export free on road in the preceding financial year, or 1 crore, whichever is higher. This is the limit for annual advance authorization. Then there are some common points which are applicable for advance authorization as well as DFIA, duty free import authorization. See, in advance authorization you first take the authorization, import the inputs and then send the finished goods outside India. But in DFIA, duty free import authorization, first you can get those goods. That is, you don't have to get those physical inputs. You can first do the export and then you will get a duty script. Based on the DFIA license, you can import the raw material, or these scripts are also freely transferable. That means, say suppose you have exported shirt. Now, what is the raw material used for shirt? Cloth. So, once you export the shirt under duty-free import authorization license, government will give you a DFIA license for import of cloth. Either you can import the cloth or you can sell these licenses. But DFIA has a value addition of 20%, while advance authorization has a value addition of 15%. DFIA only basic custom duty relief is available, but advance authorization you get relief for all types of custom duties. None of the custom duties is payable. Advance authorization you have to get it before. Pre-import condition is also applicable, but in DFIA first you can export it and then you will be getting that script. Advance authorization is not freely transferable, but DFIA is freely transferable. Then advance authorization is given only where SION is mentioned, or there are certain other ratification schemes which are done. But DFIA only given if your product is mentioned in SION. Plus, it should not be subject to actual user condition. If it is subject to actual user condition, then you will have to go for advance authorization, because DFIA is freely transferable and actual user condition is not applicable for DFIA. This comparison can also be asked in your exams, so be careful between DFIA and advance authorization. Now let's talk about some common points. See, accounting of inputs is mandatory. Whatever inputs have been used for making those products have to be specifically recorded. Prohibited items cannot be imported or exported. Some products can be imported or exported only by state trading enterprise, but if you get an authorization from them, then you can also import or export that. Restricted items obviously allowed only with a license. Domestic sourcing of inputs allowed with invalidation letter or advance release order. Currency should be foreign currency, plus when you realize it, it has to be foreign currency and Indian currency as permitted by RBI. When we talk about DFIA, the benefit of advance authorization scheme is also available for DFIA. That means you can import without payment of custom duty. But here it is only for basic custom duty. Plus, there is a restriction on import of tires which is not allowed. Eligibility, obviously it is post-export basis. First, you have to complete the export within 12 months of date of filing the application that I am going to do the export under DFIA license. Then, next 12 months, once the export is completed, you will get DFIA, and once you get DFIA, it has to be used within 12 months because that is the validity of a DFIA license. No DFIA will be given when there is a condition of actual user on a particular input. Transferability allowed, minimum value addition would be 20%. The next topic is RODTEP. Now, when you talk about remission of duties and taxes on export product, basically when you are an exporter, there might be some goods or services on which you would have paid central excise, VAT, CST. Like for petrol, diesel, there would be a inbuilt CST or central excise, or you have taken transportation service and the transporter would have used petrol. So there might be some taxes on the purchase which have not been refunded to you. Otherwise, GST which you pay on purchase is refunded to an exporter. But what about other unrefunded taxes? To compensate that, government has said that I will give you a remission of duties and taxes on export product based on a percentage, or it could be a value per unit. Now this percentage will be based on FOB value, and this will be in the form of e-scripts. These e-scripts are freely transferable, but these e-scripts can be used for payment of basic custom duty. Most important thing in this is ineligible categories. In some cases, I mean in fact lot of cases, you will not get RODTEP. The first one is if substantially same form export goods imported are being exported. That means no value addition done, you wouldn't have incurred much on the purchase side, let me not give you a refund. Then transshipment cases, minimum export price or export duty. It makes sense. The moment you government has levied a minimum export price, that means government wants to stop exports or curtail exports or reduce exports, or they have levied export duty on a product. Will they give benefits for such products? The answer is no. Restricted or prohibited products, deemed export, you will never get RODTEP. Goods manufactured by EOU, EHTP, SEZ, free trade zone, because they already claim a lot of benefits. Products manufactured for discharging export obligation under advance authorization, DFI or EPCG license. Products which are manufactured or exported availing the benefit of notification number 32/1997, which is dealing with job work and then re-export of goods. So when you import the goods for job work, that time you will not pay custom duty because of this notification where you have just imported for job work and you are going to re-export it. So if you are already claiming that benefit, then RODTEP is not given to you. Then somewhere some custom ports or airports where electronic data interchange is not allowed, EDI facility is not there, again RODTEP will not be available on those ports. And goods taken into use after manufacture, basically we are talking about used goods. Obviously for used goods government is not giving you RODTEP, because machines, if you export them, you will not get RODTEP. Then comes status holder. Status holder, current plus previous 3 financial years. Remember this very clearly. The export performance of current plus 3 financial year, preceding financial year, will be considered to determine the star rating. 1 star is available with $3 million, 2 star $15 million, 3 50, 4 200 and 5 $800 million. Should we remember this, sir? Yes, it is a very important discussion. It can be asked directly in your exams. 3, 15, 50, 200, 800. Easy trick to remember is 3 into 5. 15. 15 approximately, if you multiply with 3, so they go by 5, 3 and then 4, 4. So 15 into 3, 45, they kept it as 50 million. 50 million, then you multiply with 4 2 times, which is 200 and $800 million. You can also use some other technique, but you need to remember this because a question can be asked directly. Now, some additional points relating to status holder. Export performance will be counted not just on FOB but also on FOR. That means both are included, deemed export as well as physical exports. For deemed export, rate of exchange of the 1st April of each financial year will be used. Now for granting export, it is necessary that in all 3 preceding financial year you had export performance. That means you have been exporting for last 3 preceding financial years. For calculation of export performance of 1 star, double weightage is given. Double weightage is given for MSME sector, but only for 1 star. That means if they have done $1.5 million of export, it will be considered as $3 million and they will be eligible for 1 star status holder. Manufacturing units under ISO or BIS, units located in Jammu and Kashmir, Ladakh, Sikkim, and export of fruits and vegetables. Then the law deals with privileges. What is the benefit which you get if you are a status holder? You can get authorization of self-declaration basis. SION will be done on priority basis within 60 days. Exemption from compulsory negotiation of documents through banks. No need to furnish bank guarantee. 2 star and above can set up a export warehouse. Plus, if you are 3 star, 4 star or 5 star, then self-certify your goods. That means you don't see, in some products you require certification to be done by the authorities. If you are a 3, 4, 5 star holder, then self-certification is allowed. Plus, you are entitled to export freely exportable item for promotion. That is, samples can be sent outside India, subject to specified annual limits. As of now, government has not, ICAI has not kept the annual limits for you. Preferential treatment is given, plus they are responsible to skilling and mentorship of other small exporters. Then the next discussion is with regard to EPCG. Again, an important topic, specific questions can be asked. EPCG, what is the benefit? You can import capital goods without payment of custom duty. It could be pre-production, production related, or post-production related. Now, as government is allowing you such a big benefit, they want a export obligation. Two types of export obligation. Average export obligation, which is the average of preceding 3 licensing years, and specific export obligation, which is over and above the average export obligation, 6 times the duty saved in 6 years. That has to be met. Say suppose your average exports for last 3 preceding financial years was 100 crores. That means once you have imported a capital goods, your export should go up drastically. So say suppose in the 4th year, that means once you take the EPCG license, the export was 110 crores. Have you met the average? Yes, 100 crore will go into average and 10 crore will be considered as specific export obligation. Like this, the specific export obligation to be met is 6 times the duty saved in 6 years. Say suppose you have saved 30 crore in custom duty saved. Then 30 crore into 6, 180 crore of specific export obligation should be done in 6 years. 1, 2, 3, 4, 5, 6. If you have met 75% of the export obligation in 3 years or less, then the balance will be waived off. Plus, if you purchase this machine domestically, then in that case, you don't have to meet 6 times the duty saved. You have to meet 6 times into 85%. So 15% discount is allowed if you purchase that capital goods from Indian market under EPCG, obviously using advance release order or invalidation letter. Now, in this duty saved, that is this 30 crore. Say suppose 30 crore was the duty saved. 6 times will be 180 crores. Say suppose I have paid IGST. If I have paid IGST, it should not be considered as duty saved. Now, if you have paid IGST and not taken ITC, then it is not considered as duty saved. If you have availed ITC, then you have taken the benefit, then it is considered as duty saved. So careful about this point. IGST paid and ITC taken, that is duty saved because you have availed the ITC. If you don't take the ITC and pay it, then that will not come in the calculations. What is the validity? 24 months from the date of issue. Revalidation is not permitted, no extension will be given. Then import of capital goods is subject to actual user condition, but once you complete the export obligation, thereafter you can sell these capital goods. Eligible exporter, same thing, manufacturer, exporter, merchant, exporter, common service providers are also allowed. You can import capital goods in CKD form or SKD, semi knockdown and completely knockdown form. Computer system and softwares which are part of capital goods, not all computer systems and softwares, careful. Spares, molds, dies, jigs, fixture and refractories or catalyst, which is to enhance the speed of the process. Incentive for fast track companies, important for case study based question. Okay, now coming to EOU. EOU, EHTP, STP, Software Technology Park, Export Oriented Unit, Electronic Hardware Technology Park, or biotechnology park. See, these are also allowed to import capital goods and inputs without payment of custom duty. In fact, all these are regarded as deemed warehouses. So whatever is the normal benefit available, even they get the benefit. Import of inputs and capital goods is allowed without payment of custom duty. Plus they can store it in their warehouse, that is EOU premise will be considered as warehouse. It can be stored forever in that warehouse without any interest. But obviously if you remove it to domestic tariff area, then taxes will be applicable. Trading units are not allowed. This is an important point. Minimum investment of 1 crore, but obviously for EHTP, STP and BTP or EOUs in handicraft or agriculture sector, 1 crore is not applicable. There should be net foreign exchange earners. In a block of 5 years, their NFE, net foreign exchange, should be positive. That means you have earned more for the country than you have spent on various imports. Okay, then you get an exemption from industrial licensing. Export proceeds can be realized within 9 months. 100% money can be stored in EEFC account, exchange earner foreign currency account. Bank guarantees would not be required because you will have to give a bond once you take a EOU license. 100% FDI is also allowed. Objectives basically to promote exports and all kinds of import exports are allowed. Then the goods which are imported by these units are subject to actual user condition. Careful about this point. They get a reimbursement of central sales tax. They also get a refund of GST which they have paid on purchases. Inter-unit transfer obviously are allowed on payment of applicable taxes. Exit from EOU. Once you exit, you will have to pay back all the benefits which the person has taken, obviously on the stock. Conversion, yes, allowed. DTA units may apply to become a EOU unit. This is one of the last provisions of EOU. Coming to deemed export, again an important topic for 5-mark theory. They can directly ask you to write about all the cases of deemed export. See, basically deemed export is where the goods are manufactured in India and the goods are basically supplied to some projects which are of national importance or some persons who are then required to export those goods or services. Goods, 3 categories. 1. Supply to domestic units who can import without payment of custom duty or at reduced rate. Supply of projects which involve international competitive bidding and infrastructure products of national importance. There could be deemed export benefit for manufacturer. It could also be main contractor or subcontractor. Like advance authorization, the benefit will be available to the manufacturer. EOU, STP, EHTP, BTP, manufacturer. So if you are supplying to a EOU, you will get the benefit, not your subcontractor. If you are supplying to advance authorization holder, you will get the benefit, not your subcontractor. EPCG, same thing. But in some cases, main contractor also gets, subcontractor also gets. Like any project which is financed by multilateral or bilateral agencies under international competitive bidding, or any project where import is permitted as zero custom duty, again international competitive bidding projects, supply to UN or international organizations, mega power projects and nuclear projects. Benefit basically, see, if you are a deemed exporter, you can also take advance authorization for your supplies, because if you take advance authorization, you have to meet export obligation. Export obligation can be met either by physical export or by deemed export. Plus you get deemed export drawback. Whatever you have paid as taxes on the purchase side, that would be given back to you. Terminal excise duty, basically excise duty paid on purchases, that will also be refunded. Conditions for deemed export benefits: directly, some cases you have to export directly to that person. Some cases even main contractor, subcontractor is permitted. Then there are various trade facilitation measures. trade facilitation agreement has been entered by Government of India, and as India has ratified it, India is also obligated to make the trade quick and fast in India, any import export transaction. So they have formed a national committee for trade facilitation, which helps in reducing the cargo time, release it quickly, getting a paperless environment, transparent and predictable legal regime, and improving the investment climate. Then towns of export excellence, important for 2 marks. Basically, if certain towns are continuously contributing to the exports, then those will be regarded as towns of export excellence, and government will try to give more and more benefit to these towns of export excellence. Then this is also an important point, developing districts as export hubs. See, what is the basic objective of developing districts as export hub? In a particular district, there might be some product which has acceptance throughout the world. Then they are trying to promote those particular districts, and if each district is able to export more, automatically the exports of the country will go up drastically and the income levels will also grow up. That's the basic objective of developing districts as export hubs, where they will promote, the district collectors will promote, saying that you export these products and we will try to give you more and more benefits. For this, government has made district export promotion committees at the district level. Handling quality complaints and trade disputes is important. Then we talk about some general provision. See, when we talk about import export code, required for any import and export transaction unless exempted, given by DGFT. At present, PAN is equal to the IEC. Mandatory documents for exports are bill of lading, and then you have commercial invoice and shipping bill. For imports also you require same documentation, plus government also may ask for some additional documentation depending on case to case. Again, this is important for your exams. Penal action which can be taken against a person and he can be put under denied entity list. Now, what is this? Say suppose a person fails to meet export obligation. He has taken the license but not met the export obligation, or violates a condition and does not pay the taxes, because if you have failed to meet export obligation, you should pay the taxes. If that is not done, penal actions will be initiated, plus he will be put under denied entity list. Once he is placed under denied entity list, DGFT has the power to directly refuse any further license which this person applies, and he will not get any renewal of the current license as well. The moment he pays the duties correctly, again this denied entity list will be revoked and he will be eligible. Then let's talk about some provisions which is related to import of goods. Actual user condition, mandatory until and unless it is specifically dispensed with. Samples can be imported, yes, duty free up to 3 lakh rupees, and exporters are also allowed to import samples up to this 3 lakh, because they will be required to manufacture those products and send it outside India. Gift, when you talk about gift through post or courier, it is prohibited, but Rakhi and life-saving medicines can be imported as gift even through post or courier. Passenger baggage, obviously it is dependent on baggage rules 2016. Re-import of repaired goods. Say suppose goods have been repaired outside India and you re-import. It can be done without an authorization. Any goods which is used for a project abroad can be re-imported, at least if it has been used outside India for 1 year. Then without authorization you can import it. Otherwise you will have to take a license and import it. That's the only thing. Prototypes, yes, that is also permitted for actual uses. Without any authorization, import is allowed. Again an important discussion. Second hand goods. When we talk about second hand goods, which is other capital goods, it is restricted until and unless it is for repair, refurbishing or re-engineering. We don't want waste to come into India. Second hand other than capital goods we don't want. Capital goods we are fine if they are refurbished, reconditioned, for which chartered engineer certifies that 80% of the residual life is still there. Any other case will fall under restricted category. That means it can be imported only by authorization, like AC, DG set, diesel generating sets, desktop computer, refurbished products, all notified electronic and IT goods. All these, basically when we talk about electronic waste, government wants to deny it and it is restricted. But what about machines, etc.? Yeah, machines, etc. is allowed to be imported without any authorization. But electronic waste, there is a restriction. Electronic waste like air conditioner, DG set, desktop computer, refurbished spares and notified electronic goods, these are not allowed without authorization. They are restricted, so they can be imported only with authorization. Then some miscellaneous provision. Obviously goods can be sold on the high sea, that is permitted. From merchant exports are also allowed, that is from non-taxable territory to non-taxable territory. And then we talk about some export provisions. Will the supporting manufacturer also get the benefits of export if his name is mentioned in the bill? That is also third party export permitted. That means both the names will be mentioned, merchant exporter's name, also the manufacturer exporter's name. Samples, export of samples allowed if it is duty freely importable, then no issues, they are allowed without any limits. The limit is 5 lakh rupees. Passenger baggage, obviously when we talk about passenger baggage, it can be either by the passenger or if unaccompanied within 1 year before or after the departure from India. Import for export basis, yes, that is also permitted without any authorization if those goods are freely importable and freely exportable without any authorization. But say suppose it can be imported under bond and then cleared against convertible foreign exchange, then in that case, and also which are restricted for import, then in that case import for export will be allowed only with the authorization. Capital goods which are freely importable and freely exportable can be imported by executing a LUT or bond. See, in these cases only one particular provision has a complete relief, and that one particular thing is if any goods other than these capital goods are freely importable and freely exportable, then without authorization it is allowed. Other cases you will have to give a bond or LUT. Plus, when we talk about payment and receipt of on import and export products, all the export contracts should be denominated in foreign currency, or it can also be denominated into INR. But if you receive the foreign exchange, you should get foreign exchange. Plus, INR is permitted wherever RBI allows it. If you don't realize the export proceeds, then the benefits which are taken have to be returned back to government. Export credit agencies are for supporting the exporters. Obviously they give a financial credit. Export promotion councils, their main job is to promote exports. See, most of the exporters are registered with Export Promotion Council so that they can avail various benefits which are extended by government. One of the major benefits which we earlier also said is self-certification of origin of the goods. You can certify that goods belong to India, that is, you can write made in India without even going to the authorities. This is one of the major benefits which is allowed to exporters who are registered with Export Promotion Council and of approved exporters based on status holder, that is 3-star, 4-star and 5-star. So this was a quick revision of foreign trade policy. At least this much don't miss, so that if a easy question comes, you are able to tackle that easy question easily for your exams. Your mode of practice for each chapter of GST has to be practical as well as case study type. Customs, there will be 1 or 2 practical questions and 2 to 3 theory questions, and then FTP you will have theory questions. Sir, in GST even the theory ones are mostly case study based questions. Last thing, when it comes to GST, don't miss out on case based MCQs. At least see various case study based MCQs for about 1.5 hour or 2 hour max. Have a look at those case studies, see the points which are easier, don't miss out on the easier points. Output and ITC computation may take time, GST payable computation may take time, but all case study based MCQs will have 2 to 3 easy questions as well. Have a look at all these easy questions. We should not miss out on those easy questions. Computation related questions take up at the end so that you are able to utilize your time properly. Pick up the easy questions from your paper. First complete those easy questions. Keep a specified time limit in that 3 hours for your MCQs. If I were to do a computation, 3 hours is about 180 minutes. 180 minutes into 30% of your questions being MCQ, about 54 minutes for MCQ based questions. That's what you should allocate. It might take more time sometimes, but that's why plan your paper first from the subjective areas. That's my suggestion. Or you might also follow a technique of reading first 15 minutes and reading all the MCQ based questions and then going for the case study. But when it comes to case study based questions, smaller ones can be done quickly. Either you know the answer or you don't know the answer. But computation related questions which involves output minus ITC will consume too much time for 2 marks. So first clear off subjective type questions. Once you clear subjective type questions, depending on what you know and what you don't know, once you clear those subjective type questions, you are now into the flow of indirect taxes. Once you are into the flow of indirect taxes of solving, then you go to the MCQ. Your case study based MCQ will also run faster. But taking up case study based MCQ at the beginning is not suggested by me, though every student has a different technique, and follow the technique which is comfortable to you. Wishing you all the best for your November 23 exams. Take care, study well.